buyback and doing incredibly well. There is a sense among all the fast foods that somehow business is going to slow, but they've done some work about in the last recession. McDonald's is the best performer. Wingstop's up there too. I don't want to sell Wendy's. I want to be a buyer.
Let's get to the opening bell here. Get the CNBC Real-Time Exchange. And the big board today, it is Bread Financial, formerly Alliance Data, celebrating its rebranding at the NASDAQ. Oncology-focused Zentalis Pharmaceuticals celebrating its second listing anniversary. Of course, we just strung together, Jim, a few positive weeks for S&P and NASDAQ. We've not done that in 5 months.
Yeah, look, I think that there's a lot of surprise. Just take Friday. Friday, the market suddenly rallied. And I was writing what I thought was going to happen, and then the last hour, you just got this great, a really great rally. I think it's good. I was talking to my friend, the great Larry Williams, who was saying, look, understand that there is absolutely another 2 weeks of up. Historically, there's just a lot of historical data about April, and that April being positive, and I don't want to go against it. I think it's still
seasonally strong, although there are a couple notes out today. Mike Wilson, Morgan Stanley, saying bear market rally over. Made sense for the time, natural place for it to end.
Well, Michael Wilson, he wasn't really a part of the rally.
No,
and I think the judges had him on overtime, and you know how like when you want to make a steak, you got to keep it like you don't want to put it all the way up unless you want it to be Pittsburgh. Scott made him Pittsburgh. He Pittsburghed him. And I think that was brutal when you get Pittsburgh.
How do you like your Mike Wilson? Medium rare? Okay.
I do, but I don't want him burned on the outside, red on the inside. Now he didn't make a move. And he, but at the same time, I think at the end of it, you did feel that maybe it would be best for a salad or something. You want to eat it directly.
There's a look at Twitter. B of A Jim has a note out this morning. The desk says, what do advertisers think? They say it's debatable about whether or not advertisers sometimes like a cleaned, scrubbed timeline.
Look, I worked hard before I presented this proposal to Twitter that they should have a two-track. You pay a subscription, and people have to use their names, and then you can do the free-for-all. And I said, I think that the subscription, you could have some higher-end advertisers. The advertisers that I deal with, because they are unfortunately they are aware of the unfortunate nature of my mentions column, don't want it. They don't want to be there. They don't. And Twitter also has to make it easier so that you can buy on Twitter and get the product. Now, Twitter will tell you they're in a lot of they're part of the conversation, and they clearly are, but the horrendous nature of the mentions does not make it so Procter & Gamble wants to be there as much as they might be. A lot of the brands are there, but they're not. They're flooding the money away from there.
Yeah. Well, they also mention, B of A, that Musk's following, as powerful as it is, and the way he moves things like Dogecoin, if you fold Twitter into that universe, better be ready for some more implied volatility on this name.
Oh, I think that's very true. I also thought when I came in this morning and I saw it up I said, finally, someone has decided we got to buy this thing, fix it up.
Yeah, but that is not really the case here. And again, it is a very significant stake at over 9%. And obviously, Mr. Musk is already up 20+%, 21% on that.
It's nice to have that happen.
Which is nice. By comparison, Jack Dorsey owns about 2.25%.
Yeah, it's amazing how much more
of Twitter. So clearly Musk owns a lot more Twitter than its founder does. But I don't know where this leads, and nobody else does. Now, many people seem to believe that over time, perhaps this will result in him having a lot of influence. Right now, he's not looking for any board seats. It's a passive stake. But clearly the market believes that will change.
Well,
and that he will be here for a long period of time. It won't be just a trade. Sometimes, remember, with Musk, you just don't completely know where you stand on certain things.
But how about his poll? Do you think there's enough free speech on Twitter?
I don't know what to make of that. I don't know what to make of that.
Only one person, right? There's been a couple people have been banned.
Yeah.
A former president has been banned, but not many others. And when you ask them about the threats, implied threats, they keep telling you that they'll fix it. But the fact is that they want combat. And combat breeds pages. But I think that the advertisers don't want combat. So the daily average users can go up, but it may not be the daily. Maybe a sports team wants it, maybe a network wants it. But the fact is that if Elon Musk can make it so that it's not as violent, I think it'd be okay.
Right, right. I'm wondering what you thought of Lisa Su's comments about consumer end markets. B of A's got a note today about Dell. Because so much of their mix is commercial, they think they could be a bright spot in a period in which we're going to be more wary of consumer end demand.
Look, the new AMD is an enterprise company. Very little having to do with low end. The battle right now is HP does a lot of low end. People really jamming that last week. And Dell's been cut twice. If you look at, say, Intel versus AMD, what she was saying is basically, look, we're not in that battle. We're not in the low-end battle. We're only in the high end. I mean, she still goes to Xilinx, goes to Europe. She's talking to telco. She's not talking aerospace. She's talking all the different great things that Xilinx brings. So this is a direct move away from enterprise. Just a direct move away. And I mean, away from consumer toward enterprise. And, look, enterprise is strong. Enterprise is definitely strong. High performance is strong. I don't know about consumer. I think consumer really is, in the end, work from home, and everybody's got them.
Everybody's already set up.
Well, look, we always have this pull through, which means that, I mean, even Crocs today, a downgraded Crocs is a pull through.
Right.
There's a lot of like pull through, and pull through means everybody bought everything during pandemic, and then they don't need to do it anymore. And I think that Intel is pandemic, and I think that absolutely AMD is not pandemic. It's post-pandemic.
Jim, Jim, I don't know if you saw some of the weakness in the freight-related names on Friday.
I have
trucking,
a line on that. I'm glad you asked.
Even I think FedEx and UPS were a bit weaker as well. Something called Freight Waves. It's a business that benchmarks, analyzes, monitors, and forecasts freight markets, but also comes out with commentary. And it really moved the market on Friday with this article that then a number of analysts have then sent around who follow it. Take a look, and you can see what we're talking about there. Why I believe a freight recession is imminent is the most recent article talking about capacity expansion always continues well past the peak and can even continue for a time after the market has entered a recession, talking about the bloodbath of 2019 and saying, for example, we were turning down 4 loads for every truck a year ago. Today we're barely keeping our trucks running. In some market things are so bad that we've resorted to signing up for a load board account to keep them moving, kind of freelancing. So some controversy from this, but it had an impact. The idea that, in fact, trucking is not going to be strong for much longer. In fact, it's already weakening substantially.
Okay, so
and this is a very influential voice, apparently. I'm not familiar with it.
I have better data.
Yeah. You have better data than Mr. Freight Waves?
Yeah, I do.
Oh.
My source nationwide covers, hope to be able to get my source to be able to be on the record. Freight rates have fallen 30 to 35% over the last 6 weeks. Spot market. 30 to 35%. Wow. But, as is often the case, the debate is, he's talking about supply.
Yeah.
Do you know that there are now more truck drivers, as of last month, in this country than there were pre-pandemic? And that...
I thought we had a shortage. That's all I've been hearing about is a shortage.
Well, that ended.
What, did it end in, it ended?
It took
some day in February it ended?
My information is so good it's scary.
Really?
Yeah. That's a quote.
No kidding. Who's it scaring?
I'll try to get it on the record.
Will you try and do that for us?
I will. Is it back? Is it back yet?
You're better than Mr. Freight Waves.
Yeah, I'm much better than Mr. Freight Waves. I got nationwide numbers down 30 to 35%. But the main thing is because there's more drivers. So therefore, there's more competition. And by the way, there's a lot of 3 and 4 local
although you agree with them, potentially.
Well, but I'm saying that if there's
booms are followed by busts. A typical trucking cycle is 3 years.
Tons of demand.
And usually what kills it is oversupply. Too many trucks chasing high-paying spot freight and high-load volume.
Well, there's not more. There's more drivers. Look, I don't. Do I want to be in those stocks? No, but I'm talking about something that could be very good for the country. I'm not wanting to say to buy a freight company.
Better freight supply.
Yeah, well, how many times do I have to read from these different companies, the Proctors and the Colgate, there's a problem with freight, problem with freight, problem with freight. That's going to go away. The domestic. What won't go away, obviously, is the port situation, particularly with the longshoreman contract coming up. But I think the idea that you can no longer have the excuse that you want to ship something from Minneapolis to Dallas, that's down a lot.
Shares of Maersk were down a lot. Knight was down, as you know.
They're all
as this article made the rounds, yeah.
Well, no, but it's true.
Right.
Except for it's worse. 30 to 35% spot rates down. Now, some of these guys have long deals.
So it's worse.
Well, there's just a lot of drivers. We thought there was a driver shortage. That's over. It ended. It ended in the last 6 weeks. I don't know why.
It kind of reminds me of Citi today, Jim, weighing in on Gary Friedman's earnings call at Restoration last week, which they say echoes our proprietary credit card data, home-related spending down for 4 consecutive weeks, and now negative year-on-year, 4%.
Yeah, that was jarring. There were 2 Gary Friedmans. There was the Gary Friedman from the letter that he put out, Cheryl letter, which was really fabulous. And then there was the Gary Friedman on the conference call, of which there was a kind of, let me say, fright. It indicated there's fright, and the wealthy are frightened. And when the wealthy get frightened, I mean, wow. And he's talking about, he had many references to Ukraine, 4 references to Janet Yellen, 2 references to Jay Powell. I want references to furniture and to the great galleries and to London. That was briefly mentioned, but David is really Yellen, and at one point he was talking about kind of like a nuclear war there. I mean, I don't know. After I read it, I told my wife, so we got to cut back our order. Wow, I'm not nervous enough. She goes, yeah, you are. You're oblivious to what's going on around the world. You're always just in your little world. That's all you care about.
And then she said, and I'm not even going to have a Baconator.
No, it wasn't that same conversation.
All you care about, and I'm not even going to have a
Clean your socks up from the den floor.
Oh, no, she did say, if you don't pull your socks, you know how you boil your socks? If you don't pull them, then you're going to get them back just like that.
By the way, real quickly, guys, talking about somebody else who seems to be a bit nervous, Jamie Dimon. Of course, we haven't really talked about the letter. His annual letter, in which he sort of talks a bit about what the expectations may be in terms of Russia and Ukraine, and perhaps further sanctions, what that's going to mean for the global economy, obviously as well for the euro area, where he sees what GDP growth, there are economists, at least at JP Morgan, of 2% in 2022 instead of what previously been expected to be as much as 4.5% pace of growth for those countries, even as little as 6 weeks ago. And then he goes on to say the Federal Reserve and the government did the right thing by taking bold, dramatic actions following the misfortune unleashed by the pandemic. It worked. But also in hindsight, the medicine, as in fiscal spending and QE, of course, was probably too much, lasted too long. And the Fed gets it just right. We can have years of growth and inflation will eventually start to recede. But he goes on to say, who knows in a way. And one thing he predicts is volatile markets.
Yeah, it didn't, had the usual parts about how America's great, but and a little bit about fintech there. But and how he's handicapped by having to have has all those deposits. But overall, when I read it again, I had the feeling of restoration of our age, which is that you need to be more worried if you're investing. I mean, the takeaway if you read this is, well, I got to cut back a little.
Right.
And I don't know if he meant to have that happen, but it made me feel much more uncertain about the world, and this. I'm hoping, it's very interesting. Is the United States going for a tie or for a win in Ukraine? I mean, are we just settling for this Russia being this way? Because when you read this note, he's really kind of saying that the West has gotten together, and that's amazing, but that they have to go to China and say, listen, we need your help to end this war, basically. If that happens, then there's no reason to be let's say, as concerned as he is. But if it doesn't happen, I understand. Russia, again, size of Italy in terms of GDP, size of Texas, and yet calling all the shots in this world right now.
The images in Bucha over the weekend are just unbelievable, just heart-shattering. By the way, Goldman today does name JPM top pick going into earnings a week from today, based on better fees relative to Wells or Morgan Stanley.
I think there was a good, interesting advanced micro. No one listened. Stocks was up $1.07, and now it's going right down. People don't want the semis. They don't want the banks. So I think that JP Morgan that's a great note, but no one's buying it. They're just not buying it. And it's really incredible to me because I think the stock is cheap, but it just doesn't seem to matter.
Right. We'll see what happens in a week. When we come back, David's got an exclusive with Liberty Media's Greg Maffei, talking about a wide range of topics, including his recent announcement about Formula One's Grand Prix coming to Vegas. As we go to break, kind of a light week for macro. We will get ISM services tomorrow. 2-year got almost to 2.5 today, and the 2s, 10s still inverted. Back in a moment.
like 6 months.
Well, you had it, and I think Kev was talking about it a little bit earlier, right? The 43-page manifesto
Yeah, it's
from
a lot.
Diamond. I mean, that's more than a quick turner.
He's
there.
kind of liking
to
these,
say the least. But he really was. Hey, sometimes you need something to get you going on a Monday morning. 43 pages can be it. But I mean, look, he really talked about three key factors coming up for the next decade. He talked about driving the markets. The first one is the response to COVID and the economy's pushing out there. And we're already seeing that drive everywhere where it seems to be pushing too hard. The second part was the other area we've talked about, which is inflation. And really the impact of inflation going to be on the marketplace and how we handle it. And then the third was the war in Europe and with Ukraine and its impact. And I think it's interesting when you really start to read what he talked about 2% of GDP growth coming out of Europe just based upon the Ukraine-Russia conflict alone. He's talking about Russia being down 12% in GDP by midway through this year with the sanctions. So all of a sudden, there's a lot of headwinds out there, let alone what you're talking about in inflation. And so I think what you then saw here was this open question with the overall global market saying, wait a second, if these are the big concerns we have here, what are the exposure? And you heard in that paper as well, $1 billion in Russian assets still in play for JP Morgan. Not a huge amount, but not a small amount. But also remember, a lot of international markets, Europe, Asia, et cetera, also big on their balance sheet. So I think a lot of the weakness you're seeing in JP Morgan is that there is some potential concerns globally for their growth views, let alone the interest rates, while helpful. If things start to slow down, this is just a behemoth of a bank with all kinds of fingers all over the different areas globally. There may be more risk at play, which is really why I think you're seeing it kind of pull back a little bit. Unlike some of the other banks here in the U.S. that maybe still have a little bit less of the exposure internationally, like a Bank of America per se, that maybe has a little less of that. And now here, people are saying, wait, maybe JP is a little bit more concerned. And you start to see that. Wells Fargo cutting its price target down $5. More of them starting to look to say whether or not JP Morgan has a growth opportunity to have it, even with the rising interest rates.
All right, nicely done, Mr. McKenzie. Great stuff. Pleasure having you this morning. Thanks, JB. Good work. Mr. McKenzie is the managing director of Futures and Forex at Charles Schwab. All right, there's our big movers for the morning. When we come back, let's get into some more real estate, some specific stock picks after we heard the case for housing real estate earlier on in the show as a way to hedge inflation. What about the other side, the commercial and then also the data center and tech-oriented supply chain real estate? Is there still more to be done as the last year forced companies to try and fix their supply chain? Companies like Prologis were the beneficiary of that. We'll talk about it next as the stock is sitting near the highs.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our Active Trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're They're made by them. Thinkorswim by TD Ameritrade.
I'm Maria Schrader. Here are a few stories to watch this hour. Loop Capital downgraded Crocs to hold from buy and cut its price target to $80 from $150. The analyst says investor sentiment has changed materially, associating it with COVID winner names. However, she wants to stay on the sidelines, particularly to see whether Crocs' Hey Dude acquisition accelerates its growth. JP Morgan upgraded Zebra Technologies to overweight from neutral, but cut its price target to $500 from $530. The analyst thinks shares should trade more in line with peers and at a premium to its historical multiple. He notes that Zebra's margins are expanding, and the company has nice visibility into 2022. And Wells Fargo upgraded Ollie's Bargain Outlet to overweight from equal weight and raised its price target to $65 from $45. The analyst thinks the stock could make a meaningful move higher and expects momentum to turn positive in the coming quarter. He also argues that Ollie's can uniquely benefit from growing consumer headwinds. This has been your TD Ameritrade Network Market Update. Now back to Morning Trade Live with Oliver Rennick.
Okay, let's talk some more stocks and real estate, this time shifting away from the housing side. Joining us, Sam Adams is the CEO at Vert Asset Management. Sam, we heard earlier that a shortage of a housing means that prices, even if they cool, will still be drawing in buyers and make it a good inflation hedge. What about the other side of real estate, the commercial side, where there's still a lot of emptiness I see around in businesses?
Yeah, there's some real headwinds for some sectors of real estate, particularly in office and in the retail sector. That's nothing new in the retail sector, right? We've known that we've had too many malls in the U.S. for a long time, and we're switching more towards e-commerce. But the office sector, I think people are going to start coming back to the office. I think those occupancy rates are going up already. And a lot of the real estate investment trusts that we invest in have had all of their rents paid throughout the pandemic and continuing. So not as much of a problem at the moment, but there's still questions of whether, how much office space do we need in the future?
Yeah. Is there any way to model that right now? Obviously, there's more people in offices than there were 2 years ago, 18 months ago, but still tons of empty space. I mean, even in our main building here, this is a building they opened up in a big area of Chicago. They wanted to build up for corporate space. And I mean, it's still not even close to where we were pre-COVID.
Well, one of the things that helped me at least get my head around why it's so difficult to model these things is that office leases are typically 5 years, sometimes 10 years long, right? So any of those companies that have an office lease that have come up in the last year or two, they tend to just renew the lease as it is because it's really hard to make a decision, at least so far, of how much space you're going to need. And so, we might need less people in the office at any given time, but we want more space in that office. And so what you see is a lot of firms renewing their leases and then the building's kind of staying a bit empty for now anyways.
A couple of the companies that you guys like in the Global Sustainable Real Estate Fund, ticker VGSRX, that's the Vert Fund. You like Prologis and Extra Space Storage. Let's go to Prologis first. This is one of the supply chain beneficiaries that seemingly has no lid to its stock price. PLD is back up to the highs. Pretty amazing stuff. Are we still getting more logistics customers signing on and building out more space for Prologis, or is this about just squeezing the juice out of existing tenants in their locations?
Yeah, it's it's really hard not to overstack the positives for Prologis, right? You've had a logistics, a warehouse company, the largest in the world, that through the pandemic has just been enjoying explosive growth, and they're a really well-run company, and they keep expanding. Recently they made an offer for $21 billion worth of warehouse space from a private equity firm, Blackstone, in Europe. That would be the largest private real estate transaction. They're just going from strength to strength. So But when you look at e-commerce and you look at the need for us to get our goods shipped from one place to another, it doesn't seem like there's a way to model that going down or coming back to pre-pandemic levels. It's we've all got kind of addicted to ordering things online. So I think that's an area that's going to continue to grow. Given the supply chain crunches that are happening now, this is just an area that seems to keep going up and up.
Prologis at 165, getting ready to breach that previous high. The storage, extra space storage chart looks pretty similar, drifting a bit higher. I was surprised to see a little bit Simon Property Group in your top holdings after what you just said about malls. Sam, how does that fit into the equation? Well,
yeah, so unlike the storage sector and the logistics or warehouse sector, the mall sector has struggled. Now, here's the way I like to think about the malls. A lot of towns in the U.S. in particular have too many malls, and some of them are going to have to be repurposed into some other type of facility. But the Class A malls, the really nice ones, they're going to stick around, right? It's the Class B or Class C malls that will give way. And Simon doesn't own a lot of those, and some of them they've already repurposed or gotten rid of. So most of their properties are Class A malls, and those are the ones that are going to stick around. They have done a good job of shifting some of the tenants in those malls from straight retail to more activity-based things like restaurants and gyms and others like service businesses, so that these malls are more like town centers as opposed to just a shopping destination. And that will help increase footfall and increase the rents going forward.
Okay, the mall town center, I can dig it. Thanks, Sam. We're going to do some trading with a couple of these stocks in mind. I appreciate your contribution here.
Thanks for having me, Oliver.
You got it. Sam Adams, the CEO at Vert Asset Management. Let's trade a few of the winners there. Alex Coffey's joining us, co-host of Next Gen Investing. Look at Prologis and Extra Space Storage. So you got two bullish trades on here. Alex, charts looking pretty similar. Do you have a similar approach to these? What do you see as a good way to maybe trade a potential breakout for these stocks?
Yeah, both example trade illustrations here, Oliver, are very comparable. Liquidity a little bit questionable for both. No weekly options either for either. So I wanted to keep these trade illustrations fairly simple. Typically, if there's less liquidity, it may be advised to consider less options involved in the strategy, but also using spreads, which have theoretical profit and loss and probabilities around them, can help you get possibly more fair fill prices if executed in these particular names. But let's start with Prologis here, Oliver. I think this is a really interesting story, as your guest laid out. As we watch, even looking back to GDP in the fourth quarter, 70% of the GDP growth was due to inventory growth, as we've seen companies, as a result of the pandemic, and possibly continued supply chain disruptions, move from kind of a just-in-time inventory system to what's being referred to as just-in-case. So you're seeing builds in inventory because they're not so sure how long it's going to take to get things. Prologis, also due to its warehouse exposure, those warehouses are particularly, as your guest pointed out, tied to the e-commerce industry, which is, of course, growing as well. So a very interesting company. What I wanted to look at in this particular case is buying a call vertical. We're looking out to the May expiration. Again, only monthly choices, so you could either look to, if you wanted to stay shorter term, something out to the next week or so in the April expiration, or go out to May. I've elected in this particular case to go out to May. The 160, 175. This is the first in the money strike by a significant margin. So you could look to 165, but that's kind of barely in the money. I wanted to make sure that we're buying some real intrinsic value in this trade as well. And we're selling the 175 to reduce that debit cost. If we're able to fill this for 750, that's exactly 1/2 the width of this spread, which will set up a 1-to-1 risk-reward ratio. That's really the crux of this trade. It's a bullish strategy that caps out its gains at 175, which would need a rally, but it also is defined risk in the sense that if it does slide below 160, we don't lose beyond that, but we do have 750 in risk to make 750 with a break even at 167.5, which is pretty close to where it's currently trading on the markets in real time here. The other name that was mentioned was Extra Space Storage, Oliver. This company is a little bit different, though. This is a company that specializes in, it's Utah-based, and its portfolio consists of self-storage units. So me or you or anyone goes and they rent one of those little garage facility, warehouse facilities. They can park their
or
extra
Walter
stuff.
White.
Exactly right. Now you got the picture. This isn't the same story in terms of inventory builds, but it is notably, I believe, the most prominent sector in terms of how it performed in 2021 within the real estate investment trust sector as a whole. So it's been very, very strong. And from the things that I've read, and according to your guests as well, there's still optimism that this space can continue to grow, be it for downsizing, whatever it may be. Same strategy, though, Oliver. In this case, buying the 200-220 call vertical, looking for a $10 debit. So same things here. 1-to-1 risk-reward ratio. Can make 1,000, risk 1,000, break even 210, which is slightly above where it's trading. And again, some of the same things apply. So 210, break even, you just add that price to the long call that's in the money. But liquidity a little bit dicey here. So possibly be careful if you're using options as a substitute for stock shares.
Okay, so the REITs are not the most liquid options, to your point, for both of these, even though they're pretty popular trades within this category. You just have to be aware of that and pick ones that give you the highest chance of being able to get in, being able to get out. Both call verticals here, some pretty straightforward hedged upside exposure into Extra Space Storage and PLD. Thanks, Alex Coffey, host of Next Gen Investing, coming up. Let's talk some more tech, both cars and chips. We're going to take a look at Micron and Uber. Hour 2, and the NASDAQ is running here. Strong start to the week. Qs are ripping. We'll check it out when we come back.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust the time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting drawings, drawing tools, and then type of drawing. For symbol comparisons, select studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes
Oh,
away.
wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Welcome back to Morning Trade Live. We are in hour 2, and 30 minutes of trading has pushed the NASDAQ up more than 1%. Qs are on the move, but not the same in the Russell or the S&P 500. Market's pretty mixed right now. Twitter, obviously, the big highlight after Elon Musk's stake, but we have a few other tech trades to think about. We're going to take a look at Micron. That's our morning trade as the chip maker last week struggled alongside its peers in the semiconductor category to find meaningful headway. Really important rollover in chips last week as I closed out the show on Friday looking at both chip makers and then the rollover in transports that we got at the end of last week. So we're going to check out Micron. That's an important name within the group, and we're going to get an update here on data with factory orders from Ben in a sec. Chartmaster is going to take a look at some analyst notes out. I'm particularly interested in NEO to see what sell-side analysts are saying after the company's deliveries. Okay, let's bring in Ben. Factory orders, our main data point this morning. It's also a pretty quiet week for the economy, by the way. Not a lot of big numbers coming out.
It is. It's probably one of the first weeks you can say that in a long time, Oliver, in a market that's been so headline-driven. As you mentioned, kind of limited in terms of economic data and earnings for that matter today. The focal point in terms of numbers out, factory orders, it just came in negative. Now, I do want to point out, down only, well, this is now the second time since June of last year, down only 4 times, Oliver, since the pandemic. So we are seeing a little bit of a shift change here in terms of the numbers. And again,
negative print.
A negative print and not what you want to see. I think prior was 1.4% to the upside. Now this coincides, keep in mind, China's factory slump that we saw in terms of activity last week, the most in 2 years, their PMI to
They were shutting down factories in China, COVID and all that.
So a little bit of a different scenario. But again, in terms of talking about recession and some of the economic slowing or, lack thereof, we're starting to see signs that things are slowing just a little bit. Now, again,
we don't want a negative factory order. It's not a good number.
But we make it real clear also, one data point does not a trend make. So let's keep an eye on this in addition to some of the other numbers out, Oliver. But I did want to take a look here in terms of what we're seeing here.
NASDAQ's fine with it.
This is the big move here today, to say the least. But look at the Russell, which is actually still kind of pointed south. Now, Oliver, we talked about how we were at this pivotal area for the indices earlier in the show, and I think we're going to need to see all 4 of the majors in line together one way or the other to get follow-through. You're not going to see a lot of follow-through in the NASDAQ spiking, the Russell. This sort of feeds more into just that volatility you'd expect to see at a key area.
We used to get this a lot during COVID. Russell down, NASDAQ up, back and forth, either or. A lot of times you wouldn't even get both of them working the same direction. But throughout the last kind of push higher last year through the peak into November and since the peak, things have been pretty locked together. So you'd think this gap's got to close one direction or another.
The other thing to keep an eye on today is actually rates are on the rise here. So even with factory orders falling, you've got the TNX, the TYX up, and so that'll create a little bit of a headwind at some point for the NASDAQ to the upside here. I think this is a couple of the individual names that are really driving tech right now today. Here you can see
yields are up.
Keep an eye on the 5-year, the 2-year, especially the shorter dated, the end of the curve, because that's what's been feeding into those recessionary fears. And ultimately, again, the 30-year on the move higher. Look at this. We're talking up to 2.5% here. So these are the fundamentals that have been weighing on the market since the beginning of January. I think, again, these short bursts that we're seeing to the upside so far have been short-lived. It'll be key to see if we can get some follow-through in this one.
Okay. Kind of looks like maybe it's a little race here. Which one breaks out first? The 10-year yield back to the new high, or does the NASDAQ break out above 15,000 and hold it today? Nice context in the factory orders coming in okay with expectations, but still negative, so not helping. All right, thanks, Ben. Good stuff. Host of Futures and contributor here on the TD Ameritrade Network. All right, let's talk some stocks. Uber and Micron now on our focus. We got Michael Keeley joining us from Salt Lake. Mike, let's talk some Uber here. The company has been struggling. And I'll tell you what, here in Chicago, I don't remember the last time I took the Uber. I've been doing the Curb app. And guess what? It's like a third of the price. And the ride shows up on time. It's almost like we're back to the old days.
Well, ride hailing has been one of those places, Oliver, that's been rife with legislative risk. And that's what this is really speaking to here, is the news that developed. And when analysts are doing their assessments of a firm, oftentimes our viewers may be familiar with the term SWOT analysis: strengths, weaknesses, opportunities, and threats. And we can look at the whole gig economy, gig working space as being an opportunity of sorts and a threat. But what this bill did, Oliver, is it resulted in Mizuho as a firm saying, hey, we're now touting Uber as pretty much our top pick, with a $72 price target, because it removes a lot of uncertainty. So the state of Washington now enacting a law that allows the gig workers to remain as contractors, but nonetheless receive benefits such as injury protection, paid medical leave. It really is a compromise between the state legislature, unions, and ride-sharing companies. And it's similar to Prop 22, as stated here in the slide, with incremental costs that are very comparable as well, likely to be passed on to the end user, to your point about the cheaper alternatives. But what this does as well, Oliver, it ushers in a minimum pay standard at the state level for both Uber and Lyft drivers. So this is now marking the first U.S. state. We've had it already be the case that Seattle and New York City enacted some measures to deal with the wages that were being paid. But the specifics are now that they'll earn a minimum of $1.17 per mile and 34 cents per minute on the minimum pay level of $3 per trip. Also, the new drivers, or the law will spell out that drivers have access to paid sick time, family medical leave, and long-term care programs, plus be eligible for workers' comp. Of note, and this is something that the drivers themselves certainly resonate with, they now have the ability to appeal in that event that they're removed from the apps themselves. So there's some interesting developments here. We see that the shares are up on both sides of Uber and Lyft. And in the case of Uber, we had a downtrend, but some pretty strong support at right around $29 that the stock is bouncing up and off from at the moment.
So it's an interesting middle ground, this Washington agreement that still doesn't have them as employees, but gives them a lot of employee-like benefits. So for the uncertainty of the company from a legislative regulatory standpoint, there's some degree of positive development here. I still am unconvinced about whether or not any of this is really going to fix the business model, because right now it just has really, really bad price problems and lack of driver problems. I guess if the drivers feel more safe and that it's worth their time, then there will be a supply uptick of drivers, which could bring down prices. But that, at the end of the day, is what the business runs on. And the point at which those two lines are intersecting right now, supply of drivers and the prices of the rides, is not working.
That's a fantastic point, Oliver. So the bottom line for drivers or prospective drivers is just that. What's the trade-off? What's the overall balance here that I'm looking at in terms of this bill? And then I also wanted to mention, Oliver, that on the flip side of this more positive news, mostly positive news, would be the report of a class action lawsuit on the alleged illegal requirement of Uber Eats, Postmates, and Grubhub's no price competition clauses, which I know you'll resonate with this one. It barred participating restaurants from charging lower prices for dining in or ordering takeout, and also prevented restaurants from charging less to customers who were ordering on rival platforms. So U.S. District Judge in Manhattan, Lewis Kaplan, said, requiring restaurants to accept these no competition clauses left them with no choice but to raise prices, as the restaurants themselves were often charged a 30% commission on top of the 5 to 10% that was charged to the end user, the customer that was ordering that delivery service. So this suit seeks triple and other damages for dine-in and delivery customers in the United States, not just in the pandemic, but all the way back to April of 2016. So when we look at that aspect, that's another impediment. And Grubhub, Uber Eats, and DoorDash, they also sued to overturn a New York City law that capped the fees they charge restaurants. Right. And they're seeking similar things in San Francisco, because both cities have enacted measures that say you can't charge more than 15%. And these firms are saying, no, we can't do our business if that's the case.
This is, it's just, this companies always, all of these, they are like living on the edge of what is legally acceptable, what many would argue is reasonable and moral, blah, blah, blah. We don't have to get into that. There's a great debate to be had. I think the market, though, has been telling us that no matter how you spin it, it doesn't make sense right now. It's very problematic, not just because of COVID, by the way. Obviously, these delivery companies, in particular, Grubhub and DoorDash, had been really, really struggling for a while. So there's no big surprise, when we saw what happened with Grub in the public market. We watched all that. Dash, since its debut, down. So much of this really hinges on every little penny they can wring out from every part of the process for their business. So this Washington deal, I guess, being seen as right now incrementally positive for Uber, possibly the employees too. I guess we'll just watch the driver count. To me, that's going to be the most important metric going forward.
Not all the Teamsters unions have endorsed this bill. So it's not across the board that it's been accepted. But to your point, Oliver, on what do we call this? Ability of these firms to charge like they did right on the margin of is it legal or not. The judge used the term supra-competitive to really provide that more negative view that customers shouldn't be bearing the brunt of these more or less anti-competitive policies as he sees them.
All right, Uber and Lyft up this morning as a result. Mike, really good report. Very important story for these companies. Very important. Great work, Michael Keeley, with the explanation, joining us from Salt Lake with the news. Okay, let's trade some tech. Alan Nuttman joins us, Chief Market Strategist at BullseyeOption.com. Alan, how was your weekend? Did you get some rest?
Good weekend, but you're going to have to extend my time today because we did it for 2 weeks ago when it was bad enough to buy. Yeah. And the 25 call for July went from 7 to 12. So that illustrates this strategy. So a modest move in the stock, actually a pretty healthy move, produces big, big gains if you have the right in-the-money option.
Hey, what do you do with Uber now at $37, where after that bounce, it's right at a point at which I could draw a very simple line connecting all those lower highs. Do you want to bail here, Alan? What's the plan?
Sell too soon is part of the strategy. You sell half your positions when you have a 50% gain. 50% is nothing to complain about. And then you hold the other half positions and see if we can get 100%. So that's the strategy. That's the money management I use with these in-the-money options. And that's been successful for a long time here. Yeah, you leave money on the table. But to get back to your Uber, I'm older than you are. And remember when the banks first gave us a money card and they didn't charge us to use our money card, and then they decided to charge us $1 and then $3. It just became part of life. So that's what Uber did. They stuck their nose under the tent, and then they raised prices.
Yeah, and the market's caught wind of something, though, that doesn't make sense in this tent. Maybe maybe it's getting too crowded with other competitors, et cetera. All right, so you took off half the position for Uber after the bounce, according to your process.
Yeah, that's the way we trade this. So it's very mechanical. Trading is not about having fun. Making money is fun. So what you have to do is have your methodical plan in place. Trading is very straightforward, actually very boring. So it's a having that identify, execute, to manage the trade, and then try and maximize the trend. So that's what we try and do each and every time.
All right. I don't know about the trading boring part, Alan. Come on, you know where you are here. Okay, let's talk. I know you're being facetious. Let's talk some Micron as you are looking at the chip maker. After last week, we had a bit of selling right after their earnings. It was a short-lived earnings response to the upside, and then a really hard fade afterwards. That was last Wednesday. So what's going on here? You think that maybe they still got some life left in them?
Oh, yeah. Great numbers. And I'm going to say tech's not dead yet. Again, 15,000 is important to close above that from a psychological point. If you look at the S&P and the Dow, they're within 5%, 4 or 5% of the all-time top. So there's some value in tech. And value is in Micron. Micron here at 77.50 is about 20% off its January top. What's interesting here is it's down 15% in the last year of trade versus tech, the NDX is up 15%. So again, a little bit of a rubber band snapback is what I'm looking for. It's been trading between 70 and 100 for a year. So 85 is the midpoint magnet that you could see the market make a run to. And it's got some super support at that 70 level. I'm leaning on 70 and using my stock substitution strategy.
Okay. All right, I like it. So bullish on Micron, looking for a little bit of a bounce here. And stock's doing okay this morning, about 1% higher.
A June option has almost 3 months of time. It's only $100 more expensive than May. So I'm seeing some smart money buys. Last week was some profit taking after some beats on profit and on net income. And they also had some good comments for the future. So I think there's a lot there with good risk reward. And that's what's more difficult now after stocks have surged, is finding these stocks that have the good risk reward, and leaning on that 70 level is something I like as a trader. Trading is fun, but if you're having too much fun, that means that maybe you're getting a little bit too excited or too worried. So like I said, you want to have a straight face and treat this all about probability and money management.
Okay. All right, Mr. Duckman, trading and money management, managing your risks. I guess maybe that is boring at the end of the day, but if it makes you money, nah, just kidding. That's great stuff. All right, it's just poker, baby. All right, I'll manage your downside and eventually turns into upside. Thanks, Alan Duckman, Chief Market Strategist.
All right.
BullseyeOption.com. Okay, with the Uber trade too, as Alan mentioned, they put on a few weeks back, taking off some of that and putting some money into Micron, looking for a bounce from here. If Micron's going up, which it is this morning, NASDAQ's probably going up too, which it also is, about 1%. But Apple is sitting just below its record. Do we get the breakout there? Let's talk some more about what's happening and some other big stories we haven't hit yet. Our next guest has got a couple interesting things they're tracking. M&A as well, on top of some of the big macro stories from Apple's production cut. Market right now is mixed. Small caps are down, but big caps and the mega companies are doing okay.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim by TD Ameritrade.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade network.
Welcome back. Let's talk some more big stories moving markets. We've hit the major CEO announcements this morning as Elon takes a stake in Twitter. Howard Schultz cuts the buyback. Let's see what's on the mind of Marino Marin, managing principal at MC Squared Capital. Marino, I see that your attention right now is focused on a couple of various topics. One is some sleeper M&A that hasn't gotten enough attention in this market, but the other is Apple. So introduce yourself. Tell us about your strategy at MC Square and what your main focus is right now.
Hey, Oliver, good to be with you. We are a co-investment platform. We look at mostly private equity type transactions, so we stay away from the public market. And our strategy is around investing alongside financial sponsors in private equity deals. So we look very closely at the M&A market and what are the opportunities out there for us in the private market.
There's a lot of public companies that have been struggling and taking a private equity route. Should we expect to hear more from your ilk as public traders? Are you going to be taking our public companies away from us, Marino?
Absolutely, yes. I mean, we've been seeing this quite a bit over the last few months. Public companies, which apparently lagged strategy according to some activist investors, have been forced into M&A transactions. Look at Kohl's, for example. Over the last few months, several activists have protested lack of focus and other things around the management. And as a result, you've seen M&A deals being triggered by that. And Kohl is a premier example of that.
There are always private equity deals and takeouts happening for companies struggling, but there's also, I would imagine, potential for the volume of those deals to really pick up broadly when markets come off of very frothy valuations. I mean, we're seeing a lot of businesses in the tech space even whose products and services were super popular the last couple of years, but they still can't make money. So, I mean, a lot of folks know that a stock like Kohl's has problems, but what about, I mean, some of these tech trades? Do you think some of these small companies that have one or two trick services maybe do better in private markets than public markets?
Well, it's very interesting what you say. You're absolutely right. Technology is one of the sectors that, to some extent, has been less battered over the last quarter. As you know, M&A volumes are down. Technology is still up. And you've been seeing a lot of private equity guys circling around not only private technology, privately owned technology company, but also potential take private. So this is something that we are looking at quite closely. And for us, it's always a strategy to couple with other sponsors. And we've been seeing this quite a bit now. So technology is certainly a space that has captured our attention at this point. And you're right, some of these plays could be worth more in the private market, particularly if they are subject to some level of need for reorganization. So those transactions, those opportunities are out there. So even in the middle market, you're seeing very interesting opportunities.
We're looking at some of your thoughts here on the consumer in particular, as that creates some opportunity at a place like Kohl's where there's been a need for change. What else do you see in your line of work that points to a potential fractures and maybe the consumer strength over the last couple of years?
Well, look, the consumer has been experiencing a lot of strength over the last couple of years. Now, we're coming back to reality. For one, for example, the savings are at the pre-pandemic level, which means that whatever the consumer was able to accumulate during the pandemic, now it's being spent. That's number one. You're seeing, obviously, high energy prices, inflation, rising interest rate that affect directly the consumer and their spending ability, because now your mortgage bill is higher, your gas at the gas station is higher, and your credit card is higher. So as a result, we're not seeing yet, frankly, reasons for a strong concern, but obviously the sentiment is not where it used to be a few months ago, and that's going to percolate on the consumer sector for sure.
Apple's cuts fit into this. If Apple is having trouble identifying their market, the SE in particular, it seems like they were pretty intent on finding another small niche to add on to their already huge business with a cheaper phone. But I guess it doesn't make sense with inflation prices. If Apple can't do it, then I guess that kind of brings us back to the subject of what else might potentially suffer in this economic regime.
Look, there's no question about it. We have high inflation. There's a big disruption in the energy market. The supply chain is still not where it used to be. And we have a war going on. And clearly a global company like Apple, which doesn't serve just the United States, but is a global play, has to think about that. And so their concerns are somehow grounded, and we think that their approach is absolutely correct. Their cautiousness is absolutely correct.
If there's this uncertainty in this market, Marino, do you think a company like a Kohl's it can get a good price? Right now we're sitting near the 52-week highs in the stock price. Is this a type of company that could get a buyout? I mean, if I hold Kohl's as a public stock and there's these constant potential rumors, do you think this is the type of thing I want to hold on to until the fruition of the deal? Are they going to get a good price?
Well, look, let's talk about numbers. Goldman is running a process. It's a very robust process. Over 20 interested parties appeared during this process. You have a couple of very large players that have synergies and that can actually, increase the value of the company after it goes private. For sure, that will create value if, in fact, for the shareholders, all the shareholders, if the process is brought to fruition at the end. And so, we will know more in May. In May, there will be a meeting where they will announce whether or not they're going to move towards a sale. But seems to be a very interesting story for retail shareholders at this point.
Okay, Marino, great conversation, an interesting one that focuses our attention on some important M&A stories. Thanks a lot for being here.
Thank you, Oliver. Good to be with you.
You got it. Marino Marin is managing principal at MC Square Capital with a message on potential consumer weakness, but an opportunity for companies that could be run a little better, perhaps. The Chart Master comes to us when we return, taking a look at NEO, Crocs, and then Caroline's going to give us an update too, as we still have some more to discuss here. Diagnostics, another one that we'll be looking at, Quest Diagnostics from Ben coming up.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Welcome back to Morning Trade Live. A lot of stock news continuing to hit this morning. Let's talk about Ford with Caroline Woods joining us in New York. Not any good news here for Ford this morning, Caroline, but the stocks barely even changed, just a little bit down.
Yeah, well, actually, it's picking up a little bit of steam, down about 0.8% now. Was down, only about 0.2 just a few minutes ago. But a few different headlines here. First up, we got March and Q1 sales. Q1 sales fell 17% to just over 432,000 vehicles. It's actually in line with analysts' expectations. Sales of Ford trucks, including the popular F-150, were off 23% during the first quarter. Cars were down 49%. Meanwhile, SUVs were off just 5.1%. In terms of March sales, those fell 25.6% to about 159,000 vehicles in March. Of course, hindered by low inventory issues from the semiconductor shortage. I will say, though, that Ford says there are signs that the inventory situation is improving, noting that the number of vehicles being shipped to stores rose 74% in March versus February. Meanwhile, in terms of other headlines, more on the negative end, Ford is recalling 737,000 vehicles in the U.S. over software and some fire risk issues. 345,000 of those are Ford Escapes and Ford Bronco Sports, more recent ones from 2020 to 2022 because of potential oil leaks that could lead to fires. Then another 400,000 including F-150s, Navigators, Expeditions. They're being recalled because of concern about a tow trailer that could fail to brake properly, so some safety issues there. But, shares down now at about 0.9%, so still under 1%, despite what you could say are sort of negative headlines. Although I will say those Q1 sales are in line with expectations, despite the big drop year over year.
Okay, so the market expected that. And SUVs, the big seller, little changed, 5% compared to the 24% elsewhere. So I guess at least we kind of know that the pace of vehicle sales was not going to be able to keep up over the last year. But it's still, the recall not doing anything positive for the stock as its peers are higher this morning. Okay, thanks, Caroline. Good stuff. Good one to keep on our radar here. Ford down as the other cars are up. GM doing okay this morning. Let's talk NIO with Ben Watson, the chart master, who's got 2 downgrades and 1 upgrade for us. And the upgrade is on NIO, Ben. So how are we looking here? Yep. Any progress being made in this Chinese electric vehicle stock that has been in a long-term decline?
It has been in a long-term decline, and perhaps that is changing at the moment, starting to see perhaps a bit of a shift, if you will, from that long-term downtrend into this intermediate-term upward movement. In fact, Oliver, really starting to build a bit of an inverted head and shoulders type of pattern here. Now, it's not quite there yet, that neckline up around the 26 mark. And despite the fact that we got a little bit of a gap up into what was a rally early, that's fading a little bit here. It's got to make its way back up to that 26 in order to really fulfill the possibility of this inverted head and shoulders, which could take it up to the pattern target up around the 35 mark. That's a ways away. If it bounces down or breaks down from here, you've got that 19.5 right-hand shoulder, and then below that, you get down into about the $11 mark, which was the bottom of that kind of inverted head, if you will, that part of the pattern. But long-term sentiment definitely starting to rise. It's coming up out of oversold. Intermediate-term sentiment has been diverging bearishly, so maybe that's a bit of the drag here against this upward movement. But it is an upgrade, and there was a little bit of a gap-up movement here.
So for NIO, putting in that inverse head and shoulders, I mean, that's a pretty clear one there. Sometimes I get a little suspicious when the patterns are so clear. But hey, those are the ones that people can see that then if they do follow the expectations can bring on quite a bit of momentum if we do break out. So at what point does the rally become a breakout, Ben?
If it breaks above the 26 mark, that 26 really kind of becomes the neckline of that pattern. And that's kind of been a support level before. And you saw that little bit of a gap down to that 26. So that kind of becomes that area. 26 to about 27.5 becomes the kind of Rubicon for this to cross.
All right. So we still need to get another couple big rallies here. I mean, 6% this morning is definitely a start, but because of the swings of this stock, it doesn't really look like too much on the chart. Long-term sentiment, though, Ben, looks pretty good here, finally bottoming and maybe turning. It's just the short-term sentiment maybe suggesting it happened too fast, that we shouldn't be impatient if we're going to be bullish on this.
Yeah, for sure. And bulls apparently have been patient, you know, now perhaps being rewarded for that patience as this makes that slightly higher. And to be fair, it has made a higher low on the right-hand side of this pattern. It just hasn't broken above the pattern kind of line of demarcation here.
A pretty weird, interesting note out where UBS says to buy the stock because of the drop. It's now a reasonable thing to own. However, the price target, they're shaving off a little bit. I mean, given that we're talking two-handle here on the chart, their $32 price target would get us above that potential resistance, but they had it at above $40, their expectations for the stock. So, I mean, that's a pretty big cut to their target there, I think, for sure. So even though they upgrade it and say it's a buy, they are trimming some of the expectations a little bit. $32 is where they think it's going to go. According to your analysis, though, if we go to $32, then you know, maybe we are putting in some potential for a further bounce on confirmation of this inverse head and shoulders. Nice. All right, cool. Crocs and Quest Diagnostics, Ben, two very different companies, both with downgrades this morning. Let's talk Crocs first. What do you see here? Does the chart have holes in it, Ben?
Yeah, well, the shoes certainly do, but not all of them. They're getting out of some of those hole-based shoes. But look, intermediate to long downtrend that's turning perhaps into a bit of a sideways trend. And you know, sideways trends can result in reversals. I mean, this is how reversals are built. The stock's got to go sideways first before it bounces and moves higher. So it's oscillating in this range between 68 and 85. A little bit of a gap down rally today on a downgrade. Price target cut down to 80, which is just about where the price of the stock was, about 5 points off of where the price of the stock is in the middle of this range. The potential is here for a bounce back up to that 85. If it gets out of 85, up to perhaps 94, where there's another level of resistance, the breakdown could come back down to that 68 level. Long-term sentiment rising slightly. It's down in the oversold range, just kind of oscillated along. But boy, intermediate-term sentiment diverged bearishly, dove into oversold. It's converging with long-term sentiment. So, you know, this has a ways to go to really kind of reverse itself, if you will. But breaking out of this 85 range, that becomes kind of the critical key here. And with that longer-term sentiment kind of staying down and oversold, intermediate-term sentiment diverging bearishly, it may be tough for this price to break above that 85 mark.
Okay. Kind of similar vibe in a way, but one that hasn't put in, I mean, similar to Neo, just the long-term downtrend, and then this sideways action for Crocs that is not showing the same kind of multi-pronged bullish bounce potential that Neo had, where there was some pretty clear pushback where bulls found the price to be too cheap. In this case, it seems bulls and bears have rather agreed for about a month and a half running here that this thing belongs within a 20-point range.
Yeah, absolutely. And I'll tell you what, this is such a shift from last year's perspective of just that solid, consistent uptrend to go into this downtrend and now just kind of languish sideways. Maybe they're just, relaxing in their Crocs for a little while.
Nice, okay. All right, so Loop Capital downgrades Crocs, and it's not an easy thing to do because this stock was a great stock. They still say it's worth $80. Pre-COVID, the COVID high for Crocs was around 40. So they're saying it's worth double what it was pre-COVID, but it went from 40 to 180. Well, it went from 40 to 8. It went from 40. It's just pretty crazy stuff. All right, so look, hey, everybody has their own taste. People like Crocs, but basically the market said, all right, we're in a pandemic, economy's collapsing. How could Crocs possibly be a good thing to a stock to own? Surely this will not be people's priority. But then, so that sent the stock down to $8. Then it turns out that Crocs were actually the perfect shoe for us to walk out and get our mail with, and then walk back inside and not be seen by anybody for the next 2 years. So then Crocs went to $180. Now that we have to be seen, maybe Crocs, Maybe not so much.
Not so much. But I'll tell you what, Oliver, look, you ditched your skinny jeans and went with the kind of looser fit. And maybe people are still, still enjoying those looser fit Crocs. I don't know if you are, but.
Hey, I know that Andy Swan, our friends, the Swan Bros at Like Folio are big Crocs fans.
Oh, for sure.
But I think even they've recognized that some of the consumer appetite maybe is going to be hard to live up to there. I don't know their data. Okay. I seem to recall hearing something about that. I could be very wrong. All right. Quest Diagnostics, Ben Watson downgraded Citi DGX. I've been hearing a lot about how medical supplies, devices, and services should be a great thing to own over the next year. Seems to make sense to me. Shares are down 1.5%, though, as Citi downgrades them, saying no longer a buy. I don't really get it because the stock is exactly where it was almost a year ago. It's had a lot of ups and downs, but now to say it's no longer a buy, they cut it to neutral ahead of their earnings. I don't know, interesting timing from this analyst.
Yeah, for sure. Look, that 125 level has been kind of the launch pad here for Quest Diagnostics 2 or 3 times, right? Bounce up, rally up, pull back, rally up, pull back. We had that double top up around that 175, 180 range back towards the beginning of the year. And then it pulls back in, bounces up off the 125 again. Double tops here at 145, 146, starts to move down. We get a little bit of a gap down into what's now become a spinning top on this downgrade. And so seeing a pretty fast move to the downside, although that's not unusual for this stock, may find a bit of support here right around that 130, 132 level. We're sitting at 134 right now. If it pulls back, could pull back down to that 125 half, which has been a support. Long-term sentiment is reversing lower, though, once again, down and oversold. Intermediate-term sentiment, though, reversing back higher. Possible bullish cluster if the stock can find some support here right around this 120, right around this 132, 133 level. If you can find some support, bounce back up to that 146 double top.
All right. Quest Diagnostics in need of something to change its course right now, as it seems like it's getting pulled lower and analysts jumping ship down 1.5%. Maybe this next earnings report will be interesting. Okay, I mean, look, clearly the company benefited from a lot of testing from COVID, so I guess post-COVID world, maybe it doesn't have the same tailwinds. We got to jump in. Thank you very much, sir. We're over time. We got to bounce. Nice charts. Market meetup time when we come back. Also, headline that President Biden is calling on Putin to go on trial for war crimes over Russia's actions in Ukraine. Interesting update to that situation, perhaps expected based on what we've heard, but also the type of thing that seemingly will get some pushback. Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on thinkorswim for the income investing course and a whole lot more.
Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. A sharp move higher to begin the week in the NASDAQ, led by Pinduoduo, Alibaba, and JD.com. Tech is leading today, up over 1%, back above 15,000. Tesla is making headlines this morning after reporting sales and production data, and Twitter's getting a lift, spiking on news that Elon Musk took a 9% stake in the company. The move up adds to the rally off the March lows, but small caps, the broader base Russell representation of 2,000 plus stocks, seems somewhat reluctant to participate, still holding below the 200-day moving average and still negative on the day. The Russell's down by about 1/3%. The Dow's also lower, holding below 35,000. The ES is struggling to get back above 4,600. All a pretty good sign of, while we've managed to shrug off some of the geopolitical concerns from the beginning of March, the underlying headwind, which has been rates on the rise since the beginning of the year, remains. Keep an eye on rates this week. The flattening of the yield curve and the 2-10 spread, which recently inverted. It sparked a hearty recession debate, and while yields have come off recent highs, the TNX is holding around 2.4, the TYX just shy of 2.5, and, well, they remain relatively elevated and suggest market participants still feel the Fed's going to be forced to act a bit more aggressively than initially expected. This week, we'll hear from a handful of Fed speakers, and we'll get a look at the Fed minutes from March. They're due out Wednesday. This has been your TD Ameritrade Network Futures Market Update, and now back to Morning Trade Live with Oliver Rennick.
Welcome back to Morning Trade Live. Let's get a few more thoughts in here before we close out the show. Scott, Connor, and Kevin Hanks are with me to talk about some of the morning action here. Kev, so we started off with stock-specific stories, Twitter and Starbucks. We got an update on Ford with the recall from Caroline. But at the end of the day, or rather at the end of the morning here, the show, NASDAQ's doing just fine, up over 1%. What do you think? Hey, yep. Okay, I think might have trouble hearing us. Okay. Hey, Mr. Scott, Connor, let's talk, sir. NASDAQ's up 1.5%. What are you looking at this morning?
Story. You mentioned some of the names of the stocks that are in the news this morning. Twitter, of course, being one of them, and the stock up significantly. I'm looking right now, Twitter up 24%. Remember, this was a $73 stock not too long ago, got down to the mid-30s the last 3 or 4 weeks. Now it's almost back to 50. So I think what's happening here is it's renewed sort of an enthusiasm for the FANG stocks, if you will. Remember, we used to always see the heat map, Oliver, on the
look at Meta
platform, and it would be bright green on the left and then kind of fade. Well, we're seeing that again. So I'm almost wondering if this isn't sort of renewed sort of interest in the FANG stock group in general, because we're certainly seeing that across the board. And you have other, I think, names like Meta Platforms, parent of Facebook, kind of going along. That stock is up almost 3.5% as well. So I think just overall, it's kind of reminiscent of the way the markets used to move, before Ukraine. So I think it's pretty interesting. Let's see how long this plays out. I think that's what's interesting here. Obviously Twitter's made a huge move. Is it justified? Well, let's see. I mean, the market's going to have to figure that out.
Tesla's doing okay, even with the distracted CEO, it seems like, up 3.5%. Tesla close here would be a recent new high, the highest basically since the first week of the year. So I'm with you where this is a pretty notable move in the big caps. Apple's up 1 3/4. Apple's near 180. So, I mean, $5 move, and we're at a new record for Apple. There's something in the water when Facebook Meta is up 3%, Kev, because that thing doesn't move unless there is real news. We are just now making an effort to get back to that gap down sell-off from their February earnings. So if Facebook's on the move, I guess there's something going on here this morning.
Well, I'll tell you, once, Elon Musk, what he's done this morning above the obvious move in Twitter, he's put a jolt of energy back into social media. Let's face it, Oliver. And now people are starting to think, boy, a lot of these social media names that have had no energy in the last several months, now they're back in the focus of everyone again. And I think what's happening in Twitter is spilling over into some of these other names. So yeah, social media companies are something I should watch. Remember, I mean, if you look at a chart of Facebook, it is significantly lower from where it was on some news that should maybe have weakened the stock, maybe not as much as it did. But Twitter, you know, before Elon Musk clearly started buying it last week, and he bought 73 million shares, that stock was down in the low 30s and basically ignored by the rest of the street. So I think the overall energy level in these social media stocks has returned, and it's spread into some of the other FANG stocks and NASDAQ stocks like Scott was just mentioning. So yeah, I think it's a new level of energy in a bunch of that left side of the heat map that was kind of struggling lately, trying to find some levels of energy, Oliver.
Yeah. I'm kind of surprised at how this story is able to ignite this type of buying. But whatever it may be, price action is price action. And the NASDAQ having one of its biggest days here, despite the Russell being down. To your point, Scott, that does make us reminisce a little bit about those days where the two used to be split apart. That would be pretty interesting if that could happen again. But right now, we'll see. It's too early to tell. Thanks, gentlemen. Some good context for us. Scott Connor and Kevin Hanks with a little update for our into the show here. Trading 360 with Nicole Petalides is coming up next. I'm Oliver Rennick. Thank you for joining. I'll see you this afternoon. Market on close, 2 p.m. We got a great show this afternoon. We've got Mark Faber joining us from the Doom, Gloom, and Boom Report. And we've got Anthony Scaramucci. Great show this afternoon. Don't miss it.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
90 minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Monday morning. We are 90 minutes into the trading day. Welcome to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. Thanks so much for being with us. Take a quick look at the markets. You could see somewhat of a mixed bag today, 2 up, 2 down. But for the 1 month tally, we've done great over the last 4 weeks. So here's a look. The Dow is down 38 points at 34,780. The S&P up 14 points at 4560. The NASDAQ up 197 points. That's gaining 1.33% as tech is doing well today, 15,058. And the Russell is down 4 at 2087. Now to some of the biggest stock movers in the market. Watching shares of Twitter soaring this morning after an SEC filing shows Elon Musk has taken a 9.2% passive stake in the social media platform. Musk is now the largest shareholder outside the company. The buy comes after Musk polled his Twitter followers about whether the platform adheres to free speech principles. He had also mentioned that he was considering launching his own social media platform. As for Tesla, it reported a record number of deliveries in the first quarter, but that number came in below the Wall Street analysts. So Tesla delivered over 310,000 cars in the first 3 months of 2022. That is up over 67% year over year. Wall Street expected 317,000 vehicles. Starbucks announced it's suspending its share buyback program to invest in its future growth. The move comes on Howard Schultz's very first day back in his CEO role. He's interim CEO. The coffee chain had previously committed to spending $20 billion on buybacks and dividends. And JP Morgan's CEO Jamie Dimon said in a letter to investors that the bank could face a potential loss of up to $1 billion due to its exposure to Russian investments. Wells Fargo cut its price target on that stock to $150, down from $180. Take a look at the top futures products. You can see Bitcoin at 46,070, losing 1%. Dollar, a little bit of strength, 98.82. Gold futures, 19.38 a troy ounce, up 0.75%. Crude oil, 102.83 the barrel, up 3.5%. And the VIX at 21.70 as we speak. Get some insights in the news shaping the markets, and for that we welcome in Kevin Gordon, Senior Investment Research Manager at Charles Schwab. Kevin, good morning. Thanks so much for being with us. I like looking at the 1 month chart. It makes me feel great to see the Dow is up 3.5%, the NASDAQ's up 8.5%, and the S&P and Russell too. So over the 4 weeks, you say, oh, look at that. But you're a little skeptical of the recent rally. Explain why.
And it still even looks good if you zoom out a few months before that. You can see the pretty big drop that we've had, not just for the S&P 500, but you can extend it out to the NASDAQ or the Russell 2000, and you can see that a lot of those indices have regained a pretty significant portion of their drop. But our concern has been when we look back at just the past month, or since the troughs in those major indexes and those benchmarks, the leadership has been, number one, narrow, and number two, just very concentrated in some of the low quality speculative segments of the market. And I think from our perspective, what we really want to see is a broadening out, not just in the sense of the number of stocks that are advancing, but who is leading the rally higher. And that hasn't been high quality. And in an era of, multiple headwinds, starting with maybe the Fed moving from accommodative policy into a tighter monetary policy environment, what's going on with Russia, Ukraine, and then the commodity energy crisis that comes from that, and just the fact that we're in now a time of slowing economic growth, at least for the first quarter, you don't want to be seeing that low quality leadership. That is not the time for the baton to be passed to those groups. So we want to see a broadening out. And because that, the rally's been led by those areas and traditionally defensive areas, if you're looking at it on a sector basis, like utilities, REITs, to some extent healthcare, and then consumer staples, that's not indicative of something that, a rally that has legs and that broadens out. So that's just where we would point to for some inconsistencies in leadership.
I understand fully. And, something that made me a little bit nervous this morning was, when you hear about Jamie Dimon talking about the potential losses and the exposure to Russia and saying that it could potentially be a loss of $1 billion. And my worry is that this is what we're going to hear all week long, that all the banks ahead of earnings season, which begins next week, that they'll all start sort of putting out these numbers. I mean, $1 billion doesn't sound like a little.
Well, it's exposure to Russia, but it's also, I think, just from a loss perspective, we're going to have to start dealing with losses that are now dealing with as it pertains to the U.S. consumer and any degree of demand destruction. And a lot of that does emanate from what's going on with Russia, Ukraine, and the commodity crisis that we're seeing. So more shortages and just a disruption in supply in the supply chain is probably, at least in the near term, going to contribute to headline inflation, because that's where energy and food prices are factored in. But, as we're entering the next earnings season, we're going to be keeping a really close eye on what companies are saying with respect to margins. And if there is starting to be pressure there, because there can only be so long that consumers can actually stomach the higher costs and that companies can benefit from the pricing power. And it has to be really nuanced there, because there have been companies, especially within areas like tech and some of the growthier parts of the market, that have been able to pass on higher costs. But, in the aggregate sense, we have to start paying attention to the fact that, real incomes have contracted for 7 months now. The savings rate has collapsed. There's just not as much of a cushion in the face of higher inflation where consumers are able to stomach the higher costs. And that's probably going to start showing up, probably in short order. If it's not the first quarter, definitely the second, then into the third quarter. But as it pertains to losses that you were saying, I mean, the direct hit to the U.S. from Russia is probably not as big. And I think, some of those will be spread out over a couple of years, but we have to factor in the global perspective too. And that's where you start to get, it starts to get a little murkier.
Yeah, and without a doubt, the consumer is facing higher prices at the gasoline pump, at the supermarket, across the board. Anything that they're purchasing, they have supply chain issues. And, if you go to a restaurant, if you get in a taxi, there's all these new fees. And so there's a lot going on that the consumer has to stomach at this point. Another area that consumer is faced with and that is of concern to you is what's going on in the housing sector. Is there good news and bad news, or is it a lot of bad news?
Well, I think there's more bad news now starting to outweigh the good news, unfortunately. And if you want to call it good news, coming out of the initial phase of the depths of the pandemic, was that from an affordability perspective, the main constraint started really on the maybe down payment side or the initial affordability side, where you had all cash deals and bidding wars going on, and that pushed a lot of buyers out of the market because they just simply couldn't afford the initial pay up for the house that you had to go into. But now we're facing it from the actually the monthly cash flow perspective, with mortgage rates rising. If you just look at the change in mortgage rates over the past year, it's the largest one-year change we've seen since the early 2000s. So that's now putting a constraint on affordability for people who have already gotten into homes, in the face of higher inflation in the other areas that we were just mentioning. So with that, home price to income ratios are, depending on which measure you look at it, in aggregate sense, in some higher than what we saw during the financial crisis in the 2005-2006 run up to the subprime bubble. And then, you look on a monthly basis, it's starting to go up for people who already own homes. So that, in conjunction with higher energy prices, is starting to cause a shift in consumption and a shift in how consumers are expecting their consumption to change over the next 6 months or even over the next year. So that puts downward pressure on other areas like goods and services. And the rub with the goods part is that we've already seen downward pressure. So that's just going to accelerate pent-down demand that we've been expecting and seeing in that sector. And then it's also going to, potentially put a little bit of a weight on, a downward pressure on services consumption and services demand, which was expected to sort of lift us and lift the economy out of, the slump that we've been in. But now that's not as guaranteed, at least in the near term.
And later in the show, we're going to be talking about gaming and casinos and leisure and hospitality. And I really start to wonder what the consumer, there's been a lot of pent-up demand, what we hear, right, for retail, for traveling, for, what the consumer may or may not do. In the meantime, today, communication services, technology, consumer discretionary lead the way, while we're seeing consumer staples, healthcare, industrials, and utilities to the downside. Any final thoughts here on the market and what investors could be thinking about here?
Well, I would caveat to the sector leadership point that you were making. A lot of the larger names within those sectors. So if you want to broaden it to, think about it as the Big Five or the Super Seven, they've been called. However you want to characterize it. The largest names within the S&P 500 of the market have been driving, been responsible for a pretty considerable portion of the gains that we've seen over the past month. That's pretty consistent with what we saw off of what feels like a long time ago now, the March 2020 low in the pandemic. And the difference now is that there's not as much of a justification because we're not only living in those spheres that those companies represent. We're now much more open as an economy. We don't have as many restrictions. And we're sort of hopefully behind hopefully the worst phase of the pandemic is behind us. So that's I think maybe a mark on the leadership that we don't want to see with just a few companies driving those sectors or the broader index higher. Because if you go down the cap spectrum, that just isn't the case. You need to see more participation there.
Okay. Kevin Gordon, nice to see you on this Monday. A great setup. We really appreciate it. Thank you. Kevin Gordon of Charles Schwab. Thanks for being here. Plenty more to come right here on Trading 360. Bread Financial is in the 360 spotlight after the company completed its rebranding. The president and CEO joins me live here at the New York Stock Exchange. BFH is the ticker symbol, so we'll have much to discuss. Tai Young from Tai Young Wealth Management will join us with some ideas for investors. The markets deal with inflation and rising rates. And as I mentioned, on outlook for the gaming stocks in our 360 round, where one of our guests really sees some real upside potential, maybe 100% upside potential. Up next, though, the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein goes through the technicals. Mike Shore from Prosper Trading Academy takes us through the trades for Zoom Info Technologies, Leafly Holdings, and Nike. Next here on Trading 360.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position?
You two are all set.
Choose the app that fits your investing style.
Welcome back to Trading 360. I'm Nicole Petalides, live in New York City, live at the New York Stock Exchange. Thanks for being with us. It's time for the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein will take us through the charts. Here to take us through the trades, Mike Shore. Director of Trading Education at Prosper Trading Academy. Thank you both for being with us on this Monday. So Zoom Info Technologies, Mike, is your very first trade here. You said this is in the world of cloud. The bullish breakout potential, tell us about that, Mike.
So we're looking at Zoom Info, kind of like CRM, not exactly the same sort of company, but what we're seeing is that break through the 200, which is pretty much coincident with the recent highs. It's actually holding that level right now. So any entry in here, I think, is a great play. I love everything cloud-based. That's been definitely one of the strongest sectors, maybe not the strongest sector. Energy's been the strongest. But
okay, so Yeah, no, I didn't mean to jump on you, Ben. So he likes what he's seeing in overall in cloud. Zoom Info, is something that he's looking at here for this bullish breakout. So tell me more, Ben, when you take a look at this chart.
Mike, Nicole, good morning. Guys, it looks a lot like what we've seen in terms of the broader market. Nice move up off the March lows back to a critical area right now. And let's just dive into the 30-minute time frame so you can see, as mentioned here, this was actually the Feb low. So you can see how the March lows were unable to take out that 45 from the, we'll call it the end of February. But again, just wanted to point out the run up 45 all the way up to 61 and no rejection of these upper levels here. We're holding this level right now, but much like the broader market at a critical juncture at this point. Now, I want to point out here again, no rejection as of this point, but take a look at the daily because what we're looking at here is the move off the Feb lows. If you can see, we actually have a January low to keep an eye on as well. So this is the Feb low that we just looked at, but there was another Jan low just below 45. That was all the way down at 42.65. So if we were even to take out the March to Feb lows, you have this lower extreme to keep an eye on here, which is quite a bit below. Now, I just want to point out we're back up above the 50-day moving average. This is the blue line, trying to contend with the 200-day moving average right now, testing it. But look at RSI, guys. It has a little bit of room to go to the upside here. Volume, somewhat lackluster, typical of a bear rally, I would think. And again, as mentioned here, much like the broader market here. Now you can see how ZI testing a key area, testing those Feb highs right now. The broader market recently rifling up and through those Feb highs, seeing some follow through. You mentioned the NASDAQ at the top of the show here, Nicole, or at the top of the segments rallying and leading the way to the upside. I wanted to take a step back and, again, point out the 200-day moving average. I think that's the next hurdle to get up above. But take a look at the weekly time frame. And you can see some of the high conviction trade off the all-time high we saw up at 79.17. And I like to think of this as kind of like price stepping into an elevator shaft. It just fell off for 2 weeks straight. And then we saw a very similar pattern play out here again in the end of December, beginning of January. So that's what we're trying to claw our way back above right now. Again, you can see that high conviction to the downside. And if we do roll over here, if we do fail at this critical juncture, I'd be talking about 52.50. If we were to open up a door, see some energy below that, we'd potentially retest that 42.50 level. But you can see a series of lower highs right now. That's why I say I think it's important right now that we continue this trajectory to the upside instead of rolling over. The bulls want to see this one up and through the $62.50, $65 level, and then, again, taking out some of these key hurdles that were made on the way down from 79.
I think it's important that you're showing those lows from January, from February, and some concerns. The big picture on the rally is people aren't really feeling 100% that it's led by quality and has that conviction. So, Mike, is yours more of a short-term trade or long-term trade? Tell us more.
Yeah, I definitely deal more in the short-term trade. And by short-term, I'm talking probably in the neighborhood of 10 to 15 days of holding time. So this is not a buy and hold. This is a breakout scenario for sure. And I mean, I guess kind of the good thing about that is that if you're wrong, you'll know pretty darn quickly if we can't hold that 200-day, and then you just exit it for a minimal loss.
Exit it for a minimal loss. And that's why these trades are so important as you really give us all the details on these trades. Ben, what do you think?
Well, I think it's important. Let's keep a close eye on the broader market here. Again, as mentioned, the NASDAQ, the ES, the Dow, and the Russell for that matter, not as much small caps, but the other three majors and many of these individual names that we look at a critical level right now, where if the bulls can continue to exhibit some of the enthusiasm we've seen off the March lows, we'll see some follow through at this point. But if not, Nicole, we've seen this before. These bear market rallies fail to really see follow-through directional conviction to the upside. You get a little bit short covering or some bottom picking, but again, that's not really initiative in terms of buying where investors see value at higher levels. That's what drives price higher with follow-through and again, conviction to the upside. And we're not seeing that since the beginning of January, basically. So I think we're at a critical point right now, somewhat of a pivotal area here for not only this name, ZI specifically, but many of the names that we're looking at here on 360, as well as the broader market in general.
Right. So, that's interesting, right? As you see, there are some worries, but the big picture here is that Mike does truly believe in this, at least in a near-term bullish breakout. So we'll watch for that. Mike, thank you for that. How about we move on to the world of cannabis? A different picture here for Leafly. Mike.
Yeah. So, last week, cannabis was in a lot of the news stories and everything like that with the MORE Act being voted on in the House. Probably going to be dead in the Senate, but what we're seeing is a general momentum towards some sort of decriminalization / legalization on a federal level. You got a lot of these stocks are just really, really low, and so just as maybe a bit of a more longer term type of play, but still any sort of pullback in anything like this, in any of your quality ones. I'm not talking about going and buying some penny stock. If you want to do that, that's a lottery ticket. But this is a newly IPO'd in the last few months. And I like it in the fact that it's not one company. Think of it as kind of almost like a Yelp or a Google for cannabis shoppers, where it points you towards things that are in your neighborhood. So you're not dependent on any state sort of or local jurisdiction issues tied to one company or region or anything like that. It's all over the place and not specific to one company.
Right, and I think you're making a good point about the regulation and the news there too. Is it really does seem that they're moving forward to decriminalize cannabis overall, right? And because not just for medicinal, but for some recreational use as well. Ben, your thoughts here on Leafly?
It sure seems like they're leaning in that direction, but again, this has been a prolonged process, and there's still nothing definitive in terms of actually when that will happen. Now, I'd be more in the camp in terms of arguing that it's more a matter of when, not so much if, but it's still yet to happen. So again, a lot of these stocks that have seen benefits from the anticipation thereof have really yet to see follow through. And even if we do get it, then ultimately, again, it really comes down to the bottom line. Do these stocks actually benefit from federal legalization, and does it increase demand ultimately? I mean, here, let's just break down what we've seen recently here. I've got the 30-minute time frame up. You can see, as Mike mentioned here, not a lot of time here to take a look at in terms of this stock is relatively new since the IPO. You can see the move down to 527 initially, back up to 1158, and Nicole, Mike, how we're kind of just basically in the middle of the range right now. So again, you have a well-defined lower extreme and an upper extreme, and we're just kind of holding right in the middle of that range. Now, take a look at the daily time frame with me, and I actually sped up the RSI on this one. Normally a 14-day, this is a 7-day now. So you can see up into the 1158 level, we did get a little bit overextended into that area, and you can see the spike here. Notice how when we did get to 1158, we actually posted a lower high in the RSI. So now we're kind of back in the middle of the range, feeding into what we've seen in terms of price activity. And then lastly, I just wanted to take a look at, normally I jump into the weekly time frame in this instance though, but again, not a lot of data here. So you can see we always talk about these bell curves, basically the way I like to think of price or balance of price. You have that really well-defined upper extreme, or in this case, we're talking about a sell tail, the lower extreme here, a buy tail down to 527. And then again, as mentioned, when we were looking at the more intraday time frame, you can see how we're basically in the middle of the range. So you've got well-defined extremes here, just not a lot of directional conviction, partially just based on the fact that this is relatively newly traded stock. So something to watch here, though. Again, I love having the well-defined upper and lower extremes because it gives you the gauge in terms of the next leg of directional conviction. You would think, again, if we were to get some sort of federal legalization, that 1158 would be the next level that they would try and get up above. But then lastly, I want to point out, not as big of a deal to actually get up above or down below a key level, levels well defined like this. You want to see follow through. Again, we talk about energy, directional conviction, and then ultimately the bulls, if we were to get above 1158, they want to see a new area of consolidation, that kind of overlapping and rotational price activity to help you determine that value's been established at a new upper level. But as of right now, we've got value kind of hovering around this $8, $9 level with, again, a lower extreme at 5 and an upper extreme around 11.
Right. You know, I'm glad you talked about that. And what do you think, Mike, as we take their final look there at Leafly, and then we'll go to Nike?
Yeah, definitely. This is a lot different than Zoom. I'm not looking for any sort of breakout scenario. This is more kind of like the market itself is more of a consolidation or an accumulation sort of phase here. That's why I'm not saying, hey, wait, and then if it trades here, let's go higher. This is, if it comes back to us, great. If not, there'll be plenty of opportunities. These were so, a lot of these stocks were such high flying, a year or two ago, everybody bullish on it and everything like that. We've seen these come, well, almost down to zero, not quite to zero, but definitely more of an accumulation type of trade, but not a breakout scenario, and not trying to guess at the vote or anything like that. I don't like playing those things because frankly, I don't know what's going on in those votes. So let's not play that game.
Right. Okay. I like that. Thank you for that, Mike. And last but not least, let's take a look at Nike. Do you see some bearish momentum creeping in here, Mike? What's going on?
Yeah, it's almost a lack of bullish that it can't get over these key levels. And there's a lot of things going on. They're closely tied with China. We know that relationship has been tenuous and has become even more tenuous as we're trying to figure out what lane they're going to get to as far as west versus east. And so it just can't go higher. And so I do like, if you're looking for something that is to the downside, it can't get over that 50-day moving average. As of this morning, it couldn't get over Friday's highs. That's a decent play for the downside for me.
Understood. Okay. And Ben, what do you think?
Mike, you brought up a good point there. Again, everybody's kind of looking to see if the bears are stepping up at this point. But I think the responsibility lies on the bulls. And as Mike mentioned, with ongoing uncertainty in terms of China, a major component when you're talking about Nike and some of these other big names, that's one to factor in. And it is rolling over at some key technical levels. I think, again, we were talking earlier in terms of, we were talking about the key juncture in terms of ZI and how the broader market was at this key area of resistance right now and how would it perform at this level. Well, I think, again, this is an instance where if the bulls aren't able to continue some of the momentum we've seen off the March lows, then, considering the underlying trend has been to the downside, the fact that the bears have been in charge at this point, again, I think the burden really lies on the bulls, and we'll wait and see if they can get us back up above 140, but you do see a little bit of a double top having recently formed. Mike was talking about the 50-day moving average. I'll get into that in just a second, but you can also see a pretty well-defined lower extreme. That's the March low down around 116. So the lines are drawn here. Again, 140 down to 116 in terms of the next key level to get up above or below as far as that indication as directional conviction. Last, or just a point with the daily time frame, you can see how, as Mike mentioned, right up to that 50-day moving average. Now, what concerns me is RSI is kind of rolling over here. It's struggling to get through the middle here with follow through. And notice here how volume also kind of lackluster on the way up in terms of what we've seen, but just basically that lack of real bullish sentiment to see follow through at a key area when this market has been trending lower. You can see well below the 200-day moving average at this point still. But I do want to point out that we recently just filled a gap from back in September. You can see here is that gap that I was looking at down around this 120 level, but stalled out in terms of momentum to the downside. Lastly, a quick look at the weekly. Nicole shows the swoosh to the upside and how, again, it does seem like some of that real enthusiasm for this big name has been kind of coming out. NKE sort of rolling over off 179 back down to 134.
Yeah. I like that swoosh reference. I mean, these kinds of charts are really exciting, particularly as you talk about filling those gaps. Final thought here, Mike, on the trade for Nike.
Yeah, I don't think that Nike goes and sees the lows. What I would play this with a credit spread and selling it in that 50-day moving average area. So more of a not up versus straight down sort of scenario. So like a 34-36 call spread, selling that for 75 cents up in that's for regular April. So you're not laying too bad of odds on something like that, and you can actually get some premium for it just sitting.
Right. Yeah, I'm so glad. Thank you so much, Mike and Ben. A great big three today for ZoomInfo, Leafly, and Nike. Thank you very much. Mike Shore of Prosper Trading Academy and Ben Lichtenstein. Thanks so much. Coming up next, we are ready for our spotlight. Bread Financial. There they are, ringing the bell. Right, this morning here at the New York Stock Exchange, the financial services company completes its rebranding. President and CEO, they're ringing the bell early this morning. BFH is the new ticker symbol, and he's here with us to discuss the company's outlook and growth in this buy now, pay later space. Trading 360 continues.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. Thanks for being with us. A quick look here at the markets. You can see we've actually picked up a little momentum off the earlier lows of the morning after the bell. So here's a look. The Dow right now up 12 points at 34,830. The S&P gaining 23 at 4568. The NASDAQ, which is the tech-heavy NASDAQ, in fact, technology doing quite well today, up 1.6% at 15,095. The Russell, the small caps, pulling back about 0.1%. It's time for our spotlight, our 360 spotlight. And today, it's Bread Financial. Completing its rebranding this morning. Joining us right now is President and CEO Ralph Andretta. Thank you so much for being with us. Congratulations.
Thank you for having me here. It's a great day. It's very exciting.
It is really exciting, and I saw your video there as you were ringing the bell with the team, and this rebranding is really important to you, right? It used to be ADS, and now it's BFH, Bread Financial. Tell me why this rebranding was important.
Well, this rebranding is another big milestone in our transformation over the last 2 years. It is a culmination of now really focused on tech and mobile first and being in the market where millennials and Gen Zs want to be and how they want to shop. So it's really exciting for us.
Mm-hmm. And, you know, I was looking back, as I was just telling you, I was looking back when you came on board. And that was in February of 2020. Yes. And so you had your 100-day plan for the company, and then bam, COVID stepped in. Yep. In some ways, COVID could help a company like yours to really understand what's needed, where the leadership is. Tell me a little bit about what you learned during that time.
Yeah, you know, I had 3 good weeks before COVID hit. So it was fun. Those 3 weeks were a lot of fun.
You had your coffee at the same time.
Exactly,
and
so it was fun.
Okay.
But it did a number of things for us. So it helped us identify where our issues really were. And you had to act on them quickly because you're in a new environment that you weren't in before.
Right.
It really showed me who the leaders of the company were, and more important, who weren't the leaders of the company, and where we had to replace those. So that was exciting as well.
Interesting.
And third, it showed where we had product gaps, and that's what led to bread. We bought bread because we didn't have buy now, pay later or installment loans, so we bought that capability during the pandemic. So it really helped us accelerate our transformation.
Right, right. And you know, it's really interesting because you said you found what you needed, and being in this business, you were able to streamline to what was needed most, right? And so working with consumers, personalizing their payment plans with buy now, pay later. Why do you think there's so much worry about it? I mean, isn't it good for many folks and gives them the freedom to get the things they need? Why do you think the downside and some of the regulatory concerns? What do you say is good about it, and what's right about it that people really should know?
I think buy now, pay later is one way to pay. And what we have is we have several ways to lend money, right? So we have private label cards, we have a co-brand card, we have a direct-to-consumer card, we have buy now, pay later, and we have installment loan. So we will lean in where the market's going. I think buy now, pay later was really relevant during the pandemic because people were buying online, and millennials don't like to take credit, so they were spreading out their payments.
Right.
Now it became so popular that the regulators are looking at it.
Yeah.
And I think for us, that's a bit of an advantage because we're a bank and we're regulated.
Right.
And we have that discipline of a bank. And so when we look at it, we're pretty sure that we're following all the right rules for it.
Doing this the right way,
Doing it the right way.
know, and lending, and you have savings solutions for folks. You know, and really your history is in banking.
Right.
I saw that you were with Citigroup's credit cards. You've been at Bank of America, American Express. I mean, you have a lifelong trail in this, so you really learned along the way what works, what doesn't, and to handle the bumps along the way. So as you look at this, and by the way, you mentioned co-branding, one of which is Victoria's Secret and Pink. I saw you get 5%.
Brand new card.
I mean, this is just an example of many things that you're doing, but if someone has likes Victoria's Secret or Pink, they get 5% cash back and such. I mean, I'm sure you have a lot of incentives. I know you'll have a lot more news this week. We were talking about today is really about the branding. So how do you feel the consumer is set up now? Because I feel like it's a mixed bag. I'm hearing some people do so well and jobs are plentiful, while others are still very much paycheck to paycheck.
Yeah, you know, I think the consumers still have a little bit of that savings pent up from the pandemic and the government assistance. I think that's still there as well. So I think what we saw is spending was good in the first quarter, what we expected. I think payments are moving in the right direction. So I don't see any immediate weakness, but I think consumers are now cautious. You go to the gas station, you see the high price for gas, it gives people pause.
Sure. Sure, and it's nice that you understand that and you're empathetic to that, and at the same time they'll be facing higher rates, right?
And I think for us, we lend responsibly, and I think that's the key. When we lend people money, we do it responsibly. We don't put them in harm's way.
Yeah.
We put the right credit line for the right person and help them manage that. I think that's important, particularly when people are worried about what's happening in the economy.
So I feel like with this rebranding, you got a nice restart. The economy is back open again, and summer's coming. So what are some of the things on your agenda here going forward?
Well, we call it a fresh start.
The fresh start.
A fresh start with Bread Financial.
Yeah.
A number of things, just really focused on executing on our plan, which was digital and mobile first, and bringing new products to the marketplace all through the summer. We're excited about that. We're excited about some of our new partners like the NFL, Michaels, so we got some great new partners. We're excited about that as well. So things are really looking up for us.
Yeah, I hadn't realized that you're working with NFL and Michaels. So you can work with stores and I guess pretty much anything.
Direct to consumers with partners. Yes, we have many products now where previously we were kind of a one-trick pony. Now we've got a basket of products that help consumers and help our partners when we offer those to consumers.
And you know, what's your advice now to consumers at this point? As somebody who's running a business, I know just like all the other CEOs, they've had to deal with a lot of different things, whether it's labor shortages, higher wages. There's a lot of moving parts that are happening in our economy and for consumers too. What's some advice or thoughts that you can give us in a big picture way?
You know, first, what we like to do is we want to take care of our employees because they're consumers too, and that's very important to us. Their safety and health is very important to us, and making sure that they feel part of a great culture. I think we do that. We do that well. And that translates to our customers. When they pick up that phone or they transact with them online, you know, they're engaged in our company, and that's really important for them. In terms of consumers, it's the old adage, you know, spend with your head and not over it.
Yeah, absolutely. Well, it's wonderful to see you, Ralph. Thank you so much. Thank you for being with us. Congratulations to you and the team. Bread Financial, Ralph Andretta, President and CEO. Bread Financial, BFH is your new ticker symbol.
Exactly.
BFH. Yeah, I see it branded all over here at the New York Stock Exchange, and a new fresh start to after the pandemic. So this sounds very exciting. I look forward to having you on again in the future. We'll do some updates.
Yep. Thank you for your time.
Thank you very much.
You bet.
Coming up next, the economy is dealing with high inflation. We were just talking about that, and rising rates. So how should that impact investor portfolios? We'll get some ideas next here on Trading 360.
Thank you so much.
Thank you. So nice to meet you.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy. A measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Welcome back to Trading 360. I'm Nicole Petalides, live at the New York Stock Exchange. Thanks for being with us. Well, the economy is certainly dealing with higher inflation, Fed that's raising rates. Now, what can investors with Ty J. Young Wealth Management? Ty, thanks for being with us. So, I mean, I was saying earlier how these last 4 weeks people are feeling a little better because, boy, January was tough, February was tough, and things started to bounce back. Are you worried about the markets? You see the volatility continuing?
I do see the volatility continuing as the Fed begins to raise interest rates, you know, and stave off some of this inflation that we have. And I think the inflation's here for a while. We expect that to happen. So now is a perfect time for investors to look at their portfolios and make the appropriate adjustments.
Right. So I can't wait to hear what the appropriate adjustments may or may not be. In the meantime, you expect inflation. I mean, there's no way to know whether or not it topped, right? People are starting to question whether or not it topped. You know, rates are certainly going to be on the rise, I guess, throughout this year, don't you think?
I absolutely do think the rates went up, 25 basis points. They raised them 25 basis points. But to stave off the inflation that we have, you know, if we look back in history, back to what Paul Volcker did with Reagan, actually before Reagan, they raised interest rates 200 basis points at a pop for a total of 900 basis points over that 2 or 3 year period of time to get inflation under control, which set off a recession. So if we're going to be serious about getting rid of this inflation that we have, we're going to have to increase the oil supply and stop printing money and raise interest rates all at the same time. And if they do all those things at one time, and I'm not saying they are, but if they do, it'll certainly affect the markets. I think we'll have increased volatility volatility. So the adjustments to the portfolio make sense. I mean, now's the time to look at the portfolio and say, do I have all three elements of a winning retirement? Am I set up for income either now or in the future? Am I set up for growth? And very importantly in this environment, am I set up for protection? When the clients that come to us, they have a long-term time horizon. There's names that I think could do tremendous over a long period of time. But if your time horizon is 5 years, 10 years, or shorter, and you might need to start income in a relatively short period of time, there are products that we're using for our clients where they're protected against market losses. They can take advantage of this volatility, not be hurt by it. As the market goes up, they participate in the gains. The gains lock in on an annual basis. They don't get all the gains of the market, but the gains lock in. And when the market goes down, they don't lose anything. That is perfect for someone who is 15 years, 10 years or less from retirement.
And I know you mentioned the protection part. You said protection is a must. So if you were to break this up, you said into sort of three, right? You want to have a little growth. Tell me a little bit about one, growth, or two, protection. How would you break this up so people can learn from your wisdom?
Well, I mean, there's three ways to, thank you for that. There's three ways to have your money completely protected against market losses: FDIC insurance, treasury bonds, and third guaranteed insurance contracts. While stocks do very, very well, they can be volatile. They can go up and they can go down. We've seen market crashes. So how do you insulate yourself against that? There's a product called a guaranteed insurance contract, an index annuity. We use it widely, probably about $1 billion on behalf of our clients we manage in these type of products. And what happens is when the market goes down, they're insulated from that downside. That is huge for someone who's near retirement. And then as the market goes up, they participate in the gains. They might get half the gains on the upside. It locks in, and when the market goes down, they don't lose anything. And the fact is, you don't have to make as much money on the upside if you never lose anything on the downside to earn a reasonable rate of return. That's the way I think you need to be positioned, or we think you need to be positioned going forward in this crazy environment that we're in.
Yeah, and when will you change that position? Because you're not generally a perma bear. I mean, you're just being cautious here at this point. So at what point do you say, I'm going to turn and be a little more growth oriented, or change that strategy a little bit? Is it in the back half of the year? Is it next year? I mean, because ultimately, do you expect markets to go up in the longer term?
Oh, there's no doubt. We live in the greatest country in the world. We have the greatest markets in the world. And I'm not a bear at all. I think this market does well. I just think we have to look at history, look at what happened in the early 80s, late 70s, look at the policies of the 70s that had to be corrected in the 80s, and say to myself, do I have the same policies now that I'm dealing with? Yes. What's going to take it to correct it? Well, we learned that in the 80s. So I think the markets do great over a long period of time. It just, to me, makes sense if I'm going to be in a car driving down the road to wear a seatbelt. I want a level of safety as I get where I want to go. So I think the markets go up.
Right.
I'm just trying to use my head as we're doing it, as we're participating in it.
But this is different, right? This is different. This is not the tech boom and bust. This is not the Great Recession. It feels different, right? I mean, don't you think companies are smarter? They've worked on the balance sheets. I mean, don't you think things should be a little better this round?
I certainly hope so. I hope, I love your optimism there. I hope that companies have done a better job of positioning themselves. But as I look at inflation and look at what we've done, we've printed $1 trillion a year or more for like 10 years through multiple administrations, which devalues our currency. We're pushing the supply of oil down. Everything that we buy, gasoline, food, everything from Amazon, box stores, are all affected by that. It all costs us more. So hopefully companies are positioned to deal with that as consumers can buy less and less with their dollars. So, and there's ways to take advantage of that from an investing standpoint, but hopefully companies have done a better job positioning, but we could have a lot of volatility. We just got to be in a position to weather that and ultimately take advantage of it if we possibly can.
Yeah, good to see you. Thank you so much for that. Ty J. Young of Ty J. Young Wealth Management. Nice to see you on this Monday. We appreciate it.
Seeing you.
Coming up next, let's focus on those gaming stocks in our 360 round. How will the casinos fare as more and more people return to their seats in the casinos. So let's see. And how about Macau? How about Vegas? We'll have a lot of details coming up on Trading 360.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to wait for it.
I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Welcome back to Trading 360. I'm Nicole Petalides, live at the New York Stock Exchange. It's time to talk casinos and gaming in our 360 round. Joining us right now, Chad Bainin, Managing Director for Gaming, Lodging, and Theaters at Macquarie Group, and David Katz, Managing Director for Gaming, Lodging, and Leisure Equity Research at Jefferies. Thank you both for being with us. So I'll start with you, Chad. I saw a lot of upside potential, a lot of buys, even 100% possibility for upside. Tell me why you feel so positive on the group.
Sure, thanks, Nicole. Yeah, I'd say on the land-based side, kind of the bricks of the business. You know, we've seen really strong consumer trends for almost about a year. Some of that is reflected in the stocks. Companies that are more purely related to this side of the business are up 80% since COVID, so over a 2-year basis. The stocks that have really suffered more are the ones that are more exposed towards mobile gaming and sports betting. Those are the ones where we have a higher upside. Within our coverage universe, Penn National, we have 70% upside, MGM and Caesars 50%, but DraftKings, we are still sticking with this one. That's the one with the most upside at 100%.
Yeah, I saw that. I couldn't believe it. And you had a smaller one that I want to get to where you also had 100% upside. David, you're in agreement that the consumer is remaining strong and now wants to get back out there. You may have some concerns. I see Macau, for example, you said is somewhat subdued. What's your outlook for this group?
Yeah, I think you do have to take it in parts, Nicole. The regional casino stocks, where patrons live within an hour's drive. The questions we've been getting from investors is whether fuel prices are a concern, whether a low-end consumer bear case is a concern. We are not particularly concerned, and we are bullish on those regional casino players. We know that those revenues through many years, over the past 20, great financial crisis, they have usually been tethered to wage growth. And we are seeing wage growth in the economy today. And so we're comfortable with those regional casinos. Las Vegas is another segment which is doing well as group business returns and conventions return and entertainment returns. And so we feel comfortable there as well. Macau is really a challenge. And notwithstanding the zero tolerance policy that China has imposed, we still expect that consumer to roll back very slowly. And some portion of it, the VIP business, has been in secular decline for years and is practically shut down, and we think, permanently at this point. So that's a much more complicated recovery.
Oh, okay. So it really is a bit of a pick and choose here. Chad, just to elaborate here on the names that you liked most, you had 50% upside for Caesars, 70% upside for International Game Tech as well as Penn, and then 100% for DraftKings and Play ADS. So tell me a little bit about the small cap here, because I'm not sure that everybody even is fully familiar with that name.
Sure. Yeah, I guess within our small cap universe, we cover a number that are growth stocks and then just kind of recovery type of names. The one that you mentioned is Play AGS. They're a pure play on the recovery of the slot business. Visitation for casinos, both in Vegas and in the regional markets, we're back to about 80% of prior levels, but spend per visitor is up 30 to 40%. What we haven't seen is that 65-year-old and older demographic come back. We think we're starting to see that. We think we're seeing a little bit of that in March, and that'll kind of continue as the weather warms up here. So we do like names that are driven off of that consumer coming back, and one of the names is Play AGS. It's a small cap slot name that trades under 7 times EV to EBITDA, and prior to COVID, it was trading close to 10 times EV to EBITDA. So it's really a value recovery name in our view.
Right, and David, what's your favorite in the group then? Because you made it very clear, right? You have to pick and choose here because it's not just a broad brush for this group. I mean, what would be some of your more favorite names in the group?
Yeah, Nicole, what I would point you to is our context for how we're picking stocks, because the recovery, and this has been an incredibly complex market, right? But the recovery is underway, it's happening. We need 3 or 4 reasons beyond just recovery in order to select a stock as a favorite. We're choosing Caesars. It's actually on Jeffrey's franchise pick list, which is about 25 stocks across our whole platform, because we think there are multiple reasons for it to work. Beyond just Vegas recovery and regional gaming recovery, both of which is where they play, there is an asset sale on the Vegas Strip that is forthcoming. There is a digital business that, as Chad pointed out earlier, is currently a negative that we believe is going to pivot to a positive. They have a number of other growth areas, a project in Pompano, Florida, and a number of other areas where the EBITDA and the cash flows of the business are going to grow in the next few years. And so Caesars has multiple ways to win, which is important for us.
Right, right. And Chad, I'll give you the final thoughts, because I think a lot of people, obviously you had more people getting into gaming without a doubt during COVID. Are you thinking that's probably going to continue?
Yeah, from an investment standpoint, I think we saw a few new types of investors. We saw the retail camp that slowly moved into names such as DraftKings and some of these other names. They may have also been participating in the product themselves. And then really the other group is kind of a growthier software type investor. And I think that kind of came and went. I think that will come back. That'll help the names like DraftKings and also MGM and Caesars that are exposed to this high growth, multi-year sports betting business that we're really bullish on.
Yeah, without a doubt. Thank you both very much. What a great conversation. I appreciate it. Chad Bannon, Macquarie, David Katz of Jefferies. Thank you both very, very much for being with us. And thank you, friends, for being with me here on Trading 360 every single weekday at 11 a.m. Eastern Time, live from the New York Stock Exchange. I'm Nicole Petalides. I will see you at 2 p.m. Eastern for the watch list. Do join me then, but keep it right here because Fast Market is next.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, Go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Technical traders, the Chartmaster is in the building. Trends, support and resistance, key patterns, and technical indicators. The Chartmaster has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Hello, friends. It's the first week in April. That's when a lot of golfers go to Augusta National, but you as traders, you come to TD Ameritrade Network. Welcome to a tradition unlike any other. TD Ameritrade Network proudly presents, no, it's not the Masters, it's Fast Market, of course. And for that, I'm Kevin Hinks, your host for today's show. We've got Sean Cruz coming up. We've got Nick Theodorakis coming up. We've got Landon Swan coming up to talk. We've got all the biggest names that are trading today we're going to be looking at on today's show. We've got JP Morgan. We've got Tesla. We've got Twitter. Those are the three stocks in the news, and those are the three stocks that we're trading today. First, before we get to our guests, let's look at the four major indices and see where they sit. At 11 o'clock Chicago time, 12 o'clock Eastern. The S&P 500 up 0.9%, 25 points to 4570. The NASDAQ 100 up 1.58%, 242 points to 15,103. The Dow Jones Industrial Average up 0.1%, 42.5 points to 34,862. And the Russell 2000 climbing back into the green. It's up 0.2%. 4.5 points to 2095 and some change. All right, now let's bring in our two guests for today's show. We got a lot to talk about, so let's get to it. First, a contributor across the TD Ameritrade Network, Mr. Sean Cruz, and the risk manager, director, Nick Theodorakis from TD Ameritrade. Good to have you on the show, guys. So you wake up on a Monday morning, Nick Theodorakis, I'll go to you first. You wake up on a Monday morning, you've got Elon Musk, Jamie Dimon, and Howard Schultz in the news. That's not bad for a Monday, Nick. What are you seeing here as the leaderboard today? Yeah, we're going to call it a leaderboard. Looks very much like a Masters jacket, green across the board, Nick.
Are we doing this all week with like Masters theme? I don't know. We're going to have to. We'll get Tiger Woods hosted here. I don't know. Copyright infringement. I don't know for sure. From a leaderboard,
get the lawyers on the phone, Nick. Let's find out if we're okay here.
That's why compliance is going to weigh in for us. From a leaderboard,
they've got me on speed dial, Nick. Don't worry about it.
It's a pretty mixed market, even though we're seeing a lot of green across the board, right? There are some sectors down, but from an overall leadership perspective here, Twitter is by far and away on my watch list, the brightest green, up 25% this morning based on the news that Elon is a big holder. So, we're going to talk Twitter and Tesla. So, a lot of overlap in that topic today, which I think is fascinating. And it's just a really good reminder of headlines drive the markets, right? He didn't say, I bought this stock this morning, right? He didn't say, I bought all this stock this morning. He said, I own this, and people pile in. So, the type of news flow this week is different, right? We have a lot of Fed speakers. We don't have a ton of economic data this week. We get some PMI information, I think, tomorrow. We have jobless claims, obviously, Thursday, but it's a lighter economic week. And we're right in between that sweet spot of earnings season ending and earnings season beginning. So, news like this is the news, right? There's headlines, there's tweets, there's, talk about how ownership of companies fits together. We're hearing about stock buybacks again in the news, but it's not a traditional news week, I would call it. It is maybe a light news week from everything but a master's perspective, to your point, Kev. But, and obviously there's a lot going on geopolitically we have to think about too, right? So, we're hearing new reports and horrifying reports, frankly, out of Ukraine. We're hearing, there's news in Pakistan about, a government that's kind of under siege and might have a vote of no confidence. There's a lot that could sort of shake commodity markets, I think, in the headlines. But right now, everything kind of being taken in stride. We're seeing, oil up $2 basically. So not a huge move there, and just sort of being taken in stride as a slow kind of standard economic news week unfolds here.
Yeah, Sean, let's get to one of the first stories first. And, obviously we have a lot to talk about, but let's talk about the one that we're really not going to spend a ton of time on today, and that is Starbucks. Nick talked about a vote of confidence. Well, this stock is down about 5%. Howard Schultz comes in first thing today and stops the stock buyback. Is it political, or is it what's best for the company? Little gray area, and whether he's just kind of bending to some of the loud voices in government that are calling to stop stock buybacks. What I want Howard Schultz to do as CEO is do what's best for the company, period. Sean, how do you see this? Our first story of the day is Howard Schultz and Starbucks. Today's his first day, stock down 5%. Not exactly a warm welcome, Sean.
Yeah, I think if you look at it, to me, there was, why is he stopping it? He feels there's better things they could be doing with that cash. Right. And I'm starting to wonder if you're going to see that maybe from some other companies out there, because input costs right now are really rising across the board. And it's not just focused in if you're using semiconductors, computer chips, or if you, are somehow beholden to the price of crude oil and energy. I mean, it is everything everywhere right now is seeing these costs skyrocketing. So I would imagine you might see some other companies out there come out and maybe not just halt their buybacks altogether, maybe pump the brakes a little bit and use that cash for some other use case. I think that's going to be what's interesting. There probably is a little bit of a political component to this decision, but I think some people are already starting to look at that right now as, look, we had these, it was dirt cheap for us to go out there and raise cash if we wanted to do it. We've refinanced a lot of our debt. Now moving forward with rising rates, it's going to maybe be a little bit more difficult to go out there and tap debt markets if they want to raise more cash. I think it makes sense that maybe you're going to see some companies not want to shell out as much cash for share buybacks as you had previously seen.
Yeah, Nick, if I'm looking at Starbucks and looking at the chart, as we always do, I'm thinking, wait, the stock was just $126. At $90, you're going to stop the buybacks? I would think maybe, unless, of course, remember, as long as you can justify something better to do with that capital, then I'm all good, right? But a mature company like this, sometimes there isn't better things to do. But like I said, that'll be decided down the path. Here's my question about Starbucks, Nick. You had a year. They said that the CEO gave about a year tip-off that he was going to be leaving the company. It certainly looks like he left the company quite abruptly, and they have to bring back the old CEO. How could it be that there was no other CEO succession in place from this company? I think the stock is...
We're in a situation where, they're a coffee shop, right? They're valued on
letter to shareholders, 44 pages, Sean Cruz. And, you know, I thought it was interesting. He covered the U.S. economy. He made several points about the U.S. economy, but he also got very presidential, I thought, Sean, when he talked about the Russia challenge, he called it, and all the things that he would do to talk about Russia. So Jamie Dimon, 44 pages, covered a lot of material, not only the effects of his company, but overall global geopolitics, Sean. So this was pretty far-reaching, Sean.
Yeah, and I think it's interesting, and this is something I don't think really is appreciated enough, not just out of people who watch markets, analysts, investors, and traders, but I think even economists is trying to figure out what things will look like post Ukraine conflict. And I think everyone's wondering, well, that they're just thinking of it in terms of when do commodity prices maybe go back to some historical norms or come off of some of these highs, or things open up on the international front. I think he broached on this in there that after all of this, we might see an entirely different order just in terms of how commodity markets work moving forward, that we're not going to just flip back to, all right, it's over, we're done with it, let's go back to where we were in 2021 or whatever, just in terms of how global commodity markets operate. I think there's going to be a lot of change, and things are not going to be the same moving forward. And that's something I think a lot of economists, if they're not thinking about, should probably start taking a look at, because it will change things a lot, not just for traders in these markets, but also for companies that are operating on the global scale as well.
Yeah, Nick, some of his comments, some of the bullet points that Jamie Dimon talked about, like consumer spending over the last several months is 12% above pre-COVID levels. He talked about housing prices have been strong, and overall asset prices, some of them actually in bubble range. He talked about some serious volatility potentially entering this market. And his comment that I thought was most important was this: the stronger the recovery, the higher the rates that follow. So he's basically saying you have to measure the strength of this U.S. economy and move rates according to that. So he was really spending some time in rent-free in Jerome Powell's head here, talking about how aggressive he needs to be. Now, let's be honest, a banker like Jamie Dimon is talking his book when he talks about higher interest rates and higher yields. So that benefits him. That's why he can be a little more aggressive in terms of where he wants interest rates. That benefits JP Morgan. But how did you see his comments this morning? That stock was down earlier, JP Morgan's. Now it's back up on the day, Nick.
I don't think the stock moves a whole ton on this release, right? I mean, it's kind of like the Fed minutes in a way, to tie the two topics together, right? Like, we know what their book of business is. It's the biggest bank. We know what their desire is, right? Rates higher and low losses, and low loan losses. It's not rocket science what the business model is. I thought he's very pointed, and he and I'm sure the team of people that write this, are pointed, and I think they're always good at not burying the lead, right? What's the lead point here? And I think he makes three main points, right? And the first one is the economy's really, really strong, and then he talks about the war, and then he talks about inflation, then he talks about the war. Well, the war is like a month old, so I wonder what third thing got bumped out, right? COVID, maybe. There's some language in there about that, but like the economy being really strong to me feels like the resonating point here. And I always love, doing these look backs, and you see kind of what happened. And the first thing he basically says is there was over $4 trillion infused into the economy, and that represents like 18 to 20% of U.S. GDP last year. Like, that's incredible. So to think that the economy wouldn't be strong, right, I think is sort of the reminder, like, oh yeah, if you got a 20% raise, right, if you kept your job and you got a 20% raise, just as an individual thinking about that, that means you have more discretionary income, right? That just means it's out there. And I think that's what we're reaping what we sow in that sense, right? There was so much money infused into the economy that's going to take a while to sort of burn off, so to speak. And I think that's the biggest, I think my takeaway from this is like, there was just so much out there. But even when you strip that out, the economy is an incredibly it's growing at an incredibly fast pace. And, couple that with some of the consumer sentiment stuff we've seen recently where it feels like there's a little more disdain out there, but he's basically calling out the numbers are speaking for themselves and the economy is growing extremely hot, and we need to work on that to make sure that it doesn't get out of control. So, very pointed as always. I think that he's, always got a very global view based on the size of their book of business. And that to me being the lead point is really kind of reminded us that, all this other stuff, COVID and everything that's sort of had a long tail at this point is right now secondary to the fact the economy is so hot.
Sean, this stock is about $38 off of its high, right? Higher yields favor the financials, but a flattening yield curve works kind of against that narrative, right? It's not optimal because of the flattening yield curve. That said, though, higher yields still help banks and financials, anyone that stores money. But Sean, this stock is $38 off its high, like I just said. How would you trade a stock like this based on, let me ask you this question, Sean. Does Jamie Dimon's comments this morning change anyone's views on JP Morgan stock?
Yeah, I mean, I don't necessarily think so. I think the one interesting thing that if it's going to be in this letter, a line that I would pull out would just be where he started talking about the Fed may actually have to hike faster than what the market is currently pricing in. And the market's already pricing in and come to grips with some pretty aggressive hiking out of the Fed this year. So I think that might be the risk there. But if you look at what's going on just in terms of some of the analyst ratings and projections, they've been coming down for a lot of these financials that are out there. So it does look like, yeah, hiking rates, higher rates in and of itself is a good thing. But if it comes at the impact of blunting economic activity, specifically the demand for loans, not only from consumers, but also from businesses, that's really not good for JP Morgan across the board. So that's, I think, is really what the market is trying to figure out how to discount here. Now, there's a few key events coming up right now. They're expected to have a dividend coming up tomorrow. They also have earnings coming up here, just checking on the platform here on the 13th. So you've got two events coming up if you're going to be looking at some sort of an option-related trade to keep in mind. One is that dividend, which if you have short calls that are in the money or anything, you want to make sure you're taking a look at your dividend risk. But also when you have that big earnings event coming up, it can sort of throw some things off just in terms of premiums and where there's a little bit of a massive potential move sitting in that stock on the outlook. So one thing I'm looking at and a little concept I'm playing with here is there's still some decent amount of premium, which is always subjective to each person, sitting in the options for this week. And I'm looking specifically on the put side. So if you look at that 135 put, right now it's 50 cents out of the money, but it's still trading at about $1.80, $1.90. So you could look at selling that. Now, what I'm going to do to as part of the trader to turn this into a time spread is actually go out and buy the 135 put that expires next week. So this is going to be a short-term trade. You're really counting on a lot of that premium coming out of those puts that expire this week in this example. And what you want is for the stock to not really do too much for the rest of the week. It's certainly not shoot 10, 15 bucks higher or lower. Anywhere sort of in this range for the week where there will probably be a little bit of volatility, but like Nick said, it's not going to be something that shouldn't be something, I should say, that sends the stock flying all over the place. So what you're going to do is potentially by the end of the week, come out, you'll have that long put that expires April 14th. If that 135 expires worthless, then you have the opportunity to just close that trade or maybe even hold on to it and have a put at a lower overall effective cost because you sold that spread. But what you're counting on here for this trade is that 135 put that you're buying, that premium remains elevated as long as we're in front of that earnings report that's going to be coming out. The crux of this is that will keep the premium in that option steady ahead of that event.
Here's an interesting little thing for our viewers to look at, Nick. I put up Sean's trade, the 1 week 135 put calendar, targeting a very range-bound trade. But look at the call calendar. It's trading about $1.20, $1.21 as well. So the call calendar, the put calendar, both 1 week, 4 days versus 11 days, both trading right around the same price. And why is that? Well, because you're targeting the exact same strike price, and you're targeting basically an at-the-money calendar spread. So for our viewers, you could do the call vertical, you could do the put, or the call calendar, you could do the put calendar, Nick. Your thoughts on how these trades compare to each other, and a call calendar as well as a put calendar trading almost the exact same price?
Well, it's fun when you start piecing stuff together like that and you make the puzzle, right? So if you were to do both, right, you could throw another variant out there. You could buy both the calls and the puts. Now you're basically doing a straddle swap, right? You're buying that back month straddle or back week straddle, and you're selling that front week straddle. So that puts even more range boundness on that trade, right? So there's a lot of ways to kind of piece these things together that we're always talking about here. But you're right. I mean, you look at the individual puts a week out, they're basically $3, $2.98 to $3.15. The calls are $2.56 to $2.73. The calls are slightly in the money. The puts are slightly out of the money. So when you adjust for that extrinsic versus intrinsic value, you're seeing that they're basically trading the same price because we're right at the money. So very range bound. I threw the break even points for the put calendar on my analyze tabs here, 131.69 to 138. You know, that range itself is $6 in the back month. So you're right at that expected price range. And I always like to just break these down verbally. What does it mean, right? And what you're really, you're hoping for in a trade like this is that if you do the put side, right, you're staying above 135. Ideally, you're managing this thing on Friday and you're buying back that 135 put for pennies, right? You're managing, you're trying to pay the smallest amount. So, if you pin the strike, right, you can't just let it expire because you're short. You have to take off there. There's pin risk there. You don't want to get assigned on the stock probably. But, if we're hanging out right here on Friday, you buy that thing back for pennies against what you sold it for. Now you're long this put next week, and it's a lot less premium because you've sold, a weekly option against it. Now, there's not really a chance to roll. If you roll, you close out your next week trade. However, you could turn it into a vertical in that month if you wanted to sell something different against it. Or you obviously can close out that back month put and go from there. So a lot of ways to kind of view this. And I agree with you, Kev. I'd probably do the put in this case because it's out of the money. I'm always an out of the money option fan, but you're talking literally pennies different, right? So always fun to compare the calls and the puts. And obviously you have the opportunity to do both as well if you want to and turn it into a truly non-directional trade here.
All right, guys, great discussion. Great start to the show. That's going to be it for our friend Sean Cruz on the show. Nick Theodorex is going to stick around for the next two segments, but we're going to take a quick 2-minute break, come back with Landon Swan from Likefolio.com. He's going to talk about Tesla. We've got a lot to talk about for the rest of the show. Take a quick 2-minute break. Come back with more Fast Market. See you then, everybody.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Fast Market, everyone. Kevin Hinks back here for our second segment of the show. Nick Theodorakis has agreed to stick around and spend some time with us. And now I'd like to bring in our guest for this segment, and that is co-founder of Likefolio.com, Mr. Landon Swan, to the show. He's here to talk about our feature stock of the day, and it's featured for many reasons, Landon. Tesla, they released some deliveries over the weekend. Good numbers, record numbers, more than a year ago, but not up to Wall Street's expectations, but that's okay. The stock's still up $48, Landon. What are you seeing about the increased or consistent popularity of Tesla Motors?
Well, this is a revolutionary company. I mean, they have changed the automobile landscape. Fantastic job. I mean, it's one of my favorite entrepreneurs of all time. Side note, that Twitter buy is pretty spectacular, so that's going to be an interesting shakeup. But also, this is a company that has completely changed how the automotive industry is looking right now. And you've got a lot of other, Me Too type companies popping up, these other EV companies, and they're all way behind, but they're getting a lot of buzz. So Tesla's leading the pack. They're doing better than all of the traditional automakers with our data. They're a little bit behind as far as increase in purchase intent as some of their competitors, but it's also really, really small numbers. I mean, if you're talking about like a company like Rivian, they're at plus, I think, 180% year over year purchase intent change, but they've delivered 900 cars, right? Tesla's delivering about 3,500 a day right now. So they're still leading the pack on that. Doing very well, as you can see, against all the traditional automakers, and their happiness is also very strong. So better happiness than most of the traditional automakers, and a little bit behind some of the EV ones. But again, Lucid's delivered 300 cars so far, Rivian's 900, and the other one, Fisker, hasn't delivered one yet. So they're not really part of the conversation just yet, but it is something to watch out as they come up. The concern, though, with Tesla is they have a 230 PE ratio right now. They're only about 9% off all-time highs. The stock is doing very, very well. They've struggled a little bit with chip shortages, mostly supply chain issues coming from that as well. So they've got some problems on delivery, but their pace is continuing to increase. Now, if you look at how their purchase intent has gone over the last few quarters, the problem with Tesla is that it's slowing down. Their growth is slowing down, and that's what we like to look at Likefolio is how has it changed. So if you look at how it was just a little while ago, we were looking at plus 52% year over year. That's from 2 years ago to last year. And now, even though we're at all-time highs on purchase intent on a quarterly basis, that pace is only plus 3% year over year. So it's slowing down a little bit, and no investor wants to see that. Even though you're at all-time high purchase intent, extremely high happiness, everybody loves the car, it's fantastic. The growth slowing down is tough because we talk about this on this show. If you've got a PE ratio in the 200s, 230, I think right now, anything that's showing any kind of slowdown is going to multiply on the downside, just as acceleration will multiply on the upside. So you're really getting stretched out a lot, and that's a little bit concerning to me. So they report in about 2 weeks, Likefolio data, and I personally love this company long term, but I'm not buying any shares until after they report. I think maybe Wall Street could be in for a little bit of a disappointment just based off of, again, the growth. Even though it's at all-time highs, the derivative of that is slowing down. And I don't think anybody wants to see that.
Landon, Wedbush is out this morning with a $1,400 price target and some interesting stats on pushing out some of their production capacity just because of all the slowdowns in China due to lockdowns and from Q1 to Q2. And, so I think some pretty, technical analysts look at what's going on there. But how do you consider when you look at that purchase intent, how do you consider this industry? I guess maybe it's not the most unique, but it feels like it, where some of these companies, to your point, have literally never produced a product, right? Versus Tesla, which has relatively high market saturation or penetration, I guess is the right way to say it. How do you factor in the penetration of their sales and their growing sales into that purchase intent? How do you factor for the idea that so many people have bought a Tesla relative to their competitors?
Sure. So, well, if you go back to a few years and Tesla, if you looked at the purchase intent chart of Tesla, it was screaming off the charts. Now, relative to today, it's extremely low. But back then, before they delivered cars, it was very high. So we were bullish on Tesla, back in 2016, 2017, because those bars, if you compare them to the previous bars, are really high. They're small compared to the ones now, but it was big growth. And so I think a lot of people maybe dismissed that and didn't understand what the demand really was. People really were looking forward to these cars, and everyone sort of wrote them off. That's why you've got these perma bears on Tesla just continually getting crushed, because they didn't understand how important consumer demand is. So if you look at Rivian, for example, that plus 184 purchase intent year over year, that is what I would say a little bit concerning. They haven't delivered many cars, 920 so far. So they haven't delivered many, but Tesla was in that same boat 4 or 5 years ago, 6 years ago. So they're coming up. We'll see how they do compared to Tesla. Tesla's by far the leader. They've got the most penetration, absolutely. If you've ever ridden in one, you're sold. I mean, they're unbelievable cars. But you got these other guys that are up and comers, and of course all the traditional automakers are converting, getting a lot of electric vehicles out there. A lot of it has to do with gas prices. I mean, people talking about gas price concerns, that's plus 400% year over year. And also the autonomous vehicles, the automatic driving, that is huge. So that's plus 80% year over year. So people really want these features. They want to get off gasoline. They want to get the safety features and the ability to drive autonomously. Tesla's leading the pack, but they've got 3 companies that are coming after them. We'll see. I think Lucid is really falling behind, but the other 2 are making their claim that, hey, we might be able to get there as well. We might be able to compete with Tesla one day. We'll see. So I wouldn't write them off. We're going to need to see serious deliveries, serious follow through from them over the next few years before it's a real concern, but they're on the map of concern right now.
Landon, in terms of deliveries, the Model S and Model X, they delivered 14,724 cars. That's actually up 25%. But the Model 3 and the Model Y was 295,324 cars, but that was actually down slightly, Landon. Are you seeing any problems in that perspective? Like their growth is coming from the S and the X and actually not from the biggest seller. Is that any kind of a red flag at Lightfolio?
Yeah, so the models breakdown is really important. The Model 3 makes up almost all of their sales. I mean, it is a huge, huge percentage of their sales. You can see the Model Y is the fastest growing when it comes to people talking about which brand they're talking about or which model. But the Model 3 is second, and we're seeing some growth through that. The X and the S are actually, we're seeing them kind of less relevant as well as the Cybertruck, which it has not been released yet. So, anytime you have a car that the high models are 60, 70, 80,000, maybe 120,000. And then you've got this much more attainable Model 3 that's in the, 30,000 or something like that. It's going to lead the pack. But I also think that you get that in front of people, it could be a stepping stone into something larger. But of course, the more affordable car is going to be the one that's leading the pack. But that is the one to watch because it makes up all of their sales. So the fact that it is a little bit slowing down, the growth is slowing down, that's a big concern. But I don't know that it's from demand as much as it is from a lot of chip shortages and supply chain issues. I mean, this is a very chip-heavy car. All cars are now, but these are some of the most heavy when it comes to chips. So I'd say that's a big concern. The purchase intent is a little bit of a scary issue. Again, it's plus 3% year over year. It's better than it was, but it used to be plus 50% year over year. So anytime you get that situation, you're setting yourself up for a little bit of a disappointment when you've got a PE ratio as high as they do and expectations as high as investors have for this company.
Yeah, if you are one of the world-class growth stocks and the energy is for growth, you need to continue to show growth for that energy to remain. And you're right. The China factory is currently on pause now because of what's going on with COVID. There are supply chain shortages. There are other issues with some of the cars, yet they were still able to put up relatively good numbers. I think they missed the expectations by about 7,000. I think Wall Street analysts wanted 317. It came in right around 310. But they've got, it's funny, Elon Musk put on Twitter this morning, Berlin rocks, right? Which means Berlin is getting ready to go. They've got Texas, Austin ready to go, Shanghai, Fremont. So this company is still, expanding its footprint and getting ready. Landon, give us your final thoughts on Tesla in terms of the problems they have and the opportunities they have. And of course, Elon Musk.
Sure. So I think that's really the story, is you don't bet against Elon Musk. You can ask a lot of broke perma bears who've been short, that forever. Just been getting murdered on Tesla short. You just can't bet against the guy. He's one of the greatest entrepreneurs and innovators of our time, of all time, really. And the company is now, it used to be, they'll never be able to build that. They built it. They'll never be able to deliver it. They're delivering it. So long term, I'm a huge fan of this company. I think I'm going to tap the brakes a little bit and pause until after they report, because I think there's a chance that they could come back a little bit on the report based on slowed down growth. But then I'm jumping back in on any kind of dip. Just looking at the deliveries, they're at a pace of about 3,500 a day, over 1 million. And if you look at GM and BMW, they did about 2 million, Ford's around 4 million. So Tesla is a major player. They used to be written off as you'll never be able to deliver these cars. And just as you mentioned, they're ramping up production. They are going to be, over the next 5 or 10 years, the car company. So long term, super bullish, never bet against the guy. Short term, I'm going to wait till after they report.
Landon Swan, co-founder of LikeFolio.com. Thank you so much for coming on, as always, bringing the LikeFolio data to Fast Market. Have a great day, Landon.
Thanks, guys.
All right, Nick. You've got a trade here up on Tesla. It's something similar to what Landon was discussing, right? It's talking about a pause. It's talking about, the run it's been on. Give us your ideas and the trade you brought for Tesla. It's something in the Iron Condor family, isn't it?
This is less about, I think anybody that's seen the show before knows that we talk Iron Condors, and there's lots of ways to kind of go about this. This is a very neutral trade, though, for Tesla, which I think what Landon said, and certainly not making recommendations on stocks here, but I think, neutral in Tesla is about, historically speaking, is about as bearish as is safe to get, right? Because when they do have a pullback, the rally that has ensued every time, and history doesn't repeat itself necessarily, right? But to his point on just people getting short the stock, getting short the stock via options, and just getting run over because it rallies back so quickly is a dangerous premise. So if you're going to take a short position, right, you want to make sure, as always, you're defining your risk, because it reverses and reverts very quickly. So, and look at a chart now, right? I mean, you see this just parabolic line. You almost can't get your chart narrow enough to not see it looking straight up. And there hasn't been like massive news, right? They're bringing on factories around the world, bringing online factories around the world. And even when we hear about supply issues and halting of what is potentially their biggest growth market, the stock's up, pretty significantly today. So that's not a bull case necessarily, right? Anything can always happen with these companies, but I think if you do feel like this move in its current state is a bit outdone, you may be thinking, right, as an example trade, that this thing takes a bit of a breath prior to earnings, which is coming up in a couple of weeks. There's still an estimated date out there between the 25th and the 27th that I'm seeing. So I don't checked a few sources and see a couple of different dates. So the earnings date isn't even necessarily locked in yet. And then he's out there doing all kinds of other stuff, right? I'm always wondering what happened to the car that he shot off to Mars is doing right now. He's buying almost a control share of Twitter, and obviously all the solar stuff. So there's a lot of irons in the fire for Elon, as always. So this is just a simple, maybe the stock takes a bit of a pause. It's rallied so much, isn't calling for a huge pullback. but is also not calling for this trajectory to continue into earnings, which is about 2 weeks out. So I was just looking, Kev, at selling, an even call spread and a put spread, 10 points wide, the 1200, 1210 call against the 10 half or 1050 put, 1060 put spread. And, it's $10 wide. You're taking in about, $2.80, $3. It's kind of right in that sweet spot of, collecting 25 to 30% of the strikes, of the width of the spread. And you're looking for just a bit of a consolidation here over the course of the week. This is a short-term trade. It doesn't really call for, a correction of any kind. It's just calling for, hey, maybe this move, given the velocity it's seen, consolidates a bit over the next 4 days. If it stays within that range between your short strikes, you get your 1200 and your 1050s. I'm sorry, your 1060s, which is a really wide range. Yeah. This thing would achieve maximum profit, and then obviously if you go outside of that, you've got your maximum loss, which is about 70 cents on the dollar.
Yeah, interesting footnote on this trade, Nick. Number one, it's this week, right? So it's only this week, and you've got about $1,400 between your short strikes. So that's $700 on the upside, $700 on the downside. So you've given yourself quite the room for this to trade in. And like you said, like Folio's data is a little counter than to the rally that you're seeing in this name. Some of the growth is slowing, not stopping, but slowing. But again, you fade Tesla at your own peril. But a great idea for a trade, Nick. We'll put that on. We'll check it during the week. And that is the end of our second segment of the day. But we got more. The whole second half of this show is about Elon Musk. So let's take a quick break, come back with our discussion between Nick and I on Twitter and Elon Musk's trade that he's made over the last couple of days. Pretty interesting. Take a quick 2-minute break. Come back with more Fast Market. See you then, everybody.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. A sharp move higher to begin the week in the NASDAQ, led by Pinduoduo, Alibaba, and JD.com. Tech is leading today, up over 1.5%, and futures are back above 15,000. It's pedal to the metal in Tesla. It's cruising up over 4% this morning after reporting record-breaking first quarter deliveries of about 310,000 vehicles. And Twitter is spiking on news that Elon Musk took a 9% stake in the company. It's up over 25%. Now, the move up adds to the NASDAQ's rally off the March lows, where futures bottomed out around 13,000. It puts the tech-heavy index to just shy of the 200-day moving average. Crude oil this morning, WTI is back above $100 a barrel after posting its worst weekly performance since April of 2020. Last week, the U.S. announced plans to release 180 million barrels from strategic petroleum reserves over the next 6 months. The IEA said the IEA states are in agreement on a coordinated oil release. They still have yet to determine volumes, and OPEC Plus is increasing production quotas, all contributing to the decline in prices. The Brent last week to 103. Back around 108 this morning, as many feel the relief from the added supplies could be short-lived as demand remains strong, even with over 30 million Shanghai residents in lockdown. WTI futures are trading just under 102. They're up around 2.5%. This has been your TD Ameritrade Network Futures Market Update, and now back to Fast Market.
Welcome back to Fast Market, everyone. Kevin Hinks and Nick Theodorakis back here for our third and final segment of the day. And let's get now to the fun part of the show, Nick, where we talk about Elon Musk and his new relationship with social media. Now, Elon Musk has 80 million Twitter followers. And as you know, he's quite active on social media, but he's never been this active, Nick. He now bought 73.5 million shares in a 13G filing with the SEC. He paid about $2.9 billion for 73.5 million shares. It's worth a little more than that now, Nick, as the stock is up 28.4%. And by the way, extending gains as the day goes on. So people believe in what Elon Musk is doing, but like I said, he tweeted this morning that Berlin rocks. He tweeted yesterday that he's inspired by curiosity, and he is consistent on social media, Nick. But now, Nick, he's got a 9.2% stake in Twitter. He's now considered to be a passive investor. I don't think he's very passive, Nick.
I started following Twitter, Kevin, when it was, I don't know, $30, right? And I always just thought it was a $30 stock. It was, it's been 30, like, yep. I don't know what the exact, moving average, the lifetime moving average of the stock is, but it's hung around $30 to $40 forever. And all of a sudden, it's 50 now. So, I still question, like, in its current state, what is the monetization plan for Twitter, right? All this aside, what is the monetization plan? What happened today that makes it worth 25% more? That's a lot of percents. What makes it worth 25% more than it was yesterday? It's just a fascinating, I got a big smile on my face. It's just a fascinating tale of him, Elon Musk, driving, investment decisions, him driving, all of these kind of Reddit feed, all this stuff. Right? Look at the volume on Twitter today. It's literally off the volume chart when you pull up a volume chart along with the price action. Amazing. So he drives so much engagement in the markets and so many different products. I think it's just absolutely fascinating to see. Is it surprising? Well, I mean, clearly it's surprising to the stock. But don't forget, in the last few weeks, he's been talking about starting his own social media platform. Mm-hmm. And I think that, being smart like, he is, right? Getting penetration into a space where there's already a saturation of players. When you look at Twitter and Facebook and Snapchat and WhatsApp, all the, it's probably hard to take from another pie and add to your own, or create an entirely new pie and grow from there. But thinking about the following he already has, this is probably in his mind, and I obviously don't know, a cheap way to get, kind of vertical, if you will, integration into what he's already doing. He's got, of the most followers in the world. He's already incredibly influential. Now, when he tweets, right, he's got even more of a dollar value stake in that. And theoretically, right, going on into things like, politics and, elections coming up, he's going to have a bigger say, right? He's got 4 times the number of shares now, like in an instant almost, than the founder Jack Dorsey does, right? So there's eye-popping numbers all over the place here, but I feel almost like it's a it's a vertical integration for him to getting control of where he's already got all of his followers. So fascinating move.
Yeah. I mean, let's face it. Elon Musk has been calling for unencumbered free speech, which has really not been the way Twitter has conducted business lately. So I think this is going to get really interesting. And does he make a play for the entire company? It's kind of interesting to figure out what his next move is. Obviously, it's put an energize not only into Twitter stock, but all social media. Facebook is up $8 today based on this. So all the social media stocks are kind of surging as now these stocks were dead in the water and had no energy, and now they're all surging today. It's pretty interesting how he puts energy into a different sector. But the trade that I looked at, Nick, and this is kind of something we do a lot on this, but this is a different take on it. You've seen this show where we've done calendar spreads financed by short put verticals. And obviously, when I talk about this, my posture here is bullish overall in Tesla. But I did a diagonal spread financed by put verticals. So what I did, I went out to the May 6th, giving ourselves a little time. We're not going to get this by a credit because two things. Because it's a diagonal, and we've gone out all the way a month in terms of our days out to May 6th. So I did the May 6th 50, and then this week's April 55, which is right in line with the expected move. That's the diagonal. And then I sold two 45-41 put verticals against it. That chips away at the net debit, doesn't eliminate it because it's a diagonal and it's a long dated diagonal, Nick. But this is costing about $3. It's taking in about $44 a day in terms of theta, and you don't need a sharp move towards the $55 stock. Nick, I've got about 30 seconds. Give us your last take on Tesla, on this trade in Twitter as we wrap up the show here.
Well, it's a nice way to help finance that, Kev, because it's about $550 for that diagonal on its own. So paying for that, right? Paying for all that time over 30 days of time with those short-term puts, definitely reduces the cost and makes it more palatable. I think overall, right there, he's got his hands in so many things. Keep an eye on the share percentage that he owns. He's below that 10% control person ownership stake. If you see that number tick up, that could change the game dramatically.
For all of us here at the TD Ameritrade Network, have a great day and a great afternoon. Next Gen Investing is coming up next. See you tomorrow, everybody.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group. where risk meets opportunity.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com to all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Happy Monday, everybody. Good afternoon, and welcome to Next Gen Investing. I'm your host, Alex Coffey. Today, I am joined by Caroline Woods in for Jenny Horn while she takes a brief vacation. I believe she'll be back tomorrow joining us. But Caroline, good morning to you. Thanks for stepping in. Got a little bit of green here across the board thus far, with the Russell kind of flirting with unchanged. Any thoughts on the overall market action here to start out the week?
Well, it's the second trading day of the second quarter, and so far it's 2 days in a row of gains. The Dow sort of searching for direction. The NASDAQ, obviously the clear out performer, tech back in favor. But, you know, it's interesting. April's typically, seasonally, a strong month, but there's so many headwinds, and can't ignore the fact that that yield curve inverted last week, albeit pretty briefly. Most people I've been speaking to lately are calling for at least stagflation, if not a recession. So investors clearly shrugging that off today, but it remains top of mind for me, Alex. You know, obviously we don't have a ton of data this week. Earnings season picks up, you know, it's just around the corner. So we'll have that soon. So it'll probably be a headline-driven market. So anyone's guess. Bulls holding on tight today, though.
Yeah, we'll get the Fed minutes later on this week, which sometimes aren't a big deal, but sometimes they're a huge deal. So that could be one of those momentous events for this week. But you talked about it, kind of a quiet period otherwise in terms of eco data. In terms of earnings, we got to wait a couple more weeks still before we really get into the meat and potatoes of that. But we got a fun show planned nonetheless. We'll start things off, of course, with our upvote, downvote segment, which we'll look at some of the movers, some interesting story-based movers here on the micro front today. We're really going to focus on between Starbucks, Penn, Roku, and Match. So looking forward to that in just a moment. For the fear of missing out segment, Caroline, I think it's no surprise here that Twitter jumps off the screen as one of the stories of the day. So we'll be looking at that. We'll go over the Tesla delivery numbers, and then we'll close out the show for under 30 with Ken Rose stepping in today for Mr. George Tillis. Well, he also takes a vacation. We're going to be looking at Dave & Buster's. But Caroline, let's kick things off here with upvote, downvote. All our regular viewers know, of course, these are not endorsements or recommendations, but rather we're going to narrow down a group of interesting stories and movers to a smaller group of interesting stories and movers. And we'll, of course, look at charts and trades with Ben Lichtenstein in just a moment for that. But let's kick things off here with Starbucks. CEO, old CEO, now new interim CEO, Howard Schultz coming in and already shaking things up here. So talk to me about this story.
Yeah, Starbucks founder and former CEO back in that CEO role, just at least in the interim. And his first order of business, Howard Schultz that is to suspend the share buyback program. Shares in turn tumbling almost 5% today. Starbucks just reinstated that buyback program last month as part of a plan to return $20 billion to shareholders over the next 3 years. But Howard Schultz says the decision allows Starbucks to invest more into our people and our stores, the only way to create long-term value for all stakeholders. Share buybacks have really been a hot button issue lately, so Schultz making his stance known on those. But it's also a way to potentially conserve some cash. Starbucks, as you know, Alex, is up against a ton of headwinds right now, whether it be rising costs and wage pressures or supply chain issues, that slowdown in China that they're dealing with, political unrest, unionization efforts. I know over the weekend, employees here at the New York City Reserve Roastery voted in favor of forming a union, becoming the 9th company-owned location to unionize. Schultz, of course, knows the company well, probably better than anyone. I mean, he founded it, but he's certainly taking on a lot. He has a lot on his plate. But you know, investors clearly not happy because, of course, buybacks reduce share count, and reducing share count is what improves earnings per share. So stock down 4.6% right now.
Yeah, it's of course one way that you can see that value being returned to shareholders. But ultimately, if this shores the company up, potentially adds to more growth down the line, makes it a more profitable organization for the patient investors, it could ultimately be a better thing than just passing back those numbers and being complacent. So we'll see how things shape up. Obviously, as you mentioned, investors not loving that headline this morning. We'll see if this is the beginning of a greater trend we see in other names that are facing similar pressures, but time will only tell. I'm going to say downvote today. Just not a lot to do with this story. I think it's an interesting, and of course the reaction is always interesting, but there's some that give us a little bit more maybe meat on the bone amongst this list that maybe have a greater deal of impact going forward in terms of things that we could maybe quantify. One of those could be Roku here. Roku with a pretty nice move here today, up $9. Caroline, talk to me about why this one has seen itself on the move today.
Yeah, $9, otherwise 7%, 7.3%. So we're going from a loser today to a winner. Roku confirmed it reached a multi-year extension of its distribution deal with Amazon. This means that customers can continue to access the Prime Video and IMDb TV apps on their Roku devices. So investors clearly treating this as a big win for Roku based on the move today. Further terms of the agreement, though, including the financials behind it, weren't disclosed, Alex. But it's, as we said, up 7% today. But I'm taking a look year to date, still down 41%. Meanwhile, Amazon is up about 2% today.
Yeah, this is an interesting story. I think this is possibly a win-win for both. Of course, we don't have all the details in terms of the financials and the breakdown there, but Roku, one of the most popular mediums for accessing these different streaming channels and platforms, and of course, Amazon, one of the premier players within the space. So seeing them two come together and make a deal here, of course, is going to be important for both of those companies, probably more so for Roku, given that that's their only business. Amazon, of course, being a huge cloud player and e-commerce player as well. It's more of an ancillary side of their business. So not surprised to see a nice positive reaction here. We'll see if it can hold or even continue down the line. I'm going to say upvote today, Caroline, on Roku. You talked about this, the tremendous pressure it's been under, trying to mount a little comeback and building on that momentum here this morning. Next one that caught my eye here was Match Group, Caroline. I read this story, and I'm going to need more details. Maybe you can help make some sense of it to me, because it's got me all twisted up. I'm not even sure I understand it.
Well, this is a fun one. So Match Group and Visible, which is the Verizon-owned all-digital wireless carrier, they're celebrating singles because it's wedding season. So who else to celebrate other than the singles who have to go to all the weddings and give all the gifts and not get anything in return other than maybe a dinner and some dancing. So that's until now, though, because Match and Visible are creating a limited time singles registry where users can sign up to receive gifts and then send them to special single people in their lives. It makes sense for Match because they own Match, of course, as well as Tinder, OkCupid, Plenty of Fish, all those dating websites or apps now. But what does a wireless carrier have to do with it? Well, that was my biggest question. Apparently, Visible is the only wireless carrier, though, to offer savings to single line users. So no need for a family plan in order to get those discounts. So Alex, as for what you can add to your registry, you can add a foldable one-person kayak. You can add Mine and Also Mine hand towels for the bathroom. You can add single-serve coffee maker, a selfie stick, a self-massager. So nothing that you need a significant other to enjoy. Mm-hmm. The registry will be active from today through April 30th. So go check it out, Alex.
I think it's a fun headline, a fun story, clearly a little bit of kind of some puns intended there. Who's buying this stuff on the registry, though? I don't know how much this actually leads to actual bottom line, more kind of a fun story. So for that reason, I'm going to say downvote. But Match getting some nice publicity here today. It's up nicely, $3.94, almost $4 on the day. But the NASDAQ leading, how much of that is due to this headline? How much of that is just tech being strong today? I'm not sure. Final one on the list, though, is Penn. And this story, I think, is a little bit more powerful. Of course, they have their association with the Barstool Sportsbook here in the U.S., but also making some headlines again on their acquisition of the Score, and maybe a little bit more to that story here this morning. Caroline, what's the news?
Yeah, Penn's up 6.6% right now. It's expanding its online gaming business, announcing that its subsidiary Score Digital Sports Ventures has officially launched the Score Bet mobile sportsbook and casino in Ontario, Canada. It's a mobile sports betting platform, but also features an online casino product that includes live dealer games, digital slots, and table games. Meanwhile, the Score Bet covers all major sports leagues and events. The app is available for download anywhere in Canada, although you have to be at least 19 and physically located in Ontario to wager. But its CEO, Jay Snowden, said today's launch is significant as it expands Penn National's online gaming business to a jurisdiction that is expected to be one of the largest regulated markets in North America. So big bets on Canada. The plan is to expand the Score Bet to include games from Penn Game Studios. And as we said, investors clearly celebrating this one up big today.
DraftKings in many ways have stole the spotlight when it comes to coverage of this particular space, but of course Penn was one of the leaders as well with their Barstool Association. And in a little bit of fun, it's a national title game for college basketball tonight. Two of the most recognizable brands in collegiate sports facing head-to-head between the University of Kansas and the University of North Carolina tonight. Just for that reason, alongside this interesting story, I'm going to say upvote. It's a timely conversation, Caroline. So we got Roku and Penn National Gaming as two to explore a little bit further. For a little preview on that, I want to welcome in the host of Futures and TD Ameritrade Network contributor Ben Lichtenstein to the show here. Ben, let's kick things off with a little streaming talk and Roku. Give us a little tease of what's to come.
Well, Alex, this is a great example of what I look to as a trader, the two phases of price development. You have well-defined horizontal type price development, which phases into a vertical phase. And, when I look at price through this lens, it really helps simplify things for me in terms of there's really just two phases to focus on. You have, again, that kind of low conviction overlapping rotational, or you have that kind of high conviction type price activity. Now, you're actually looking at Penn here, but Roku, again, is a textbook example of the vertical versus the horizontal phase, Alex. And recently we've seen it recently trend from 268 down to 997. And then since February, mid-February, it's been a little bit more sideways. We're talking about 140 to 97. So, down year to date 41%. I heard you and Caroline talking about how it's taken a hit, but it's got some exciting levels to keep an eye on right now. And again, a perfect example of the two phases of price development. So we're going to talk a little bit about that.
Yeah, down tremendously year to date, but already making a huge rally just as recently off the lows, Ben. It might be down 40% year to date, but it's up 33% from its closing low. So just tremendous volatility there in Roku. But you mentioned Penn National as well. Give us a quick preview on the chart here of Penn, another one that's been beaten up pretty good.
Yeah, Roku and Penn, Alex, both testing key areas of resistance right now after, again, as you mentioned, rallying back off lows. Now, in the case of Penn, we saw a sharp move lower off the March, a sharp move higher, I should say, off the March lows. Penn actually double bottomed around that 38-39 level, but since it's been kind of running into resistance up around 45. And again, as mentioned, a key threshold right now where the bulls want to see this thing continue to the upside. The bears are looking for it to fail and kind of stall out here and roll back over and again, potentially work its way back down to 38. But we're going to talk in this instance about two separate scenarios. The breakout scenario, what to look for if we do get a move up and through that $45 level with conviction, with follow through, and ultimately what the bulls would be rooting for. And then we'll also talk a little bit about what happens if you fail up at this key area of resistance and what to look for if you're somewhat bearish the stock, if you think that it just doesn't have the conviction to follow through. Now, lastly, I want to point out we're talking about two names that have come into recent resistance while we have the broader market, Alex, which has been continuing to the upside. So you're talking about the NASDAQ, the ES, the Dow, and the Russell have been able to take out the February highs throughout the month of March. The last couple days, as Caroline mentioned, we're up 2 days in a row here now to begin the second quarter. So or to begin the second quarter today, the first full trading day, or the first full week of the second quarter, I should say. But a lot of momentum here in a couple of these names. Broader market, just again, the two names that we're going to look at have really yet to express the same enthusiasm that we've seen in the ES, the NASDAQ, the Dow, and the Russell. So could be a bit of a tell here in terms of what to watch, but I'm excited about these two names we get to break down today.
Yeah, looking forward to it. A little bit of growth outperformance here to start the week, as we've seen throughout much of this kind of rally over the last few weeks. So if that continues, maybe an environment that could be constructive for names that have been beaten up like Roku and Penn. But Ben, hold on to those thoughts. We're going to take a short break. Caroline and myself will be right back as well to explore both Penn National and Roku just a little bit further. We'll look at those charts in depth with Ben Lichtenstein. Of course, we'll look at some trade illustrations as well. Stick around. We'll be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the Watch List at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Welcome back to Next Gen Investing. I'm Alex Coffey alongside Caroline Woods. We're also still joined by Ben Lichtenstein, the host of Futures. We're going to quickly, though, take a quick look at the market itself. I wanted to show something on the heat map. If we could pull up the platform, look at the market leadership today. A lot of bright colors on the board. A lot of familiar names here up on the day. You got the mega caps way out in front with Apple, Microsoft, Facebook, Alphabet, Tesla, Amazon. You get the picture here. The most important names to the market are the strongest today. NVIDIA as well, all higher, Adobe, Salesforce. So when I see something like this, it's going to lead to NASDAQ outperformance. And if we flip over to the NASDAQ 100, you're going to see they make up an even greater percentage of the NASDAQ 100, but you're seeing a market that's very familiar, one that we had seen for much of the time period throughout the post-pandemic time in the recovery. As some of these very strong, some may argue, almost monopolies in some cases in their own sectors, really out in front here as they have the strongest balance sheets, in many ways strongest market positions, and in some cases very, very strong growth prospects. So I think that's very interesting to see. Kind of the breadth is not so great. You see a lot more red on the screen, but the bright colors of green in those big bars or in the big blocks is really important. But I want to come back to the names that made it through upvote and downvote here, Caroline. We have both Roku and Penn National, both very interesting names as they've kind of, in many ways, captured kind of the sentiment of the overall market. Both had tremendous run-ups during the pandemic period for various reasons, kind of tied to that stay-at-home trade and how we spent some of our time, be that productive or not, on Roku and things like Penn National's sports gaming apps. But let's start here with Roku, Caroline. Give us a quick reminder of what this story was.
Well, Roku said that it basically reached a deal with Amazon, so it can extend. So basically, on your Roku devices, you'll be able to see IMDb TV and Prime. Sorry, I totally just lost my train of thought here. Yeah, so they can continue to get Prime Video and IMDb TV. I was thinking about those growth stocks being back in favor, but you know, it's interesting with Roku, Alex, because, and we'll bring in Ben here in just a second to talk about the chart, but it's one of those stocks back in favor. You kind of looked at it as glass half full, talking about the bounce from the bottom. I think you said 33% bounce from the bottom, but down 40% year to date. But if you zoom out on that chart, it's crazy to think that that stock traded at almost $500 a share last summer, and now it's trading around $130, $134 a share. But Ben, I know you said that there were some key technical, exciting levels that you were looking at. So talk to us a little bit more about what those key levels are and what you're specifically looking at.
Caroline, and I think in this instance, investors have been thinking of this one as a glass half full rather than half empty, or a glass half empty rather than half full, I should say, and some of the weakness we've seen in terms of price activity. Now, I mentioned that there's two phases of development when you're talking about price. You're talking about either that horizontal phase where price is kind of overlapping and rotational, has less conviction, less energy associated with it, and then you have a vertical phase, and where the market is seeking value up or down in a breakout type tendency. You have higher highs, higher lows, you have a really well-defined directional conviction, and you have, again, that initiative type price activity relative to the sideways consolidation type price activity. Now you can see a pretty well-defined migration of value to the downside here. Again, these separate areas of consolidation constitute areas of value, and in this instance I have them numbered. So again, the first area of value forms around this 230 area. You get a vertical move out of balance to the downside to begin the month of January, a little sideways consolidation. These are kind of short-lived areas of consolidation, 1, 2, 3, 4 to the downside. But then, Caroline, you can see it gets a little less well-defined in terms of migration of value to the downside as 4 kind of shifts into the beginning of February and into the middle of February prior to that big breakout to the downside. So let's dive back into this chart here because I want to show you from 1, 2, 3, 4 into kind of losing some of that directional. What I went ahead and did was just kind of took a fat crayon, and here you can see I went ahead and drew this as now I changed 4 into 3, this larger area, and then the bigger breakdown here, again, the initiative move lower into this 4th area of consolidation. We're testing the upper extreme of it. Again, the bulls are looking for a breakout in this instance up and through this 140 area. But to really get something convincing to the upside, I think you have to take out the middle of the last area balance that formed. And in this instance, you can see that really is yet to happen, going all the way back to the beginning of December. Now, this is just looking back to the highs that we saw again from December on, 266. But take a look at the daily time frame. You mentioned the highs that we saw last summer into last fall up around 500. There's a bit of a double top up there that we saw. And then look, the death cross, the 50-day gets below the 200-day moving average. We're just now kind of back to that 50-day moving average here. You can see how the RSI, potentially some room to go. So encouraging for the bulls that are looking for that breakout up and through the range that we just talked about, the one that we're currently forming right now, and this 140 area to the upside. But ultimately, you can see volume's been kind of limited in terms of participation. I did want to point out, just quickly taking a look here at the weekly time frame, you can see, again, that double top around 490, but look at the high conviction trade to the downside. And even here, you can see the well-defined vertical phases, these big red candles to the downside where the market is just lower lows and lower highs on the weekly time frame. And then you can see, again, how we're kind of in this just overlapping rotational. Lastly, right back to where we were into and prior to the pandemic spike. So again, a bit of a roller coaster ride as Roku's gone up to that 500 level, double topped, and now again right back down to 135. But for the most part, the trend's been to the downside. It's testing a key area of resistance to the upside in a market, again, that's been trending lower. Many people see that as, well, potential opportunity either to get short and look for a return to the lower extreme, or wait for a breakout and then ultimately buy that breakout and look for a bit of a trend shift here. So at a pivotal level, to say the least, here right now in Roku on multiple time frames in many instances.
Hey, Alex. Alex, I'm curious how you would trade that given the option to either go short or wait for that breakout. I will say I did check, and the median price target for Roku is 175. So obviously that's a little bit longer term, but analysts ultimately think this is a stock that can't go back to those highs, but can move higher from here.
Yeah, I think it's certainly going to come down to the individual investor and their feeling about the outlook going forward. But tying it into today's story, which I think objectively most would think is a positive development for Roku, and certainly the market is telling us that this morning, alongside some NASDAQ outperformance, which of course is a little bit more of a growth-oriented index. That's going to tie into Roku as well. What I looked at was one that sort of, it does play to the bullish side, Caroline, but it's one that does lead to the fact that we may have some overhead resistance very, very soon. And so what I did is I know that the target date for the earnings event is in the early parts of May. Some traders would be comfortable with that kind of uncertain added volatility element of a binary event like earnings taking place within the duration of their trade. I went ahead and I looked for a duration that expired prior to that event, so we didn't have that next level of uncertainty here for this example. But what I did is I went ahead and I bought a call vertical, meaning is that we're buying one option with a lower strike, a bigger option, and then we're selling an out of the money call against that to reduce the overall cost of the trade in exchange for defined profitability. I structured this so that we buy a strike that is partially in the money, and then sell one that is partially out of the money here with a break even roughly exactly where we're trading. And so if the stock were to fall below 130, which is about $5 lower, we'd be exposed for our full $500 in risk. But if it were to rally through 140, we'd be able to watch this expand going through expiration all the way up to $10, the width of the spread, and it could turn into a $500 profit. If I flip over the charts, this kind of builds on what Ben was talking about. There's this gap around earnings where it goes up to about the 143 level. This corresponds to that middle point that Ben was talking about, one of his consolidation areas. And I know there's a concept within the technical world of filling gaps. And so if we did fill that gap all the way, that would be our max profitability zone for this particular trade. And that was another part of the concept that I tied in here. So break even is roughly where we're trading. It is defined risk, defined profitability with an upside here taking place if it does finish above 140. I know we're also going to look at Penn National as well, Caroline. Quick reminder what the story was on this one.
Penn National expanding its online gaming. It's launching the Score Bet mobile sportsbook, or it just launched it in Ontario today, as well as the casino. So shares, as we said, up almost 7% today. And Ben, I know you said this is another one that's testing a key area of resistance around 45. It's at 44.80 right now. So tell us a little bit more about this chart.
Well, I can understand why the focus is on Penn today, ahead of the March Madness game tonight, and all the anticipation thereof, in addition to the story, as Caroline mentioned. So multiple focal points here for some of these big names. But, Penn's another situation where, again, testing key resistance to the upside in an area of consolidation that's been forming and kind of setting up similarly to what we were talking about as far as Roku and the recent run up there. Now, I wanted to just point out how one of the reasons I like this sort of mindset, or looking at price activity through this lens, these auction market theory concepts and principles, the idea that price kind of goes through these two phases, again, the horizontal, the vertical, and transitions from one to the other. Sometimes it's more well-defined than others, but Caroline, the one thing I really like about it is it applies across all time frames, bullish, bearish type trends. We're talking stocks, bonds, ETFs. I mean, it's a really robust way of looking at and understanding price activity. So here I just sort of identified the range that we're in basically since, if we take a look, the beginning of March here. So over the last 4 weeks, we've been mostly sideways. 45 is the upper extreme, 38 is the lower extreme, and you can see how we have kind of a triple top that we're retesting right now up around this 45 level, and a pretty well-defined lower extreme, bit of a double bottom, a triple bottom if you want to call it. But even as I point this area of consolidation out, you'll see the rotational kind of wave pattern that plays out. work your way to the upper extreme. The bears are getting all bummed out and the bulls are getting excited, but we kind of just continue to sort of rotate through and within this range. But notice here you have the two separate phases of development playing out here on the left half of the screen, the horizontal, which phased into a vertical, horizontal, vertical, horizontal, and then into vertical. And this is just a elongated horizontal phase. But take a look, because this is just the move off the 5172 high that we have up here. But as we dive into this chart, you're going to see that this has been trending lower basically since 142, talking about March of last year. So over the last year, it has been and continues to be trending lower. Here, you have three very well-defined areas of consolidation. This is the most recent one we were looking at. Actually, we were just looking at this very narrow sliver of range here and that move off that 51, 52 level, if you remember. So again, just pointing out here how we're kind of in this range here right now, but you can see again, migration of value to the downside off a V-top kind of pattern that formed here, or at the very least a stall up around this 119 area of value that formed, 142 kind of a V-top type pattern. But I wanted to take a step back and move away from this daily. I don't usually use a lot of moving averages. I kind of just look at a very clean chart with value in this instance, the vertical, the horizontal phases, and migration of value to try and determine trend. But take a look at Penn. You can see this area of resistance that I mentioned, this critical juncture that we're at right now. We're testing the 50-day moving average, nowhere near the 200. We haven't really been near that 200-day moving average since the summer of last year. You can see that trend environment to the downside. And then lastly, just taking a look at the weekly, I want to point out how, well, we talk about, again, the area of consolidation that we're forming right now, and just to kind of look at the weekly time frame. If we were to break out up through 53, 54, we'd be looking for, well, not until taking out 75 do we really start to lose some of this well-defined trend environment we've seen off that 142 level if you're looking at these areas of consolidation that have formed on the weekly time frame. Now, this is a bit of a bigger picture look, but here you can see, again, the spike up and, well, recent pullback. Now, still holding up above that key area, the 30 area. We always talk about the prior areas resistance becoming current support, but we've got multiple areas to watch on this chart. If you're looking at those two phases, the horizontal and the vertical phase, they'll really help you simplify price activity and just kind of see things a little bit more clearly, and sometimes more well-defined than others. But I think this is a robust way of looking at price, whether you're talking stocks, futures, across the board here. It's really applicable.
So Alex, Ben said, talking a little bit bigger picture, was looking at that $75 level. I know that the median price target is 62, so analysts don't see it going up that high. But when you look at this stock, how do you think about trading it?
Yeah, again, I'm going to take a very, very eerily similar approach to what we just looked at in Roku to this particular one. I think although the companies are vastly different in terms of what they do, they're largely very similar companies in terms of the factor they find themselves in, more of this growth kind of accelerating new age style company in terms of where things are transitioning from to where they're going. And then also, you have to look at it in terms of another early May earnings event on the horizon. And so taking the similar approach of trying to avoid that earnings event. Nothing wrong with trading into it, just know that there's maybe added risk associated with that binary event. And so what I did is went out to the April 29th expiration, which is just shy of that May earnings event, and I'm buying the 43.46 call vertical. So very similar style trade, however, a little bit smaller in terms of the notional risk and the notional reward, as it's a lower stock price, but also has more strike selection here available with $1 wide strikes as opposed to $5 wide strikes in the case of Roku. Similar risk-reward parameters in the sense that I looked for something that I could get a ratio of 1-to-1 between the risk and reward. In this case, it's a $3 wide spread trading for about $1.50, which is exactly half the width of the strikes. And the break even is roughly where we're currently trading. And so if we took that $1.50, that means we have $150 in risk for what would be possibly $150 in profit, max profit potential. The break even is $44.50 with the stock trading about $44.70, so pretty much coincides with where we're trading. Ben had talked a lot about that 45 mark being a critical point of resistance. So one, if it runs into that resistance there but kind of continues to test it, this could expand to $2, as that would be $2 in the money for this spread as we approach expiration. but also if it does break out, we could still get a little bit of that performance above that level up to 46, which would be our max profitability zone. So one that's maybe playing for a breakout, but nonetheless just hoping for not a resumption of the downtrend that we have seen for the greater part of the last few quarters in Penn National. So $1.50 in risk to make $1.50. Pre-earnings trade, again, buying a call vertical here in Penn National. I want to thank the host of Futures, Ben Lichtenstein, for joining us here this morning. Always a pleasure. Make sure you check out his show every single day at 8 Eastern, 7 Central here on the TD Ameritrade Network. We're going to take a short break, though. Caroline sticking around. Be time for FOMO, and I'm excited for this conversation. We're going to talk about the Twitter story, which, of course, is Elon Musk making maybe a little bit of a kind of a behind-the-scenes acquisition here of Twitter, building a stake of personal investment within the company. We'll talk a little bit more about how and why right after this. We'll be right back.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads, like counters and diagonals, are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on thinkorswim for the full Options for Volatility course and a whole lot more.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Welcome back to Next Gen Investing. Mounts Coffee, joined this morning by Caroline Woods, in for our regular co-host Jenny Horn. It's time for FOMO, and a really interesting story here breaking out on the Twitter front. Caroline, talk to me a little bit about some of these details here. We got kind of notable CEO, billionaire Elon Musk, billionaire being maybe a little bit of an understatement, as it's closer to, let's say, $300 or so billion. But Elon Musk making some rumblings here. He's been chatting about this on Twitter, but now we see some details. He's been acquiring some shares behind the scenes.
You think billionaire is the understatement? I think notable might be the understatement. It's Elon Musk, I think, is whatever the next level of notable is. But yes, he's taking a 9.2% stake in Twitter. That's almost 73 million shares, valued at about $2.9 billion. So given his net worth, I think it's more around like maybe $270 billion. This is just a very small drop in the bucket for him, and it is considered a passive stake. It's below that 10% key active threshold level, but there's speculation, Alex, that this is just the beginning, and that it could lead to a more active stake, a more aggressive role, even a potential buyout. And as you made reference to, it really shouldn't be that big of a surprise, because last month on Twitter, Musk was saying that he was giving serious thought to creating his own social media platform. He has criticized Twitter, saying it doesn't enable free speech. So this might be an easier or cheaper way of building a platform from the ground up. We know that Trump's Truth Social platform has proven that it's very difficult given the issues that they're having on that front. And I should note that Digital World Acquisition, the SPAC that's doing Trump's social media platform, down almost 12% today, likely on this news. But you know, Elon Musk already has 80 million Twitter followers, so this 9.2% stake could just be, you know, the beginning. We might hear more about it. He's also been seeking to end SEC oversight of his tweets because of, you know, past issues, saying that they're trying to trample his rights for free speech. So this kind of plays into that as well. So very interesting story, and the fact that Twitter shares up 30% today. Good day to be a Twitter shareholder, especially if you bought, you know, in the 30s, you know, last week.
No doubt about it, Caroline. I think that's a great summary. I'm going to add a couple thoughts here from my perspective, then we'll look at a quick trade illustration before we move on to another Elon Musk story, and we'll talk some Tesla. But I want to talk about kind of a couple of the things. So one, we've had Elon Musk being fairly open about how he feels about this space. So it's not unknown what he potentially would do with some sort of acquisition or controlling stake in the company. So to see the company's performance to the upside in the event that that were to happen might tell you a little bit about what the market feels about that plan. I don't know, maybe that's just, you know, maybe people just think anything Elon Musk touches is gold, or it could be a little bit to say that maybe the direction Twitter's been going versus the direction Elon Musk talks about, one is seen as maybe a greater market, you know, potential down the line. Again, this is just kind of commentary, no meaning, it's somewhat speculation. I'm just trying to put meaning to what we see. You also mentioned the reaction in terms of the former President Trump's, you know, association with, I believe it's Digital World Acquisition Group or Truth Social. Well, again, this is showing two things. One, I think it's a great point. It might be easier just to take over something and change it the way you want to, as opposed to try to build it from the ground up. And then all those who are trying to build that maybe are arguably same sort of alternative are not going to, that won't be necessary if you take the main player and you change it. So I think there's a lot of interesting kind of domino style effects that could take place from this. And you may not even have to see more stake from Elon Musk. Just simply this move showing that he would possibly do it could be enough to make some major changes over at Twitter on its own. So very interesting. But on a trading front, just here real quick, Caroline, I want to talk about an example. The stock's obviously making a massive move. Some are going to feel comfortable kind of piling on that momentum. Others maybe not so much. So what I wanted to do is sort of find something in between. And this is a neutral to bullish strategy in which we go out, we're avoiding that earnings event at the end of April. So we're going to the April 22nd weekly expiration, and we're simply just selling a neutral to bullish put vertical at the 45 strike, defined by the 44 put. So it's $1 wide, looking to collect about 30 cents on the dollar. So can make 30 bucks on $70 in risk. Pretty standard risk profile here, the elongated Z. So not a really uncommon strategy, one that we talk about quite a bit. And of course, this would be neutral to bullish. So if you don't feel that way about a company like Twitter, this strategy, of course, wouldn't fit that desired outcome. But we're going to take a very brief pause in the Elon Musk conversation, take a short break. When we come back, we're going to continue it, but this time a little bit more about Tesla after they announced their deliveries over the weekend. We'll unpack those numbers and more. Stick around. We'll be right back.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Welcome back to Next Gen Investing. I'm Alex Coffey, joined today by guest host Caroline Woods, in for Jenny Horn. And Caroline, as promised, more Elon Musk, and this time in the form of Tesla. Tesla roaring higher once again, kind of a delayed reaction to these numbers, but maybe there's more to it. Talk to me a little bit about this Tesla deliveries print that we saw over the weekend. I'm sure you got some notes on what the analysts have to say as well.
So Alex, it's interesting, Tesla shares up 5.7% right now. You said it was a little bit of a delayed reaction. That's because Tesla delivery numbers did come in shy of many estimates, delivered about 310,000 vehicles in the first month of the year, or the first 3 months of the year, sorry. That was an increase from the previous quarter's 309,000, and also a sharp jump from the year ago period, almost 70% growth. But Wall Street was looking for as many as 320,000 deliveries. We know Goldman Sachs was looking for 315,000 deliveries and warned on Friday that there could be some downside to that estimate because of the Shanghai plant closure. I remember you calling them out on Friday for kind of hedging their bets and not just sealing the deal with a lower estimate. But over the weekend, Musk tweeted that it was an exceptionally difficult quarter due to supply chain interruptions and China's zero COVID policy. And on that note, Tesla's Shanghai factory, the Gigafactory, had to remain closed today. It was initially just supposed to be locked down, or because of those COVID lockdowns, it was initially just supposed to be closed from Monday through Thursday of last week, but those continue. Regardless, though, shares up 5.7%, and I think you have to really think about this. Despite all of those headwinds, Tesla has performed so well in the face of especially the chip shortage, and the fact that they did grow their deliveries from 309 to 310,000 quarter over quarter, still a pretty impressive feat given the current environment, Alex.
No doubt about it. And it was a little bit almost uncharacteristic of Elon Musk to even say there was a little bit of shortcomings or some problems. He seems to be the ever optimist CEO, always finding a way to spin things, like when he threw that shot put like stone at the Cybertruck, and somehow that ends up being like viral gold and bringing all the attention in the world to the Cybertruck. So, you know, interesting, but Tesla very much kind of encapsulates another part of the market, which is this, you know, feverish stock momentum, the call buying, the meme stock frenzy. Tesla sort of in its own way caught up in that environment as well. So maybe a little bit of that factoring into things as well. But you mentioned 310,000, roughly in line, maybe a small miss, still an impressive number nonetheless from the company over at Tesla. So we'll see how things shape up. Pushing back towards almost yearly highs now, and actually high on, up on the year. So Tesla, full recovery after what was a shaky start. Very, very interesting. We'll see how things shape up. We got earnings on the horizon as well, so we'll probably hear a little bit more from the company in the coming weeks. You can kind of see that trend from those previous highs. We're getting up near that. Stock market technicians and bulls maybe looking for a break above that to kind of cancel out what's been this very, very wide range, but also still technically a downtrend for the stock. So we'll see if that happens. But we're gonna take a short break. When we get back, it's time to wrap things up with Under 30. Ken Rose is gonna stop by. We're gonna talk a little bit about Dave & Buster's. So with us still, hey, we're crossing our fingers, we're knocking on wood, but maybe COVID for the most part in the rear view mirror. We're learning to live with it. Does that mean we go back to Dave & Buster's and have some fun? We'll find out. Stick around.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Welcome back to Next Gen Investing. I'm Alex Coffey alongside Caroline Woods. Caroline, market itself pretty strong still. You see the Russell peaking up above the unchanged line, but we're going to shift gears here. We've been talking a lot of big tech, a lot of these big stories. We're going to talk a little Dave & Buster's, and I was thinking about it during the break. I'm not sure I've ever been to a Dave & Buster's. And, granted, unless I, have children at some point here in the future and they want to go there, I don't anticipate going to one. How about yourself? Any experience at Dave & Buster's, Caroline?
I'm shocked by that because I have not only been to Dave & Buster's, I've been there a ton of times. I have a much younger brother, so he sort of grew up with a sister who had a license that could drive him there. But no, I'm shocked. I mean, I don't play anything there other than skee ball, but I have been, and I can vouch for their chips and cheese. I remember we used to go watch the Sabres games there, and they had good chips and cheese. But, Dave & Buster's was a company we talked about last week because it missed on earnings and revenue, but gave a much more optimistic forecast for how things are turning out or looking this year. So let's bring in Ken Rose. He's a contributor here on the TD Ameritrade Network. Ken, tell us about what you're looking at here with Dave & Buster's. Ticker symbol play, but it's down 3.4% today.
Right. Well, one of the things that kind of jumps out to you when you look at the chart for Dave & Buster's was the huge move that it took after that earnings announcement. And again, that was based with regards to forward expectations, but it has been fading since then. And one of the interesting aspects is with their most recently completed earnings announcement, they basically came out with their 2021 annual report, and they actually only fell about 3.5% short of pre-COVID levels. So that actually isn't too bad considering some of the devastation that COVID has created up to this particular point in time. But another interesting aspect recently Play has come out and given us some information with regards to their performance during the first 8 weeks of 2022. And what's interesting about that is comparative store sales have actually increased 5.4%, and also walk-in sales have also increased by about 9.1%. If you take a look at that and you mix that with the fact that special events comparative store sales are still down by over 40%, as the COVID thing, as we continue to get over COVID and those special event sales are able to pick up, and Dave & Buster's could be in a situation where they could be creating revenues and earnings per share that could be the highest in their history following the COVID coming out of the whole COVID situation. So it'll be interesting to see how they continue to perform and how they continue to improve as we come out of the COVID environment here, Alex.
Ken, first off, thanks for joining us. It's always a pleasure. I got to say one thing quick, then I got a question for you. Dave & Buster's up there with Petco is just all-time great stock tickers describing the business play. It's just great alongside Woof for Petco. But talk to me a little bit about this company and kind of the concept of it's all the way back. So we had this time, and I have a 5-year chart pulled up here, Ken, for Dave & Buster's, and certainly it was struggling a little bit for the years leading up to the pandemic. Then you see it just go off the cliff like so many things in the peak of the uncertainty, and it slowly but surely built itself back up. But we can't make up for all that lost time. I imagine there were things that had to be done to, keep the company intact during that period, and we just don't get that time back. So I compare this to something like a cruise line that is nowhere near where it was pre-pandemic. How is it that we're all the way back here in this stock, and you're talking about numbers that are still down from those pre-pandemic levels, Ken, yet we can't make up for that lost time, I guess is my question.
Right. Well, I think one of the key characteristics when we're looking at the chart is not only the price of stock, but also the price of stock in relationship to the earnings per share. And currently, Play is trading at a price multiple of about 21, which is still a little bit lower than the average price multiple on the S&P 500, which is currently sitting at about a 25. So from that standpoint, the price appears to be fair in relationship to the anticipation that the pent-up demand is going to benefit this stock in a potentially big way, particularly when you're looking at a potential increase in revenues related to special events. This is also a company that has dedicated themselves to innovation, growth, and value. And one of the aspects with regards to value is they recently partnered with UFC, and what I think it's called is UFC and MMA in order to broadcast all of those fighting events in all of their venues. So you have all those events in all of their venues as well. So how does that pan out though with regards to their clients? So I haven't been to a Dave & Buster's. I don't know that I really like MMA that much, but hey, if you got that along with everything else, then perhaps that could be a good draw for them.
Hey, Ken, you mentioned that COVID is one headwind that could be kind of on the back end, at least that's the hope, right? But another headwind that so many companies have had to face is inflation. How exposed to operating cost inflation is a company like Dave & Buster's?
You know, Karen, I think you bring up a great point there, particularly if we look at their most recent quarter. Their most recent quarter, their operating margin actually dropped by about 50%. Their operating margin dropped down to about 7.48%. If you look at the previous quarter, their operating margin was sitting at about 13.9%. So that would be a little bit of currently an area of concern. However, if you look at their last quarter, they did generate they were very successful with regards to generating cash. I believe in the last quarter they generated over $80 million of cash. They took a fair amount of that to pay down their credit, and with that pay down, they currently have about $25 million of cash. Plus, they also have an additional $492 million of credit that's available to them. So from a financial standpoint, it looks like they're sitting in a fairly stable place at this particular point in time.
Ken, I would add to that too. I mean, if there is continued inflation, we see a plowback in consumer spending. Doesn't matter how badly we want to get back out there. Maybe we're just not going to be able to, as we have to, set aside more cash for our expenses. So maybe getting hit in both ways there. But I think the moral of the story here is MMA, exciting partnership. I'm a kind of casual fan of that. I'm not sure it gets me to Dave & Buster's unless there's a special event. So you get me there for a special event, maybe that'll be it. So it sounds like we got to get some of those back on the uptick side for a company like Dave & Buster's. But Ken Rose, looking forward to more from you throughout the week. Always a pleasure, and have a great rest of your day. Caroline, thanks to you as well for filling in for Jenny and joining us here on Next Gen Investing. That's going to do it for myself, Caroline, and Ken. Thanks as always for tuning in to Next Gen Investing. Looking forward to more market coverage throughout the day with the watch list coming up next. We'll see you tomorrow.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then Watch List. When the default list appears, select the name box, then Create Watch List. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watch list, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Good afternoon. Welcome to the Watch List. I'm Nicole Petalides. It's 2 p.m. Eastern Time. We're coming to you live from the New York Stock Exchange. Thanks for being with us. Quick look here at the markets. 2 hours left in the trading session. You can see we do have green across the board. We've had back and forth action throughout the day, but we are picking up some momentum today right now. In fact, we could see a higher close like we did on Friday. Look at this. So the Dow right now is up 42 points at 34,860. The S&P is up 26 points at 45.72. The Nasdaq up 1.7%. So tech really doing well, 15,109, and the Russell fractionally higher. In today's top stories, CEO of J.P. Morgan Chase, Jamie Dimon, releasing in his annual letter to shareholders and noting potential risks facing the markets. Dimon believes that the combination of high inflation, U.S. economy rebounding from COVID-19, and Russia's invasion of Ukraine have created unprecedented conditions for U.S. markets. Dimon said they present completely different circumstances than what we experienced in the past, and their confluence may dramatically increase the risks ahead. Dimon saying J.P. Morgan and investors should prepare for potential negative outcomes. To take a look at all the top stories here, Ben Lichtenstein is with us, host of Futures on the TD Ameritrade Network. Good to see you, Ben. So obviously some concern from Dimon. He actually talked about a possible $1 billion lost as a result. Amazing. We've had this back and forth action. I mean, how do you think the market is digesting all of this when you take a look at the technicals after really a great 1 month of trading?
Yeah, fairly well, to say the least, Nicole. Good afternoon. Watching the NASDAQ, the tech shares, which are leading today, currently trading up over 1.5%, and really just a swift move to the upside on the open and follow through throughout the day for the most part. The NASDAQ, again, as mentioned, the tech-heavy futures back up above 15,000, and this is in continuation of the move that we've seen off the March lows. As you mentioned, this wasn't just today or Friday. This really started off down around lower levels, 12,942 to be exact, and now, as I mentioned, again up and through the 15,000 level. This is what investors were looking for after the month of March. We took out those February highs, and again, we were waiting to see if we would get some follow through. Now, I'm still keeping an eye on that 15,400 area, but here you can see the move off the January highs, again, as mentioned, down to the March lows and the rally back that we've seen. I wanted to just take a step back from this intraday, this hourly look, and point out that, well, it was back in November that we topped out, and it was the beginning of the year that we started selling off. So again, recently down to below 13,000, short-lived though, as you can see. We're back up above the 50-day moving average as of recent, and it's not just the NASDAQ above that key level, the Dow, the ES, and the Russell, all four of the majors. But the focus today on the NASDAQ, Twitter, again, being one of the focal points here after Elon Musk took an over 9% stake in the company. Also, we had Tesla, also a focal point. Here's tech. Here you can see the NASDAQ, the futures getting back to the 200-day moving average. Tesla, also a major focal point here today, as mentioned again in terms of those record-setting deliveries. But, you know, it's Pinduoduo, it's Baba, it's JD.com that are actually leading the way for the NASDAQ higher today. Again, above key resistance recently and holding above. I just want to point out here as we take a look here with the NASDAQ rallying back, look what's happened to the VIX. Volatility has just fallen off from the upper levels that we saw back in March. We took out the Feb highs up to 3650, but look at what's happened here now to begin the month of April. We're already taking out the March lows. And here's just a quick look, Nicole, at how we had been seeing a series of higher highs and higher lows. Well, look at the move lower here. You can see the significance thereof. And again, volatility just coming off as the indices have really rallied back here to begin the first full week of the second quarter and the second full trading day of the quarter.
Right, and you know, I mean, I think people are excited because you've seen several weeks of gains. We have earnings next week, so they have a lot to be excited about. On the other hand, there is really a lot of evidence of slower growth and maybe even a slowdown, as has been displayed to us by the yield curve. Tell me a little bit, because I know you're watching the 210s, but there's so much when you take a look at the yield curves multiple. There is. It's raised many heated and hearty discussions in terms of whether or not we're going to see some sort of a recession to come in the months ahead. But you know, I think in terms of the NASDAQ rallying back, what's been most notable is the fact that it has occurred with rates on the rise, which, keep in mind, that was the headwind since the beginning of the year, in addition to geopolitical tensions recently since the beginning of March, end of February, kind of factored in as well. But rates on the rise have been the major stronghold here in terms of some of those growth names that make up the tech-heavy index. Now, speaking of rates on the rise, I just wanted to point out, here we're looking at the bonds on the left, the 10-year on the right, so Treasury futures, and that's the culprit. They've been selling off. So again, investors have been selling the futures, and they traded all the way down to 146. The bonds did. The 10-year traded down to just below 121 to end the month of March. And since then, though, we've been a bit more sideways, just with a little bit of a hint of a bid coming back into play. You can see we're holding off those March lows. I wanted to remind everybody that we should be keeping an eye on the shorter end as well, because this is sort of tying into the 2-year versus the 10-year, the inversion there, and what we're seeing as the shorter end more closely tied to the Fed. It's been accelerating at a rapid rate. And again, the futures to the downside, but take a look, because when we're talking about futures to the downside, Nicole, you know very well we're talking about rates to the upside. Here I've got the 30-year on the left, the 10-year on the right. 30-year recently to 2.64, but you can see again with the futures rallying off those lows how rates have come back off. So we're back down below 2.5 on the 30-year. You've got the TNX, the 10-year, got all the way up to 2.5%, but back down now to 2.4. So a significant move lower there. And again, but keep in mind, though, the NASDAQ was still rallying throughout the month of March with this run-up that we saw in rates. Again, the TNX and the TYX here. But take a look here. Again, as mentioned, the NASDAQ managed to kind of muster up some strength off those lows that we saw earlier last month, and you can see how that occurred even with rates on the rise. But yeah, I think this is going to be a focal point for many in the next weeks, in the coming weeks, in the next couple months here, in terms of ultimately what does a yield curve inverting mean as far as indicating that we'll be in a recession. What is it? I think 18, 22 months in the future. But you know, I've been hearing from a lot of our guests that it's more being entrenched in this kind of negative inverted conditions rather than just kind of touching on it and then coming off. So something to watch here in the coming days and weeks, that's for sure. Yeah, without a doubt. And historically, there's nothing exactly like what we're experiencing right now. And to your point, it's touching, it's not entrenched. There are those who would argue you take a look at the 3-month, not the 2-year. There's so many discussions, as you said, Ben, and we'll have all of them, I'm sure. Thank you so very much, Ben Lichtenstein, host of Futures of here on the TD Ameritrade Network. Thank you for a look at all those stories. Joining us now is Eddie Gaborik, Key Advisors Managing Partner, joining us to talk about his market outlook. Hi, Eddie. Good to see you. Your thoughts after we saw several weeks of gains. The S&P, in fact, has had a great 4 weeks. 1 month, it's up almost 5.5%. Now what?
Look, I think this is nothing more than a bear market bounce. And in bear markets, you get these massive, violent bounces that happen really quick. And I think it's great because it gives investors a second chance to reassess risk and to consider potentially taking risk off the table. As I look at the setup for this next quarter, this quarter that we're in right now, I don't like the setup at all. I think we are turning, this is going to be a bear trap that's going to bring investors in. And just as fast as it went up, in my opinion, it could be down. One thing I'm going to be watching very closely as earnings start to come out next week is the guidance they're going to give moving forward, because I think you're going to see a lot of revisions to the downside because of how slow the economy's growing. And the other thing, too, is the Fed hasn't raised rates quite a bit yet. They're talking about a 50 basis point hike next month. If they do that during this slowdown, I do not see how risk assets do not correct. So unfortunately, I'm about as cautious as you can be right now, even with this bounce, because again, I think we're basically in a bear market right now, and we're not going to get out of it, in my opinion, until the Fed pivots and goes back to loosening versus tightening.
Well, or how about loosening? Well, come on, Eddie, that's how about just stopping tightening?
Well, that'll be the first step, but the million-dollar question is how low does the S&P and the broader market have to go down before they pivot? The bottom line is they are so late to tightening that now they're forced to tighten at the worst possible time economically. And look, the consumer's getting hammered right now with inflation. I don't see how anyone thinks that the discretionary spending numbers are going to be anywhere near where they were this time last year. And that's why we're so cautious. There's just not a lot of positives right now. And the last thing I want to hit on, the one positive has been real estate. With the 30-year mortgages spiking the way they have here recent weeks, that could ultimately start to bring some cracks in the real estate market. And then we'll have a whole nother set of problems hitting us right now. So it's a strange time period. There's a lot of risk out there. I just think it's prudent to be cautious at this time.
Yeah, I saw mortgage rates zooming past 4.5%. You know, the tightening, raising rates hasn't happened for 4 years. So are you saying that you might have to wait 4 years to see the markets turn around and have a rally that you believe in? That doesn't sound right. Is that right?
I think the Fed is going to raise rates like they say, but I think the market is going to go down pretty fast because I think they're probably miscalculating how slow GDP actually is. And once they make that announcement that they potentially are pausing their tightening, more than likely it will be kind of in line when we've had a bottom in the market. So I think there's probably going to be some amazing buying opportunities later this year. I just personally would not be doing that in high-risk assets right now going into one of the toughest quarters for comps that we've seen in our lifetime.
So here's the thing, Jamie Dimon talking about everything that's going on in the confluence of factors. We're not worried about our direct exposure to Russia, though we could still lose about $1 billion over time. So tell me a little bit about that. And, it sounds like you agree with him to a certain extent. This, as rates are on the rise and profits are decelerating, we're going to start earnings season next week.
That's exactly right. I mean, the deceleration of GDP and earnings while the Fed is tightening, while we have geopolitical issues that have caused commodity prices like corn and other things like that to stay really high, is why when you look at all the macro dynamics that are facing us right now, there are a lot of headwinds. And I think for me to ignore that and not bring that to our clients' attention would be a big problem. So we have absolutely pivoted in our portfolios. We pretty much own the opposite of what we owned this time last year because we think the environment is the complete opposite. Last year, growth was accelerating, inflation was under control. Now we have the complete opposite dynamic. And so I don't know how you can own the same thing when the environment is quite different.
Yeah, and you have, exactly, there's nothing to compare exactly what we're experiencing here at this time. Eddie Gabor, nice to see you. Thank you always. Eddie Gabor, Managing Partner at Key Advisors. Thank you. Later this hour, Tesla reported a record number of deliveries in the first quarter, and we'll discuss those numbers along with Elon Musk's purchase of Twitter shares with Gordon Johnson. I'd like to hear what he has to say. And DraftKings jumping after the company made an announcement for expansion plans. Michael Keeley will fill us in on all the details there, and our panel is ready to take a look at those home improvement names, Home Depot and Lowe's, and what they could signal about the housing market overall. But up next, many investors are concerned about the Fed, and our next guest says there's some bigger risk for the markets coming up.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust the time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes.
Oh,
away.
wow, I gotta take off. Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see ya. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Welcome back to the Watch List, live from the New York Stock Exchange. I'm Nicole Petalides. Thanks for being with us. After back and forth action throughout the day, you can see all green across the bottom of our screen here. Let's take a look at the biggest movers in the market right now. Watching shares of Twitter. Twitter soaring after an SEC filing shows Elon Musk has taken a 9.2% passive stake in the social media platform. Musk is now the largest outside shareholder in that company. The buy comes after Musk polled his Twitter followers about whether the platform adheres to free speech principles. We'll discuss this and Tesla later in our show. UBS upgrading NEO to a buy from neutral, lowering its price target, though, to $32 from $42. While NEO's sales volume growth has slowed with aging products, the analyst notes that there will be 3 new model launches this year, which could rival the sales and really move those sales forward and accelerate. The stock is down 44% in the last 12 months. Now, here's a look at Qualcomm announcing that it has acquired a Arriver business from SSW Partners. The deal will enhance Qualcomm's ability to deliver open and fully integrated advanced driver assistance system solutions to automakers and to suppliers. The move is also meant to help better position Qualcomm for its autonomous driving technology. Starbucks announcing it's going to suspend its share buyback program to invest in its future growth. This move comes on the first day that Howard Schultz is back as CEO. He's interim CEO currently. The coffee chain had previously committed to spending $20 billion on buybacks and dividends. Take a look at Bitcoin today. Right now, 45,340, down 2.6%. like to get right to Dan Irvine, principal at 3 Summit Investment Management, to get your ideas here. I just finished saying that rates are on the rise and profits are decelerating. I mean, would you agree with that? You tell me.
Absolutely. Nicole, thanks for having me on. Inflation is definitely having an effect on profitability for companies. And, we're expecting, with wage inflation, as we've seen it, we expect margins to come down significantly. And that dramatically impacts our outlook on economic growth in the coming quarters.
So, you and Jamie Dimon are talking about some of the, you have inflation, you have all these disruptions. Of course, he said that they're not directly exposed to Russia, but that the slowdown could affect them greatly. And I'd be curious to see if other banks are going to come out and say much of the same. What's your economic outlook here?
We're most concerned about economic growth. We think that inflation will be a catalyst towards that. And we expected inflation to top out around this quarter, maybe next quarter. I think the biggest impact that the geopolitical situation has had is that it's pushed that out a little bit. So I think right now there's a very high risk that growth will come in below consensus expectations, which could be a catalyst for further moves down in the markets.
So what I thought was interesting, how you said underweight stocks, underweight bonds, overweight precious metals and cash. Tell me a little bit about the overweight play.
Yeah, we like precious metals because of the economic regimes that we think are most likely for the quarters going forward. Right now, we're in more of a stagflationary environment with growth decelerating, and obviously inflation is still moving up. And history shows that precious metals do well in those environments. And we actually think that later in the year, we will see a topping in inflation and possibly start to see inflation come down, which is deflationary. So we think it's a great place to be. And an additional benefit to precious metals is that they are very effective at lowering volatility of an overall portfolio. So we think a 5 to 10% allocation to precious metals is a good play right here.
Yeah, and are you looking at something like GLD and silver, or are you looking at
we like miners,
through
GDX.
stocks or what? Mm-hmm.
Yes, we like ETFs, SLV for silver, GLD for gold, and GDX for miners.
Oh, I see. So GDX for the miners. Yeah, GLD and silver, I had on my mind. That being said now, when it does come to equities, you're not saying get out all the way. You're just saying underweight, right? So are you looking at utilities and what else?
Yes, our favorite play right now, we think lowering your allocation to broader indexes like the S&P 500 just because of their overweight positioning to technology, and going overweight individual sectors is a good place. So we like XLU, XLP, which is consumer staples, and XLV, healthcare as well. How
about energy? I think you had energy, or no?
We do like energy. We've liked energy for a year, and we just think that the geopolitical situation has extended that trade. So we think that's great diversification and should be added.
But you did mention healthcare. I hadn't seen that one earlier. Why healthcare? Why now?
Well, it moves along with traditionally defensive sector plays, and I think you're seeing it right now with XLU specifically. People tend to think that defensive sectors are more of a rate-sensitive play, but you've seen interest rates heading up, and XLU has outperformed the S&P and all sectors except for energy. So defensive sectors, what they're very effective at is covering for as investors start to realize that growth expectations are going to come in below expectations. So it just confirms our growth outlook.
Mm-hmm. And, you know, as the Fed is raising rates now overall, is there an international play or anything like that? Or is it just going to be somewhat a cautionary tone around the globe for investors?
We're cautionary around the globe. We have been underweight international, and given the geopolitical situation in Europe, that remains, we remain underweight international.
Right. Yeah, understood. And then here at home, you mentioned that this is likely a bear market rally, right? You can correct me if I'm wrong, but that also recession, is that something that you see as how much of a possibility is a recession?
Well, you know, it's interesting. If you look at the employment numbers that we got last week, they were very good. They're just a testament to how quickly we've recovered from the pandemic lows. But in employment numbers below 4%, combined with inversions in the yield curve, in the longer end of the yield curve, those are prerequisites for future recessionary GDP prints. So we think the risk of a recession later this year or early next year is very real.
Oh, Dan, that's tough. I mean, I understand what you're saying, and I understand the premise behind it. Investors don't love that. That'll be tough to stomach. Dan Irvine, nice to see you. Thank you very much. Principal at 3 Summit Investment Management. We appreciate your insight here. Thank you.
Thank you very much.
Coming up, Tesla reported record-breaking number of deliveries last quarter. Was it good enough? Our next guest has plenty to say on this. We'll take a closer look.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim by TD Ameritrade.
Technical traders, the Chartmaster is in the building. Trends, support and resistance, key patterns, and technical indicators. The Chartmaster has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to the Watch List. I'm Nicole Petalides. Glad you're with us. This should be an interesting segment. I'm looking forward to it myself. I'm live at the New York Stock Exchange, and we're talking about Tesla. Tesla delivered over 310,000 electric vehicles in the first quarter. There were certainly lots of market challenges, but let's talk about this with Gordon Johnson, CEO, founder of GLJ Research. Thank you so much for being with us. Now, I will say, Elon Musk talked about the exceptionally difficult quarter. He talked about supply chain disruptions and, of course, what's going on in Shanghai with, closures and hiccups over there. Not good enough? I mean, you're notoriously thinking that Tesla's overvalued, right?
Yeah, absolutely. I mean, so let's just talk about it. So the street estimate going into the quarter, FactSet, was 317,000 cars. They delivered 310,000 cars in the first quarter. In the fourth quarter, they did 309,000 cars. And you guys had a popular analyst on Dan Ives who was saying they were going to do as high as 358,000. So the number was clearly a miss versus consensus, a miss versus Dan Ives. And the RBS analyst, I think, was at 326, and the Barclays analyst was above 320,000. So it was a miss. But let me put it in perspective. Tesla is currently valued at nearly every other automaker combined. They're valued more than everybody else combined. Toyota sells about 10 million cars per year, which breaks out to about 3.5 million cars per quarter. Tesla just sold 310,000 cars per quarter. So Tesla is valued for tremendous growth, which means every single quarter, they need to see incremental growth to justify the valuation based on our calculations of roughly 60,000 cars. And they grew cars this quarter by 1,000 cars. So I think this is a big disappointment. And I think anybody saying otherwise is just not facing the fact.
Right. And so as we look at this, so this is a big disappointment. What would you like to see differently done? Because, you know, they're not able to resume production now. We know in Shanghai that is closed once again. They've been closed for 1 week, and they're losing on production each day. When you make the case, what is the pros and what are the cons of Tesla here?
Right, but I just want to highlight one thing I left out with the deliveries. They changed the definition of deliveries. They left out verbiage on where they said a delivery means you transfer the car to the customer and the paperwork is signed. They left that out this time. We think the apples to apples deliveries, we think the real number is much lower than what they reported. And we believe the street needs a definition on what that change in verbiage is. Listen, it's similar to Elon Musk's investment in Twitter today, right? So we know that as per his disclosure, he crossed over the 5% mark 10 days after you're supposed to report that. You're supposed to publish a 13G or 13D. He didn't do that until today. So clearly, in our view, he violated securities laws. We'll see if the SEC steps in. And in addition, he filed a 13G, which means he's a passive investor, versus a 13D, where we know after he crossed over 5% ownership, he did a Twitter poll asking if Tesla is applying freedom of speech correctly, and he said the results were going to be important. That suggests clearly he's seeking an activist position, which means he should have filed a 13D, not a 13G. This will be another clear violation of securities laws. So there's a lot of hair here that I think people aren't looking at.
Unless he changes it. Unless he changes
Correct.
it.
I mean, but
don't know.
if he
It does
changes
say
it,
passive right now. It does say
but
passive.
he was supposed to file. He was supposed to make that filing March 24th. Filing that 10 days late is a clear violation of securities laws. But to your other question, yep. I'm sorry. Go ahead.
Well,
to your question of the positives and the negatives. Yeah. So I think the positives of Tesla are they have a gullible shareholder base that does not look at financials, that does not read the 10K and 10Qs, and is enabled to be fooled by things like, you know, changing the definition of a delivery by, keep in mind, Tesla, right before the quarter end, 3 days before the quarter end, or roughly 4 days, their head of IR sent out a quote-unquote consensus estimate. It brought the consensus numbers down. People were taking their numbers down at the end of the quarter, which allowed them to, you know, come closer to what the number was. And in addition to that, they changed the definition. And in addition to that, this Dan Ives, the analyst at Wedbush, who came out and said they were going to beat by 15%, had the lowest estimate on the street, roughly 275,000 cars delivered. So his number brought down the consensus number. And despite all that, they still missed. So those are all negatives. The positives are their investor base. But I think they're losing share in China. They're losing share in Europe. And the problem is, look, Shanghai is down. We think Shanghai could be down another 6 days. We think that's significant risk to their 2Q numbers, their 2Q margins, because the Shanghai cars are the highest margin cars, but also their 2022 numbers. And we think as the street adjusts those numbers down, but more importantly, you have roughly 10 guys in China selling 10,000 cars every month. So now you're having Tesla's market share eaten away significantly. So I think this hyper growth story is eroding.
Okay. So, I mean, there's no doubt that, you know, it's been a real soaring kind of company. you know, when people look at it, is it overvalued? Someone like Dan Ives, I think, has a $1,400 target. So while he may have been on the lower end of the street as far as deliveries, he's still a big believer in the company. Whether he's right or wrong, we'll have to wait or see. But so far, he's been very right as far as the price target and also, for the most part, the deliveries. When you say they changed the definition, did they just not put that part in about that it has to be delivered and signed by the customer? Or are you saying you're using the phrase change the definition? Did they actually change it, or did they just leave that sentence out and you just can't find it?
Well, no, they left that piece out. And we went back and looked at every single delivery report every quarter,
Right.
and that verbiage was in every single delivery report going back to 2Q17. So there's nothing, in our view, Tesla does that's unintentional. We don't know the answer to this. We posed the question to Tesla IR. They've never answered a question of ours. They've never taken a call of ours. Full and fair disclosure, another thing maybe for the SEC to look into.
Okay, so
But,
I
yeah,
guess
so
I'd be
I think this needs
cautious
to be
to
answered.
say that they changed the definition only because if they omitted something versus actually changing it, I feel like there's some sort of real small difference, but maybe a big one. What do you think of the stock split idea?
Yeah, so if I sell you a pizza and it has 4 slices for $10, are you going to pay me more if I cut that pizza into 8 slices? Listen, this is something,
But that's
you know,
what they do with every company. It's not
Right,
just
we're
Tesla. I mean, all stock splits are that, right?
Right. It means absolutely nothing to the fundamentals, to the operation of the company. It's absolutely meaningless. And I'm rereading the book Reminiscences of a Stock Market Operator, and it's a great book, you know, from the 1900s, one of the greatest stock market operators in the early 1900s. And there's a chapter in the book dedicated to stock splits, and it says, you know, when companies are trying to boost the price of their stock for people who don't understand how markets work, they resort to stock splits. Listen, the stock split happened right around the time that their head of FSD and AI, Karpathy, decided he was taking a 4-month leave of absence when they're supposed to be delivering level 5 FSD this year. There was other news, negative news that came out that weekend. So they announced a stock split. By the way, that's not going to happen until 6 months out. I think this was a diversion tactic. I think the Twitter investment is likely a diversion tactic too, from bad delivery numbers. And we think the Q1 earnings estimates are going to be bad too. So I would look out for those who think that this stock will react to fundamentals, because the fundamentals are deteriorating quickly. And again, when you say Dan Ives has been right on the deliveries, I would challenge that. Go back and look at his estimates versus what they actually delivered.
Yeah, I only have a minute left. So I know that, I mean, we all have to agree, whether you like it or not, Tesla's popular, right? I mean, what they're doing and selling with their cars overall, with that 310,000, the 3 and the Y were a majority of the, you know, over 295,000 were the 3 and the Y, not the S and the X. So we know which ones are the best sellers. You talked about market share, losing some market share in Asia. I mean, there's certainly a lot of up-and-comers. I know you've mentioned BYD before. I've seen that in some of the notes. Do you think that Tesla is not a market leader, or is there another name or 2 or 3 that we really should be focusing on EVs? Are you a believer in EVs and just not Tesla because it's overvalued?
Yeah, so EVs are just 5% of roughly 5% of global auto sales. Tesla is not the leader in China. BYD sells significantly more EVs in China. They sold over 100,000 EVs in the month of March alone in China. BYD trumps Tesla in China in EV sales. VW sells more EVs than Tesla in Europe. And right now, Tesla is the leader in the US, but that's only because Ford and GM have not really got their act together with respect to EVs, but they're investing billions to do so. So when people call Tesla a leader, they're not a leader in China. They're not a leader in the EU. They rank nearly dead last in FSD. They're not a leader in any kind of technology. So I don't know what people are talking about when they mention Tesla and leader.
Where should it be priced? Right now it's at $1,148.
We believe Tesla is worth about $67 a share, and we think by the end of 2022/2023, the stock will be there.
Listen, I'm glad you're on, because there are some people who think that we're too busy touting Tesla to the upside because everybody's in on it. And, you know, I'm willing to listen to all sides, and I'm really thankful you were able to join us, Gordon. And
hey, thanks a lot for having me.
Talking to. Look, Buffett is hot on BYD. I mean, we've always been watching Tesla doing amazing and delivering and record deliveries, but you know, we respect your opinion. Gordon,
well, it was a record delivery by 0.5%. And again, they changed the definition. So was it really a record delivery? I don't know. I don't think anybody
didn't change the definition. Maybe just admit it. I don't know the answer. But I understand.
We deserve. I think the investing public deserves an answer.
Well, that's a good question in itself. And you know, we'll have to leave it there.
Absolutely.
There. We have extenuating circumstances too. Gordon Johnson, GLJ Research. That was fun, right? All right. We'll take a look at DraftKings and why its shares are surging. And we'll also take a deep dive into the tech sector and see what names investors should be watching. We head to break. Here's a look at winners and losers in the S&P 500.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome back, friends, to the watch list on this beautiful Monday. I'm Nicole Petalides, live at the New York Stock Exchange on the corner of Wall and Broad. Thanks for being with us. 90 minutes left in the trading session. You can see lots of green on the screen. We've seen communication services, technology, consumer discretionary doing well today. Right now, the Dow is up 76 points at 34,894. The S&P's up 30 at 4576. The Nasdaq up 258. Look at that. The tech heavy Nasdaq up 1.7% at 15,119. And the Russell is gaining almost 4 points at 2094. So we've had plenty of people coming on and expressing some caution as well. I'd like you to take a look at shares of DraftKings. It's a name we've been watching throughout this morning. It's been on the move, of course, climbing about 7% in the session. I want to talk with Michael Keeley, contributor of the TD Ameritrade Network, to take a look. It's got some big news that it announced, and you tell us some of the details.
That's right, Nicole. So this is news of operations that are going to be launched in Puerto Rico. And so they got the approval to expand their relationship through a local tribal nation to be able to offer online and retail sports betting in Puerto Rico. And so, you know, this is seen as a positive, no doubt about that, and the shares are lifting. However, we have to point, Nicole, to the performance of the stocks in this space, DraftKings being one of several that have had a really rough road over the last year. And I can recall distinctly last year at the same time, a lot of buzz, a lot of excitement about new frontiers opening within the digital sports entertainment area with online betting, sportsbook, iGaming, and specifically a catalyst of March Madness being cited on a lot of the publications that were out there and some of the analyst reports as being, you know, something worthy of attention because of the billions that are spent wagering on March Madness. But you know what, Nicole? The shares were looking a lot stronger in terms of price action last year at this same time than they are right now. We're looking at a stock nearing, you know, very near and up off of a 2-year low. So with analysts projecting losses this year, losses next year, there's not as much leash, I think, that investors and traders are providing for firms that aren't producing profitable outcomes right now with positive cash flow, and this would be an example of a company that is not.
Right, and you know what's interesting is that earlier today we had on Macquarie Group's Chad Bainan, who seemed hot on DraftKings. I mean, he liked it. He talked about it being the #2 player in sports betting, and he had a $38 price target, so he saw some upside potential there. Michael Keeley, thank you for that report. We appreciate it. Michael Keeley of the TD Ameritrade Network. Thank you. I want to shift back here, a close look at the tech sector. We said the NASDAQ was leading the way. We saw it up 1.7%. Joining us right now, Daniel Rubino, Executive Editor of Windows Central. Thank you so much for being with us. So everybody's calling this a bear market rally. Do you think it's a bear market rally, particularly for tech?
Yeah, so obviously tech's had a rough year so far, and the question is, should you buy on the dip? And if you're buying on the dip, what companies should you go after? We see the Pelotons and the Netflix is suffering greatly, subscription services, all the stuff that during the pandemic seemed to have been surefire hits are now not doing well. But what is doing well for the long-term sector, I'm talking years out, it's still the same companies we were talking about 6 months ago. Anything involved with cloud, software, cybersecurity, chip manufacturing, this is all the future in tech right now. And all the big companies there, including the FANG group, as well as your NVIDIAs, are also going to be doing very, very well and are all positioned to continue doing well. So should you buy now and wait it out for the next couple of years? Yeah, I don't know if we hit bottom yet with the tech, but it does seem like we're starting to see a rebound as the market is correcting itself.
Right. So as the market is doing this, what names are we looking at specifically here? Because it was funny, I was looking at the hot chart where you see what things are doing today, and a lot of the FANG stocks managing to hold on here. Is that group a good group overall?
Yeah, definitely. There's nothing coming down the road I see that's really going to disrupt that. Even Meta, right? Facebook. Facebook has faced a lot of issues, just regulatory problems on the horizon, possibly. There's a story out this week about TikTok, and Facebook trying to, but the bottom line is Facebook is still doing well, and I think they're going to continue doing well. So despite there's a lot of animosity out there, I don't really see this affecting their performance anytime soon. Same thing with Google, same thing with Apple. These companies all seem to be very, very strong. You have a company like Microsoft, who obviously I cover every day. They're just so well positioned for all these markets, whether it's going to be cloud, it's going to be enterprise, edge computing, holographic, the whole metaverse, thing. So Microsoft, I think, is really positioned well here. NVIDIA, people think of NVIDIA as gaming, also data center, no doubt about it. They have the hardware for it, but they're a full stack company. Let's not forget that they're really investing heavily in software. That recurring revenue for subscriptions is going to be their real driving financial factors for the next couple of years. And I think that's one reason why people are so positive about NVIDIA and where they're going with the future. Another company I like, ASML. A lot of people don't know about this company. When we're talking about chips, ASML is the company that supplies the technology to companies like Samsung, TSMC to manufacture the chips. They do a thing called lithography, but it's a specific version they do. They have no competition here. So when it comes to extreme ultraviolet lithography, these machines cost around $200 million a piece, and they're the only company in the world that makes them. And it's such a crucial piece of technology. It's also not being shipped to China. So that's another company, I think, long-term investment. They just don't have any competition, and we know chips are super important. All the chip makers need this technology, and it's just, it's a very cost-effective, or I should say cost-effective, but very lucrative business for these companies.
And I also think, I'm glad you mentioned NVIDIA and ASML, and you had Microsoft in there. A name that sort of came out, and it felt newer, but seems to have some traction, is Roblox. Tell me a little bit about that one. You still like that, right?
Yeah, Roblox is, like every other tech company this year, has had a significant drop in its overall stock performance. But Roblox is kind of positioned well for this metaverse thing. And I hate throwing that word around. It is a buzzword at this point. But the fact is, It already is this sort of metaverse. It has in-game e-commerce already. They have big partnerships with Nike and other companies coming forward. Their market share continues to grow. Their user base continues to grow. Their monthly active users continues to grow. And if you think of them as similar to Minecraft, what I'm curious about is any company going to try to buy, because that's what we've been seeing in the gaming industry lately. A lot of consolidation. You see Sony, you see Microsoft trying to buy out these studios. I personally see Microsoft purchasing Roblox as a good move. They did, buy Minecraft a couple of years ago, turned that around, and that's been doing exceptionally well for Microsoft. I could see the same happening here. It's the same sort of, gaming environment that they're in.
And you and I have been talking a few years at this point, Daniel, and I'm always fascinated by what's on your shelf in the background. Now, I know you must carefully place some of the things that go there. I've seen Xbox controllers, and this is your, wheelhouse. This is your beat. What, I don't know, software, hardware, what are we really going to be talking about and excited about when it comes to tech? What companies will be bringing us some really exciting things for 2022?
Sure, at least in the PC space, the push is going to be for foldable displays in computers. Obviously, laptops open and technically full, but I'm talking like what Samsung is doing in the space right now. Samsung, Intel, Microsoft have all got together and are basically trying to push a new form factor in PCs. So you can think of a big tablet PC that then folds in half, and you can actually drop a physical keyboard on. Some of these have already been announced. Lenovo was out there first with it last year. We're going to see many more of those coming out 2022, push it to 2023. So this new idea of like new form factors for portable computing that starts to blur the lines between your phone, a tablet, and a computer, that's going to be the big push in the PC industry. It's going to be really interesting to see, how successful that is. But companies like Samsung, Intel, Microsoft are all there. And then you have LG, HP, Lenovo, of course, will be there as well. So I think that's going to be really exciting to watch in the computing space.
Yeah, that sounds exciting, right? You'll be able to fold your tablet in half and attach a keyboard. Very cool, Daniel. You always know the good stuff to talk about. Thank you, Daniel Rubino, Executive Editor at Windows Central. Thank you. I'd like to turn our attention right over to the home improvement space. Our panel is here. Chris Raja is with us, Senior Analyst at Argus Research, and Kevin Green, Senior Derivatives Manager at Charles Schwab. I want to get your opinion here on what to expect. This, as we've seen mortgage rates zoom up to over 4.5%, Chris. What does this mean for the home improvement names?
Well, I mean, I think it can be positive. I mean, I don't think it needs to be the doom and gloom that a lot of the street is seeing. So certainly the next catalyst for the sector is to show that they can grow and to show that they're not going to be derailed by higher interest rates. Now, why would that be possible? I mean, the biggest part of my framework for looking at these stocks is, do people see their home as a cost or an investment? Back in the Great Recession, when people didn't have home equity, when their home was underwater, they were very reluctant to put money in their homes. Right now, people have huge amounts of home equity. We have, almost record home price appreciation. So people clearly see their home as an investment, that's somewhere good to invest money. The next thing is that consumers, their balance sheets are in very healthy position. Job growth is strong. And I think even people who are in their home may be saying to themselves, number one, we refinanced at low levels, so we're sitting pretty. And even if we don't move, even if we're going to stay in our house for a while, let's fix it up. Let's make it nicer. And we've also seen this whole period of COVID shut-in where people realize that their home's a different thing than it was several years ago. And I think people can still catch up on what they want their home to be. The big thesis is we have a shortage of housing, and either they're going to have to get built, or the millennial generation is going to have to go out and find homes that maybe aren't as nice as they hope to buy and fix them up. So that's my take on things.
Right. I understand what you're saying. What do you think, Kevin, as we see these names? I mean, we saw certainly people made a lot of money on some of these names, but they've pulled back some. What do the charts tell you? What are you hearing?
Thank you, Nicole, for having me. Yeah, we saw these stocks, Home Depot and Lowe's, actually come back down a little bit from their all-time highs. But that's not to be very surprising. Obviously, we were in a very interesting situation when it came to COVID, and the investment that people made into their homes and buying new homes just went through the roof, if you will. Now, I would say that we are seeing a little bit of a reduction in mortgage applications, so that's going to have an impact. We are seeing a little bit of a slowdown in new home sales and then also pending home sales as well. But one thing to keep in mind, though, Nicole, we are seeing from some of these home builders, if you will, the Lennars, the D.R. Hortons, if you will, their backlog is just astronomical. So they still have a lot of homes to build that have already been, spec'd out, if you will. And I think that might be a continued driver for this particular space. If we're looking at the overall chart, let's just look at Home Depot, for example. If you're looking at it right now, looking at a short-term support area, about $295, kind of right at that level right now, and then a longer-term support at $245, and then a resistance level at $340. Now, that's going to be a pretty wide range, but obviously the stock has pulled back considerably. I would not be surprised if you see a little bit of a bid to the upside as traders try to find value and try to find yield in this market that's been so volatile as of late.
Right. And Chris, what are your final thoughts as you take a look at what's going on here? I think you made a point about investors in their homes, right? So it's not about necessarily just buying new homes, but it's a lot of do-it-yourselfers. Even with inflation and supply chain disruptions, I mean, people wait forever for a washing machine or something. Do you continue to expect people to be able to afford what it is that they want to get?
I do, and thanks, Kevin. I was taking notes while you were speaking and writing down all those points. But yes, I think when you look at how much homes are appreciating, and if somebody decides to sell, I mean, there's just such clear upside in making an improvement, whether it's your siding or it's kitchen counters or whether it's doing some painting. So yes, I think there's definitely upside there, and I think as long as the consumer is in good shape, there's definitely the potential for more home improvement spending. And the other thing I think I should clarify is that while they've been growing so fast in the past, I mean the analyst community does know that they're lapping things and they've got tough comparisons. So it's not like the analyst community is expecting double-digit growth in the future. I think there's pretty realistic expectations for what's priced into the stocks.
Mm-hmm. And I agree with you. I think Kevin made some great points. I know some of the things that he had sent to us earlier was just about building permits data and some of the cost of sales increasing due to the commodity prices, but some of the other elements that you were putting in there. You had your short-term support, your long-term support, and the resistance. Kevin, I'd like to hear more from you about that and your final thoughts.
Definitely. Well, you saw a little bit of a turnover in both of these stocks, especially Home Depot, compared to Lowe's. And that's actually not surprising. Lowe's was actually a little bit of a cheaper value for the last year and a half compared to Home Depot. Right now, they're both trading, Home Depot is trading at about 19 PE, if you will, and I believe Lowe's is trading at about a 17.5, almost 18 PE. So Lowe's is still a little bit cheaper, but it hasn't had as much of a pullback as Home Depot at this point in time. But always got to keep in mind here, when you're looking at these two companies, the way that they are leveraging their cash is a little bit different. And I can tell you that Home Depot, with their last earnings report, they utilized a lot of the cash that they had on hand to get in a lot of inventory. They were trying to get ahead of the supply shortages we've been able to see. Yeah. Let's see if that actually pans out in the next earnings release here, if that's been a profitable strategy for them.
Kevin Green of Charles Schwab and Chris Graja of Argus Research. Thank you both very, very much. A good conversation. I appreciate it. Thank you, friends, for joining us here on The Watch List every single weekday at 2 p.m. Eastern Time. I catch you at 11 and 2 right here live from the New York Stock Exchange. I'm Nicole Petalides. Thank you for watching. Market on Close is next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Good afternoon. Welcome to Market on Close. I'm Oliver Rennick. It's Monday and stocks are ripping. NASDAQ off to a real strong start, about 2% higher. It's pretty much been nonstop all morning. Things kind of got off with the interesting start from Elon Musk with the 9% stake in Twitter. Seemingly has got investors psyched up about some of the big tech and social media. When Meta Platforms is up big, then something's in the air that's a little bit different. The stock has been struggling, and so even it waking up a little bit. We got Tesla up 5% here, and a couple big moves in giants like Apple as well that are putting some crucial stocks just below their all-time records. The big rally we got up off the lows now is near a bull market territory. So technically we describe it as bear market when you go 20% off the highs. NASDAQ ticked that, and then that next day started rallying. And so 20% off the lows, we're not in a bear market anymore if we close at that level. So we're pretty darn close right now. The Russell's not doing much. Small caps are a little bit frazzled after last week, trying to get back above 2,100 and failing. Russell, I do think, really important here. NASDAQ, the second worst performer after the small caps, and now the best performer off the lows. So you're getting that kind of snapback activity that we generally see when this market does take a stab at beating down tech names and the market as a whole. It's growth stocks, it's companies that used to be expensive businesses, some still are, but those that really got beat up on the way down now have that reflexivity on the upside. So generally the stuff that got hit the most on the way down is doing the best here. Not a whole lot of real power in the cyclical value trade. That's definitely lagging on the way up, but it's not doing terrible. So generally, breadth, I think bulls will be happy with right now. If you're a passive indexed investor, you're getting pretty excited as we're getting close to those highs. But we haven't quite taken them out yet, and a few charts here still need to clear a little bit, just a few more inches of hurdle before really getting off to the races, I think. We'll get to that in a sec. Firstly, crude oil, 4%, just continues to go higher. WTI doesn't really need a lot of constant news flow, it seems like. It just is a baseline trend that we have to watch every day, is being a constant reminder of the inflationary forces that generally have been driving the market. You can see a lot of volatility to the upside in the Ukraine situation, but you really, again, can just kind of pull that out and look at the overall trend for WTI, and we've pretty much settled right back into that trend, finding that strength. There's no real reason here to expect WTI to roll over unless there is some shock event, it seems. Whether that's going to be some major breakthrough in peace talks between Russia and Ukraine, you'd think that could be crude oil negative. but even some of the economic news flow, where a few of the last data prints have pointed towards some slowing of inflation, at least in some of the economic figures. Looking at last week's PCE came in line with expectations. It's still very high, but in line with expectations. And we got some data over the weekend that shows some of the trucking prices have cooled off, according to some reports as well. But it's not showing up in WTI at all. I mean, just continuing to rally. So before you get too excited about the peak inflation being passed, or at least the market understanding the risk of inflation, we have to keep watching the chart of crude, which tells us almost every day that it still is going higher. So prices there are definitely still going in one direction. Looking at stocks and some of the big swings in today's market, most of it is generally pretty tech heavy, but there's a few little holdouts here in the overall narrative that could be a little bit problematic. Firstly, the dollar is up pretty sizably here, pushing back towards kind of punching up into the high end of its recent range. It didn't break down, and now it's trying to break out. So naturally, when you have this kind of range-bound trade in the dollar, really since the first week of March, failed to break down, and now we'll test to see if it breaks out. I do think we have to watch this very carefully. Market has been very optimistic since Jay Powell did that first hike. Okay, the dollar had pulled back as well. Okay, here's the first hike, and the dollar pulled back. This is March 15th. So it's interesting that the dollar has found this range as the market got more details about that hawkish plan for the Fed. And if you view the dollar as symbolic in the markets, degree of anxiety around potentially interest rate hikes derailing the economy, I think this is a crucial, very important chart. There's other stuff that goes into the dollar, of course, a lot. Geopolitics, the general central bank divergence, though, is very crucial in the direction of the dollar. We're hiking rates, and other countries can't right now. That's the bottom line. They're trying to in Europe, trying to follow a longer path, but not as quickly. China's a total mess right now. I was just looking at videos on my desk of Shanghai lockdown, people trying to escape lockdown to go get food. I mean, it's nuts. So they're doing the opposite, cutting rates. So if the dollar does break out higher here, I think that's going to be a little bit of a risk point for assets in the stock market, risk assets as a whole. If the dollar continues to break out, I think that's telling us that the market is once again seeing this as some type of safety trade in an interest rate environment that could potentially derail some of the other risk-on behavior right now, but not yet. Okay, it's still holding here. I think it's kind of a race right now. What's going to break out first? Is it going to be the dollar, signaling that we still have anxiety and potential economic risk around interest rate hikes? Or is it going to be stocks like Apple and Tesla, which are also trying to break out? The high beta ETF SPHB up almost 2% today. This one's going to do better than your basic passive fund on up days. And as I pointed out, it still is downtrending, lower highs and lower lows. But if you get another couple percent here, then potentially you could get above that recent high. But as of now, high beta stocks are still in that broad downtrend. You have to really give some appreciation to the technical descriptions here to try and identify what is unique. And so far, even with some of the good strength that we've gotten in these types of names, it's not particularly unique. It is kind of getting over the February and March highs, but generally still that downtrend. You want to see more strength before kind of clearing the bar there as well. Apple and Tesla, these are stocks right below highs, but still also, I mean, if you're going to be very, very particular, the chart of Tesla too, even after a 6% jump today, is still below its previous high as well, but barely. I mean, this is an incredibly impressive move, just a ton of strength. The appetite to buy these companies is still very much there. Keep in mind, this is what we did get in the first couple months of weakness in this market. We had a big bounce back in Tesla too at the end of last year. Fell short of the previous high. Now do we do the same? Tick back down and continue that downtrend as we also made the lower lows here. Technically, you have to describe Tesla still as being in a downtrend. But if we get, really, it looks like just one more day, who knows? Maybe if we close with some serious buying action. But generally this week, we're going to find out if we are out of that bear market trend, out of these downtrends. Because you can't really, I mean, I guess you could go sideways for the next 4 days, but come on. Probably not going to happen unless some sudden equilibrium reaches this market. This is a very swingy market. We still have VIX near 20, but it is dropping right now. So possibly things could calm. But if you start getting upside moves in Tesla and Apple to break out, that's a very different market than the one we've been looking at for the last 5 months, and one very encouraging for bulls. Price action is king. You break out, and that is bullish for sure. So we're very, very close on some of these. One other hang up though, Bitcoin down today. Where's BTC? BTC was the early strength in risk assets, putting in the higher lows over the last couple months, even as the NASDAQ was going down and making lower lows. So Bitcoin kind of stalling out here. We'll see. Maybe it's nothing. We'll find out if it wakes up. But if it stays down while stocks are trying to move, I think that's a little bit of a yellow flag for stocks, but more of a red flag for Bitcoin. Good news is we're going to talk some BTC. We've got Anthony Scaramucci joining us in the second half of the show today. Looking forward to catching up with him as we haven't talked since his big Bitcoin adoption. So that'll be exciting. We've also got Mark Faber joining us here at the top of the show to talk about doom, gloom, and boom and figure out which one that we're in right now. But first, let's get some more news from Caroline Woods, Kevin Hanks, our contributors and hosts here. Kev, things really took off today. I mean, this morning seemed like Elon kind of put a little bit of fire under bulls, but who knows the reason? It just seems like everybody woke up ready to buy this morning. Okay, I don't know if we got Kev's audio, so I'm going to throw it to you, Caroline. The Tesla move keeps going, Caroline. I guess it doesn't matter that he might get involved in another biz. People are just ready to follow wherever Elon goes.
That seems to be the case. Twitter up almost 30% today, on track for its best day since its IPO. It closed up 73% on its IPO, so this would be next best compared to that. Bringing other social media stocks higher as well. Pinterest is up 10.5%, Snap up 5%, Meta up 4%. One social media stock not doing so well today, that's Digital World Acquisition. That's the SPAC that's merging with Trump's social media platform, Truth Social. That's down about 11% today, on pace for its 7th straight day of losses. So the Twitter Elon Musk news likely not helping it. Also, there was a Reuters report that the heads of product development and technology, the chiefs of product development and technology, have resigned, so that's contributing. But of course, the news, if in case anyone was under a rock, is that Elon Musk is taking a 9.2% stake, or 73 million shares in Twitter. It's a passive stake. It's below the key 10% active threshold, but many people are saying this is just the beginning. They expect him to take a more aggressive stance, and even, talking about a potential buyout. But, it's interesting you mentioned Tesla. Obviously, that could be up on delivery strength as well. But, I was looking at a comment from Dan Ives in terms of implications for Tesla and SpaceX. Obviously, Elon Musk already works, 60, 80 hours a week. Does he have time for something else? He said, "We view this move as Musk building out his tentacles, and we're not worried in any way about Musk taking his eye off the ball with Tesla and SpaceX." So he's one of those people that believe this is just the beginning, going from passive to active. So Tesla, as you can see here, up almost 6% today. So showing no signs of slowing down.
The Buffettification of Elon Musk's portfolio, I guess, just become a big investor in companies you believe in and have some extra sway. Jack did it with Square and Twitter for a while, but many would say that maybe that's kind of the reason why Twitter's in this problem, that they didn't resolve some of the main issues, core problems. Hey, news flow around Elon or not, Kevin, at the end of the day, as traders, we watch price action, and boy, are we getting close here. I mean, it seemed like just a couple months ago, all hope was lost for tech bulls, and now we're looking at a couple bucks away from an Apple all-time high. What do you think, Mr. Hanks?
Yeah, from out of the ashes, right? How long, Oliver, did you and I talk about that left side of the heat map was just red and ugly and soft, and really social media was a big part of that. It had no energy, right? The Facebook news and the Facebook price action, the news out of Twitter, they had given this sector no energy going forward. I think Elon Musk, to Caroline's point, he's going to prove that he can walk, chew gum, juggle, and ride a unicycle at the same time. He's going to do many things. Let's see if he can do them well, because so far he's got a pretty good track record of juggling different different industries with each other. And we all know he's got an interest in social media. He likes it. So there's the inertia for him to start this. But yeah, this has given, I think, that whole group, Pinterest, Snap, it's given all of them energy in different levels, but I think they're all energized by this news, Oliver.
It is an effective battery here as Pinterest is able to rally. I mean, that thing has been dead money, so some energy for sure. So we'll have to, as traders, be careful too about what is dead cat in this market and what's not. Pinterest has got a long way to go. All right, but if Elon's interested in Twitter, who else knows who might be interested in some of these beaten down tech companies at these prices? Thanks, Kevin. Thanks, Caroline. Good context here for a big rally here today. NASDAQ up just shy of 2%. And we know we just went through a pretty big boom. Are we still in? Or is it time for gloom? Maybe doom? Mark Faber is joining us, editor and publisher of the Gloom, Boom, and Doom Report. Mark, we spoke some years ago at Bloomberg Radio, but it's great to have you here on the TD Ameritrade Network. Good to see you.
Nice to see you. And thank you for having me on your program.
Absolutely. Thank you for being here. So cut to the chase. Which one are we in right now? Or do we have any boom left in us?
Well, as you know, last year, a lot of stocks were down 50% to 80%, the meme stocks. Even the ARK Innovation Fund was down 50% from the high in February 2021 to January of this year. And since then, a lot of these bombed out stocks have rallied strongly. But there are only very few that will make new highs. I mean, you mentioned before Apple, that's a possibility. And also Tesla and maybe another 10, 20 stocks. But the broad market is not likely to make new highs. And if the old FANG and FANG-related stocks, the Facebook, Amazon, and so forth, if they make new highs, investors have to be aware that this is not the new bull market, that this is kind of an extension of the old bull market, which is taken place because there is still excess liquidity in the system. This has to be very clear to everyone. There's a lot of liquidity still around in cash accounts and so forth. And you said the Fed is going to tighten. Well, that's very relative. Inflation is running depending on your household, how many children you have, how many wives you have, and so forth, at between, say, 7% to 15% per annum. But the Fed is discussing whether to increase interest rates by 0.25% or 0.5%. And, you know, it's irrelevant if inflation is so high. So this is something to keep in mind. I'd just like to remind everyone here, in the 70s, when inflation was high as it is now, and that was in 73, 74, when we had the oil shock, the 10 years treasury already in 73, 74 went to 12%, 12. Then it dropped to around 6%, and then it went up to over 15% in 1980. So all I want to say is here we are in the US, but even more so in Japan and in Europe. In Europe, the inflation rate in Germany is over 7%, and the interest rate is at 0. Because the central bankers are money printers, and they rather hurt small households, poor people, than the rich asset owners. That has to be made very clear to everyone. The rich asset owners, the holders of big shares and so forth, they're not hurt by inflation. But the small guy, the family that has a low income, say more than 50% of US households, they get hurt if cost of livings go up substantially, especially food prices, energy prices, transportation prices go up a lot.
The stock market, as you mentioned, Mark, if it pans out the way you believe that broadly there will be enough weakness to keep the index from making new records, does that start to pinch the wealthy? Does the stock market, that does inflict a bit of pain for asset holders. Will this administration let the market go down?
This is a very good question. In my opinion, we are in a world where presidents of countries don't matter very much. There are people behind that kind of manipulate them and tell them what to do. And my view is they will not increase interest rates meaningfully. They'll increase them for a show. They have to say, oh, we're fighting inflation. But you understand, the COVID-19 saga or virus or whatever they call it is a very highly suspicious event. Number two, the Ukraine conflict is also suspicious, why it happened exactly now and so forth and so on. But both give an excuse not to increase interest rates. First, they could say, oh, we have COVID, we have to print the money to keep the party going. And with Ukraine, now they can say, oh, we have Ukraine, we can't increase interest rates in this situation, and so forth. You understand? All these things are, for me, as an observer, and I'm an asset holder. For me, it's nicer if stocks go up, if commodities go up, if everything, your real estate goes up. But as an economist and social observer, I'm telling you, I think we're heading into very difficult and tough times for especially poor people that have a high percentage of their income on food and energy and necessities of life. Aldi in Germany, Aldi North, this is the lowest cost discounter in Germany. It's a very successful company. It was started by two brothers with nothing. They just increased prices by between 20 and 50%. 20 and 50%.
Saw that, yeah.
Go to a store in New York, go to a store anywhere in the US, prices are way up.
Mark.
But the Fed members, they never go shopping themselves. You understand? They have employees to do that for them. They don't know what the cost of living is, or they're liars. Both possible. Ignorant or liars. Both are not very favorable for people to run a central bank.
Mark, what about the person that's somewhere between the poor and the rich? What about the person in America who has household wealth that has increased over the last 2 years? What about those that now have assets tied to financial assets, household wealth more tied to financial assets? Is there an obvious solution? Do I take my stock holdings, my 401k, flip it on its head and short the market instead to make it through this route? Do I go and buy a digital token that doesn't have any obvious immediate utility in a store either? What's the solution, Mark? I'm hearing the doom part. Give us a way through.
Actually, I tell you, in inflationary times, some of the poorest people actually are almost better off, because what happens is that taxes also go up. In other words, how much you have to pay to the government to monitor you and to annoy you. So all over the world, in the developed countries, you can be sure taxation will go up, but not taxation on the richest people, because they can afford an army of lawyers and accountants and all kinds of advisors. But the middle class, say if you're a doctor and making $1 million a year, and not many doctors make that, but say if you are one, you can be sure that your tax will be very high. If you're an employee in a corporation and they see how much your salary is, your tax will go up, that for sure.
Mark, have you made changes to your assets, your ownership? Can you give us an idea what you see as something that might work in the environment you see coming over the next year?
Well, except for trading opportunities where bonds may rally somewhat, I think that you need to be more in assets. In other words, real estate, but not every real estate. You understand? The market for stocks and for real estate and for any business is very fragmented. You will have good companies and bad companies. And you will have some real estate that will go up. If we look at the US, some real estate like in Phoenix and in Florida has gone up a lot. and in other places it hasn't gone up a lot. In general, stay away from real estate of democratically run cities. Chicago, Baltimore, New York, any Californian city, and go to more reasonably run cities where people still have an appreciation for hard work and for policies that make sense, common sense policies.
A lot of those areas are going to be pretty expensive now, Mark. Places like Florida got pretty expensive. People moved out of those cities. Buying a house in Palm Springs, Florida now is as expensive as Palm Springs, California.
Yeah, sure. But they are like in Europe. You know, you go to Portugal, Spain, Italy, Greece, Macedonia, now in Eastern Europe. You can buy real estate in the countryside at very low prices. And I can do my business from anywhere in the world. I don't need to be in a city. In fact, in a time of COVID, and more COVIDs will come in future, you can be sure of that. The governments will launch something else. You're better off in a small village, but don't have a house next to a bridge, because the bridges are used by tanks to cross rivers. And all the houses in the neighborhood are shut down.
Complications.
But next to a river, you need water, and you cannot live a lifestyle of a rich guy in a small village. You have to adapt and play the poor guy, because otherwise you stand out, and then in a revolution they'll come and hang you. So all these things you have to consider very carefully.
Mark, I don't think many of us, not all of us have that option, but we could buy an emerging market real estate ETF or something like that, where we could get exposure to that region and potentially other ways besides the move, perhaps. But a message received. Mark Faber, thank you for being here. I appreciate your contribution.
Well, it's my pleasure. You can go to Latin America. This is not that far. Same time zone.
That's true.
And prices are very reasonable at the present time.
I was just speaking with somebody at a wedding last weekend, buying up real estate in Colombia, in Bogota and Medellin, as an example.
Yeah, sure. Medellin is very good. It's a nice place.
Yeah. Looked at the apartment. Pretty good deal for $1,800. Mark Faber, thanks for the tips. Appreciate it.
Medellin is ideal for Hunter Biden to retire.
Okay. All right, Mark, thanks for being here on the TD Ameritrade Network. Mark Faber, editor and publisher of the Gloom, Boom, Doom Report. Find somewhere that's not as expensive as Western democratic cities. If you can't move immediately, I'm sure you can find someone who can buy the properties and put them in a fund. There is some emerging market and developed world exposure too. That's what I'm taking away from that. Anthony Scaramucci is joining us to talk some BTC later. I told you we got a fun show coming up here. Let's get some stock picks from our next guest.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
All right, let's talk some stock picks, companies and businesses that you know that are within grasp to buy and sell. And Michael Klarfeld joins us as Managing Director and Portfolio Manager at ClearBridge Investments. Mike, let's talk some stock picks and what your team is thinking about right now as we look at a market here rallying back pretty big. Obviously, we heard a little bit of the doom case there from Mr. Faber, but not the first time we've heard it. If you do want to buy assets here in the U.S., what do you like right now?
Yeah, so I think, we're long-term oriented investors. So, we're not in and out traders, but trying to find investments in high quality companies and the equities of high quality companies where we can compound investments over the long term. And we run a dividend growth portfolio focused on companies who can compound their dividends. And, dividends are always great, but dividend growth is particularly critical in an environment like this. We keep talking about inflation and rising rates, and dividend growth is one of the only things that can help investors offset that. So what we're looking for broadly is companies with high quality businesses, strong balance sheets, companies who can navigate the ups and downs of the global turmoil we see and who can compound their dividends at healthy rates over time. One of the things we're looking for most with the companies we invest in is that they have pricing power, because as we are all talking about and seeing around us, with costs escalating so much, no companies are immune from this. We need to be invested in companies who are able to raise the prices to their consumers enough to offset the rising costs they see and still maintain their profitability.
At this point, the market is giving a little bit more optimism to some of the companies that it really didn't want the last 4 or 5 months. The powerful bounce back in growth tech. It seemed like the narrative you're describing was pushing people towards dividend pairs and more kind of reliable cash flow models instead of the high growth software stuff. But now the last month has kind of thrown that whole thing into question. What is your view here on how the market's kind of processing? It seems really the hikes that Powell is doing, it's not getting in the way of these tech companies. I mean, what happens if we get some of these tech breakouts? Are those type of dividend payers going to get left behind again?
Yeah, so I think, you presented as sort of a dichotomy where there's high growth companies that maybe aren't, stronger, don't have great fundamentals behind them.
Sure, yeah, there's both, right? There's hybrid.
Sure, I think, what's different today from other points in earlier market cycles is that the growth companies today are highly profitable and are some of the best businesses we've ever seen. I don't think we would expect we're not forecasting by any means a meaningful diminution in their, in their strength or their earnings power. And we expect that to continue. I think one of the headwinds that you've seen significantly of late in those, and I don't mean of late just in the last few weeks, but over the last, call it 2 quarters, is valuations in the face of rising rates, right? So in the last many years, when interest rates have been near zero, you can sort of support any multiple on a cash flow stream for an asset. With rising rates, purchase price really begins to matter again. And so I think we would continue to expect, broadly strong fundamentals from tech companies. It's just the large cap, high growth tech companies. It's just a question of what people want to pay for them. From a dividend perspective, there are a handful of high growth, tech companies that pay nice dividends. We have some exposure to those, but I do think that part of what you're talking about or implying, and I think in the question is what happens to higher multiple stocks in a rising rate environment. I think we do have concern that the last many years have been a time where, again, purchase price hasn't really mattered. And we think that with interest rates rising, it will begin to matter again. And so we think investors ought to be cautious in that regard.
A few stocks that you're looking at that do meet that dividend priority. Enbridge, if you want exposure to energy, Apollo to financial assets and investment management. The one that I want you to tell us about is Comcast. This thing's been just kind of left for dead. What's the growth story for Comcast, or is this more just a pure dividend style way to park money in a business that may be struggling a little bit to keep up, but is not going away necessarily?
Yeah, no, it's interesting. I think Comcast stock has really languished on concerns over competitive dynamics.
Yeah.
And we think that concerns are really overdone. I mean, this is a company that's actually putting up a very robust earnings growth. It's trading at about 13 times earnings with a 2.5% dividend yield. And keep in mind that the vast majority of the earnings these days comes from high-speed data networks, right? So everybody's high-speed internet at home. And the future of work with a more hybrid environment or work from home, and with 5G, and I mean, that's a wireless component, but the demand for data only goes up and up over time, and they have the best mousetrap. And so they continue to add subscribers at a slowing rate, but they have terrific pricing power rather in that business. So, we actually think that their pricing power, people appreciate it, but we think they can lean into it a little more in the current environment and extract even better earnings. So you have a company, or better margins. You have a company that's trading 13 times earnings with the market, much, much higher than that. And then they have a cyclical kicker coming as people, continue to pick up travel, resume travel in the parks. So, we think we think this is a terrific position here. Very asymmetric risk reward here.
Okay, asymmetric risk reward. A lot of people find that music to their ears. Mike, thanks for the analysis and the stock picks. Appreciate it.
Take care. Bye.
Same to you. Michael Klarfeld is Managing Director and Portfolio Manager at ClearBridge Investments. Enbridge, the energy pick, Apollo in finance, and Comcast for an underappreciated survivor story. When we get back, John McNichol, our contributor here, has got some options trades he spotted in today's market. Obviously, Twitter is one of them. We'll see which strikes and calls people are piling into. And for Starbucks, options buyers trying to fade this move, buy the dip.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position?
You two are all set.
Choose the app that fits your investing style.
Welcome back to Market on Close. Let's talk some options trades. Twitter obviously on the list today from John McNichol, looking for the market's big call option buyers. But the one you saw for Twitter is not like the most hyper bullish trade, John.
Yeah, that's right, Oliver. Well, certainly a lot of call activity in the markets today. As volatility has continued to drop below 19, I believe, on the S&P 500. And in looking at Twitter, we did have a gap up. Obviously on the news of Elon Musk taking a major stake and possible speculation of Twitter being a takeover target from the likes of Disney and other media companies such as Rupert Murdoch. But with this example, we actually have a sell of a call, which is typically going to be more neutral to bearish. What the trader has done here is sold just shy of about 10,000 contracts of the April 14, or actually the 50 call. The date looks like the date's off there. Yeah, looking at the $50 call there for a credit of $2.34. Now
it sold about 10,000.
Yeah. Now what's interesting with this is, we had a high today of around 51. The 200-day moving average is at around 52. So what the trader's probably expecting is that the price may back off from where it's at. And if it stays below $50, that's a $2.34 credit. Even if it trades above 50, as long as it stays below 52.34, which is the break even, this would be a profitable trade.
Okay. So the sell downside in Twitter is pretty bullish too at this point. I mean, after the big bounce today, I mean, we've seen some pretty hard reversals and fake outs in this market the last several months for a stock that's trended downward for, almost a year now. It wouldn't be surprising to see the stock give some of this back. So someone's selling downside in Twitter, pretty bullish after this, some confidence that it's not going to totally reverse. What about in Starbucks? John, you saw a trade there as shares are down 4%. Not a lot of buyers today. It hasn't found much relief.
Yeah, another stock in the news, as the CEO mentioned about suspending the share buyback. I think they were looking at buying back upwards of about $20 billion in shares over the next 3 years and halting that. So, the market reacted a bit negatively to that. However, the stock also popped when they announced that Schultz was coming back as the CEO. So it's kind of a little give and take. From a technical standpoint, we're talking about a stock that's been trading in a level, between the 85 to around the $90 mark over the last 10 sessions. So even with the gap down today, it's still kind of holding that range that we've seen. And with the example of the trade, we're looking at an example of a long call. The trader was looking at 2,600 contracts of the June expiration on the 17th, June 17th, $105 strike for a debit of 39 cents. Now, the stock does need to move to the upside, in this case to break even, is at 105.39. That would be to the upside. And that's actually a level that the stock was trading at not much going sooner than around January of this year. The stock is off about 25% so far this year. And so the trader is looking for a bit of a recovery to at least get back into the range to where it was trading earlier in January.
Okay. Nice bounce that they're thinking about here. $87 right now. Well, a little bit below 88, so this would be a pretty nice move for Starbucks if it gets it. But not a lot of encouragement here today so far. John, your last one, you got Alibaba, which with Chinese stocks is doing okay, a little bit of strength, 6.5%, though still keeps it within recent levels. Nothing big breakout just yet, even with all this strength. But, another day like this, and suddenly you could be looking at a big cap China breakout again.
Yeah, that's right. Well, we've seen some more positive news come out of China as far as, one, with them supporting Chinese markets, and two, as far as them being more open to U.S. Looking at their books while trying to preserve some of their, their intellectual property or secrets there. So along that line, Baba has been recovering from some of those levels. Again, kind of in a range from around the 111 up around to around the 124 mark. And with this example on Baba, again, another long call where the trader was looking at 2,500 contracts with the June expiration at the 105 strike. Now, this option's actually more in the money. Notice $19.25 debit. So the trader possibly looking at this as more of a stock replacement type strategy, try and get a similar move to what we've seen with the stock. With a break even of 124.25, that's pretty much just in the top of the more recent trading range. So the trader's basically looking for it at least to trade above that level and beyond. And again, having more of a deeper in the money option, less capital invested to profit from the rise in the stock.
Okay, so pretty bullish across the board. And it's a bullish day, so it all fits together.
Yep.
Okay, John, nice trades. Good eyes. Baba upside, Starbucks upside, and selling some downside in Twitter. What was the strike they sold in Twitter? Okay, there you go. All right. They sold downside in Twitter. John McNichol joining us from Salt Lake. When we get back, let's talk some commodities. Crude is just unstoppable. Stocks up, stocks down, doesn't matter. Crude just keeps going higher. But we did see potentially signs of blow-off tops elsewhere, where trend is not quite as obvious. Think about wheat, corn, some of the other agricultural moves. Those were more like spikes as opposed to trend. Let's see what Chris Robinson thinks next. WTI up 4.5% now.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
I'm Maria Schrader. Here are a few stories to watch this hour. WWE announced that WrestleMania 2022 broke its 2016 revenue and attendance records, with over 156,000 fans at the stadium in Dallas. This is the first WrestleMania with full crowd capacity in 3 years. Next year's event will be in Los Angeles. Shares of WWE are up around 1% higher on the day. Goldman Sachs upgraded Logitech to buy from neutral and raised its price target to 107 Swiss francs from 88, citing strong recent execution and growth outlook. The analyst sees strength in gaming and video conferencing, which he thinks can accelerate sales in fiscal 2023 and onwards. And Bank of America upgraded SunPower to neutral from underperform and boosted its price target to $23 from $13 after the company's analyst day offered clarity on its growth path. The analyst made material upward revisions to his estimates and thinks there is no reason to doubt the turnaround plan SunPower projected. This has been your TD Ameritrade Network Market Update. Now back to Market on Close with Oliver Rennick.
Okay, let's talk some ags and commodity moves. Crude oil is unstoppable, but not quite the same resilience in some of the others, though they haven't broken down. Let's bring in Chris Robinson to talk some charts here, Managing Director at TJM Institutional Services. Good morning, afternoon rather, Mr. Robinson. All right, so crude up 4%. It's still jamming here. I guess we're going to get back to 130. It just might be a couple months from now, or what?